Hello everyone, welcome to JAIIB CIB Prep, and today onwards we'll start with our subject PPB. We start with Unit 1, Module A, Unit 1. In Unit 1, we'll look on to the requirements to be called a bank, what are the different relationship a bank enters with its customer, who is a customer, and then we'll look on upon the different type of relationship which exist between a bank and its customers. So, debtor creditor, creditor debtor, bank as a trustee, bailey bailer, agent principal, SLSC, indemnified, and what are the different deposit products which bank offer? What are the services which bank offer to its customer and investors? Then we'll look upon some questions which are provided in Macmillan book and some practice questions, right? So, without further ado, let's start with this unit. Number one, requirements to be called a bank. Where it has been defined, a bank has been defined under Section 5B of the Banking Regulation Act 1949. A bank is nothing but a company that accepts money from the public and with the pure intention of lending it or investing it. Now, the bank cannot use this money for any other purpose. The money can be repaid on demand or after a certain time. So a person can keep the money in its savings bank or current account, and it can withdraw its money on demand, or it can keep its money. A customer can keep its money in fixed deposit, recurring deposits, and can withdraw it after a certain point of time. Now, what are the essential requirements to be called a bank? Number one, accept bank should accept deposit only for the purpose of lending or investment. Now, if a company accepts money and uses it to manufacture goods, it is not a bank. All right. A real bank uses your money to give loans or invest. Number two, the deposit should be from public. Say if an organization accept deposit only from its member, then will not call that organization, that company a bank. For example, Nidhi or cooperative societies. So, a bank must deal with general public. This is important. And number third, deposit must be in the form of money. Now, a person cannot come to the bank and say that I want to deposit my watch. No, a bank will accept deposit only in the form of money, cash or digital money, and not any other kind of goods or services. Now, a company has to be registered under Companies Act, and a license is required by RBI for using the term bank, or for any company to call themselves a banking company. Say when you put 10,000 rupees in fixed deposit, you can withdraw it after a term. So the money has to be repayable and withdrawable. In a savings account, you can withdraw any time using check or your ATM card. Now, who cannot be called a bank? Number one, money lenders cannot be called as bank. Money lenders, say sahukars, so they lend their own money and they are not organized companies. So they don't accept deposit from public. Uh, they are not open to the public. They are not company. That's why they are not. They cannot be called as a bank or a company giving loans. But accepting deposit from only its members, then that company cannot be called a bank. See, if a company gives loan but does not take deposit from public, then it is not a banking company. This was illustrated in Mahalakshmi Bank Limited case. Again, there are certain other activities which bank can undertake, and they are provided under Section 6. So, Section 5 defines the term banking. It is a definition clause, definition section, and then Section 6 uh, permits a bank some activities. Like, what are those activities? Like collecting checks and bills, safe custody of valuables, issuing drafts, letter of credit, foreign exchange services, or providing safe deposit services. Modern services are also provided by bank. Say wealth management services, bank do sell mutual funds, right? Insurance, tax payments, stamp duty, stock market services, factoring services, venture capital funding. So these are some of the modern services which bank provide. Now let's move forward to banker customer relationship. So we have understood what is a bank, what are the requirements for a company to be called as a bank. Now who's a customer? So there is no legal definition of a customer, right? There is no legal definition, but customer is someone who has an account with the bank. Say you go to a bank, you go to HDFC Bank, and then you want to open your savings account. So we call you a customer, you becomes a customer. Now earlier there was a view that a long relationship was required in order to call someone a customer. So this was known as duration theory. So earlier, only someone who has dealt with bank for a while was considered a customer, and this was propagated by Sir John Paget. But this view was rejected. Um, no, a person who has deposited the money and bank has accepted uh, the money, then that person will be called as a customer. Now, even a person say who opens an account today itself is a customer. So this view was taken by Kerala High Court in the case of Central Bank of India versus V. Gopinath Nair. So earlier, what was the view that a long relationship was required in between a bank and a person in order to call him a customer. But now, even a person who opens an account today itself is a customer of the bank. And a customer need not to be a company or need not to be an individual. A customer, a company can be a customer, a firm can be a customer, government department or trust can be a customer. And according to KYC norms and Prevention of Money Laundering Act, a customer includes anyone who has account or business relationship with bank. Say a company opens a current account, it becomes a customer. A beneficial owner, the real owner is behind the scene. A beneficial owner is the person on whose behalf someone is maintaining or doing transactions. Say if you ask another person to do transactions on your behalf to maintain your account on your behalf, then you are the beneficial owner, and that's why we call you a customer. People doing high risk or large transactions are customers or clients of intermediaries like brokers or lawyers using the bank for their clients. So the client is known as the customer, and people who are doing high risk or large transactions, say you transfer 20 lakhs through a wire transfer. So even though there's no account with a certain bank, the bank will treat him as a customer for compliance reasons. So there's a person A. Now this person transfers 20 lakhs through wire transfer. Even though person A does not maintain an account, say with ICICI Bank, but still ICICI Bank will treat Mr. A as its customer. Now let's move forward to different kind of relationships that exist between a bank and its customer. Number one, debtor creditor. So when a person deposit money, say you deposit your money into a bank account, what are you doing? You are lending money to the bank. So you are the creditor and bank is the debtor. When a person deposits money in bank, now in this case bank becomes the debtor because bank has an obligation to repay your money and you became the creditor. In simple terms, you have done nothing but you have lent your money to the bank. Now there are some key features that the bank can use your money as it sees fit, and the bank will not automatically return your money. You have to demand it, and bank will not provide you any kind of collateral or security. So you cannot ask bank uh, to mortgage their building in order to provide you security or give you some kind of bonds or something. No, the bank will not provide you any kind of collateral or security, and the limitation period starts only when you demand your money. Say you deposit 1 lakh in your savings account, the bank may lend this money to someone else, and if you need the money, you must withdraw it yourself at the reasonable hours. You cannot go to a branch at say 12 a.m. in the night and ask for money from the branch manager, or you cannot just knock the door of the branch manager at the middle of the night. You have to go to the bank at certain hours on certain days, and then you will be able to withdraw your money. So the bank won't offer you unless you ask for it. Number two, creditor and debtor relationship. Now, this is just opposite of what we have understood in the first relationship. Now, these are the key features that I just explained to you. Now, when bank lends money, say when you take a loan from bank, the bank becomes the lender. So, the person who lends is known as the creditor. Creditor is nothing but the lender. Okay. So, the lender is the creditor and you, the borrower, becomes the debtor. What are the key features? You must repay the loan with interest. You must may sign certain documents and offer collateral security. Okay. Say you take a car loan of 5 lakh rupees from bank. Now you owe this money to the bank and you will pay EMIs over the years to repay your money. And then this case, the bank is the creditor and you are the debtor. Just a minute. Okay. So bank as a trustee. What do we mean by trustee? If you hand over your valuables or money for a specific purpose, and in this case, the bank as a trustee, meaning to say it will safeguard those valuables and will use only for that purpose. So, when you give 50,000 to the bank to buy shares, the bank buys and the bank buys only a part of it, then you are entitled to the unused amount. And in this case, the bank was your trustee. So, trustee is a person who holds or administers property for the benefit of a third party. In this case, the bank holds your valuables or your money for a specific purpose for the benefit of its customers, right? The trustee are obligated to make decision in the beneficiary's best interest. So, if you have handed over your money, given the specific directions, the bank has to use your money only for those directions, and if bank fails to you know comply with those directions, then the bank will return your money. Bailee bailer relationship. Contract of bailment has been defined under section 148 of the Indian Contract Act. What does it mean? Say if you give your valuables to the bank for safekeeping, in that case the bank becomes a bailee and you are the bailer. The bank must take reasonable care. If the items are lost due to bank's negligence, it must compensate you. Say you deposit, for example, you just deposit your property documents in bank safe custody, and if the bank loses them, then the bank will be liable because the bank is acting as a bailee. So when a customer deposits certain valuables, uh, documents with the bank for their safekeeping, the bank becomes a trustee, also a bailee, and the customer becomes the bailer. So this will be asked in your exam. These relationships uh, will come in case study forms or in statement forms, so be attentive. Agent principal relationship. The bank can act on your behalf to perform tasks like paying your bills, collecting checks, making payments, and in this case, you, the customer, are the principal and bank is your agent. So, principal is a person who delegates authority, and when you delegate a certain authority to the bank, like bank can pay bills on your behalf, bank can collect checks on your behalf. So, in this case, you, the customer, is the principal and bank becomes the agent. Say you instruct your bank to pay your electricity bill, your phone bill for every month, then in that case, bank is acting as your agent. Lessor lessee relationship. So a bank gives locker on rent. In that case, bank is the lessor and you are the lessee, the tenant. Where it has been defined, the term lease, lessor, lessee, it has been defined under section 105 of the Transfer of Property Act. Now, when bank gives safe deposit lockers, the bank becomes the lessor because bank is allowing you to use its property, and for the usage you are paying some rent to the bank. You are paying the premium to the bank. Now bank has certain responsibilities. If there is any loss, theft, or if there's any negligence involved on bank's part, then the bank will be liable. But if there is any loss due to natural disasters or act of God which are beyond bank's control, then the bank will not be liable. So any loss arising due to natural calamity or act of God, for those reasons, bank will not be liable. Bank has uh, bank has to take reasonable care of your belongings which are put in the locker, but for act of God or natural calamities, the bank will not be liable. Bank will be liable if there is any employee fraud or there is any fire incident, any theft, robbery, dacoity. In that case, bank will be liable. And what is the bank's liability? The bank will be liable to pay up to 100 times of the annual locker rent. All right, 100 times of what? The annual locker rent. So you rent a locker for 2000 per year. If the bank's security fail and your jewelry is stolen, the bank must pay 2 lakh rupees if it's at fault. 100 times of your annual locker rent. Indemnifier indemnified. Section 124 of the Indian Contract Act defines the contract of indemnity. Contract of indemnity is nothing but where one party promises the other party that I will save you from the loss if any loss has been caused to you by the conduct of the promisor himself or by the conduct of any third party. So, in this case, the customer is the indemnifier and bank is the indemnified. The customer promises to compensate the bank for any loss if something goes wrong. Usually in special cases, say a customer lose a demand draft and ask the bank to issue a duplicate, then the customer must sign an indemnity form agreeing to repay the bank if someone uses the original draft fraudulently. right? So these were the different kind of relationships which exist between a bank and the customer. So this is a summarized table. It is important for your exam point of view. Do give it a quick read. So when you deposit in the bank, bank becomes debtor, customer becomes creditor, loan, bank becomes creditor, customer becomes debtor, safe custody, bailey bailer relationship exists in locker. When a locker has been given on rent, the bank becomes the lessor, the customer becomes the lessee for collection of check. The bank becomes the agent, the customer becomes the principal. So this summarizes bank customer relationships. Now let's move forward to the different deposit products or services which bank offer. So when you put your money in bank, that's called a deposit. Depending on how long you want to keep it in the type of account, the bank may pay you interest, a return on your money. So there are two different kind of deposits: demand deposits and time deposits. So demand deposits you can withdraw anytime you want. Current account, savings account are the example of demand deposits. Do keep in mind that for current account, bank don't give any kind of interest. The shopkeepers open a current account to pay suppliers. Receive customer payments daily. So this is example of current account. A salary employee saves a portion of salary in savings account and earn interest. The second being time deposits. You put your money for fixed period and get interest. Now, for time deposits, you usually cannot withdraw early without a penalty. Fixed deposits, recurring deposits are the examples of time deposit. In fixed deposit, deposit a lump sum of money and earn regular interest. In recurring deposits, you add money on a regular intervals. You deposit a fixed amount every month and interest is paid on maturity. Now let's move forward to the services which bank provide to its customer and investors. In deposit products, bank provide different deposits to NRIs, which we'll see in our upcoming units. Say NRO, NRE, FCNR. So these are different kind of accounts which a bank provide to non-resident Indians. Services to customer and investors. Number one is merchant banking services. So merchant bankers are companies which help other companies. So merchant bankers help other companies to raise money from the public or private investors. They offer services like they help in initial public offering, they prepare project report, market survey, they do a feasibility study, they take care of getting approvals from SEBI, stock exchanges, they appoint brokers, they help in underwriting services. They appoint registrars, advertisers, marketing. They market the public issues, say roadshow ads, and they help the company to list their shares on exchanges like BSE, NSE. So when say for example when Zomato launches IPO, merchant bankers help with paperwork, advertising, and listing of its shares. So merchant bankers that they facilitate capital transfer from investor to corporation or government. So they provide capital from the person who requires the capital, from person who has excess money to the person who requires the capital. Right? They aids in IPO, FPOs, private placement. They assist in preparing project reports, market survey, obtain regulatory clearances, help in underwriting services, distributing prospectus, applying to stock exchange, and the other services which I stated earlier. Number two, lease financing. Lease financing means giving something on rent. So instead of buying, you rent something. It's as simple as that. The company who uses the asset is known as the lessee. And the company who gives the asset on rent, who actually owns the asset and give it on rent, is the lessor. It has been defined. The lease has been defined under section 105 of the Transfer of Property Act. Say a bakery needs an expensive oven but does not want to buy them. So what the bakery does? Bakery leases them from a company and pay monthly rent. So what are the advantages to the lessee, the user? They don't need to buy the costly machines. The lease payments are business expenses, and um, it does not affect the company's loan or financial position. But at the same time, the lessee never becomes the owner, and the lessee can only use the asset for agreed purpose. Asset can be taken back if terms are broken, and if lessor goes bankrupt, asset may be seized. So these are some of the disadvantages of the lease financing. All right, you have to keep that in mind. Plastic money is nothing but money which you use. Uh, Plastic money means using cards instead of carrying cash. So these include credit cards, debit cards. So let's understand it one by one. Charge card lets you buy now and pay the full amount later. It is similar to credit card, but the only difference being you have to pay the whole amount for a charge card. You cannot just pay your minimum amount due and move forward. No, that is not the case with charge card. You have to pay the full amount. No interest is charged if you pay on time, but late payments attract a late fees. And there's usually no fixed spending limit on charge cards. So American Express charge card is an example of charge card. Credit cards, you can buy things on credit, pay later. Uh, but again, you don't have to pay the bill in full. You have the option of minimum amount and pay the rest in parts. Say HDFC Bank credit card, ICICI Bank credit card, you bought a phone using the card. Now you can convert them into EMIs. You can just pay the minimum amount due, but keep that in mind that if you pay a minimum amount due, then you have to pay interest on the outstanding amount. Debit cards. So debit cards, the money gets directly deducted from your bank account immediately after the purchase. It only lets you spend what you already have. ATM cards. ATM cards are used to withdraw money from ATMs. Now debit cards are also act as ATM cards. Prepaid cards. So you load money in advance and then spend from it. It can be gifted or used by someone else. Amazon gift card loaded with 1000 or a Metro card. So these are examples of prepaid card. Co-branded card, a credit card issued jointly by a bank and a retail company. Say SBI and Indian Oil Corporation card, ICICI and Amazon credit card, Flipkart and Axis card. So these are the examples of co-branded cards. You get special discount reward points at the store, um, but it can also work elsewhere. Electronic payments, you can pay money via smartphones, internet banking, you use payment apps, digital wallets, and cards are also issued in electronic form. Example, Google Pay, Phone Pay, Paytm wallet. So you can pay directly from your phone. Remittance services. Remittance is sending money. The bank now uses fast electronic systems instead of old methods like drafts or mail transfers. Now bank uses NEFT, transfer money in batches within few hours. RTGS, real-time transfers for big amount, 2 lakhs or above. IMPS, instant money transfer, it is available 24 into 7. UPI, money app-based transfer using UPI ID. AEPS, money transfer using your Aadhaar number and fingerprint. And then there's NACH, which used for bulk transactions like money or pension payments. Bank also serves as a distribution point for providing various government services like PPF, NPS, Sukanya Samriddhi, Senior Citizen Scheme, Gold Bond, Jan Dhan Yojana. So these products are offered by the bank under one roof, and for offering these products, bank generally charge commission from the government. So bank help people open account or invest in government savings and pension schemes. Then we have third party products which are sold by the bank like demat accounts to hold share electronically, trading accounts, mutual fund, insurance, life insurance, vehicle insurance. They are sold by tie-ups. Safe custody and trusteeship service. Bank provides secure service to keep valuable safe and handle funds responsibly. For example, safe custody, keep property papers or jewelry at bank. Safe deposit locker, rent a locker for valuables. Escrow account, when it is used when money is kept in trust until certain conditions are met, like in property deals. And then there's trusteeship or executorship. The bank can manage your money or will as a trusted representative. So without further ado, let's start our video. So what is money laundering? In simple sense, it is to make dirty money look clean. What do we understand by dirty money? The money which origins from illegal activities. So money laundering is nothing but hiding the origin of illegal money and making it legal. For example, a drug dealer earns money through illegal drug sales. Now, he does not want anyone to know it's illegal. So, he deposits the money into a bank in small amounts or invest in a property to make it look like he earned it legally. So, as the name suggests, money laundering is you are laundering the money to make it clean. So, to make dirty money look clean. You may come across with certain terms like terrorist financing as well. So let's understand it. Terrorist financing means raising and using money to support terrorist activities. Examples, someone donates money to a charity that secretly supports a terrorist group. Now, this charity looks legal, but it's just a cover. It is terrorist financing. And money laundering and terrorist financing, financial crimes, they are somewhat connected. All three are often done by the same people or groups and use the same tricks like fake identities, multiple accounts, secret transfers, so on and so forth. Now, who will fight this money laundering and terrorist financing globally? So there's an organization known as FATF. This is an organization which gives rules to countries on how to stop money laundering and terrorist financing. Now, these rules issued by FATF were known as FATF standards and 2012. Now, let's understand about the stages of money laundering. Uh, in the offense of money laundering, generally there are three stages involved. Number one, placement. Number two, layering, and number three, integration. In placement, a criminal puts illegal cash into the financial system. For example, he deposits small amount of illegal cash into bank account. So he's what he's doing, he's placing his dirty money, his illegally gained money into the system. Now, in next step, what he does, he moves the money through many transactions to hide its source. He transfer the funds between multiple accounts to create a web, to create a layer in order to hide the origin of the money. And third, integration. He uses the money legally. He buys a shop, he invests in real estate with the laundered money. So what he does, he introduce that illegal money into the system, making it look like it's clean money. All right, let's move on to stage of financing of terrorism. Now there are four stages involved in terrorist financing. Number one, raising. Uh, when we say the term raising, we generally speaking about the collection of funds from supporters or illegal businesses. For example, there were fake donation campaigns or smuggling, so on and so forth. Number two, moving. In moving stage, the funds are transferred to the terrorist group using hawala or wire transfer. Once they are moved, they are stored into some foreign bank accounts, and generally there is a cooling off period. Money is stored into the accounts and it remains there for some time. After the cooling off period, the money is used on terrorist operations, used for terrorist operations on terrorist acts like buying weapons or funding training camps. Now we need to stop this money laundering. We need to stop this terrorist financing of terrorism. So we introduce Prevention of Money Laundering Act. So what are the objectives of anti-money laundering? You are against money laundering. You want to prevent it. So number one, you stop criminals from using banks, you protect society from criminals, you keep the economy safe, and you block terrorists from getting funds. So these are the core objectives of anti-money laundering. You stop the criminals, you protect the society, you keep the economy safe, and you block terrorists from getting funds. Now let's talk about India's anti-money laundering system. India passed a law called Prevention of Money Laundering Act in 2002, PMLA 2002. So this act was enacted in the year 2002. These in anti-money laundering system in India are FIU India, Financial Intelligence Unit. It collects and analyzes suspicious financial data. Then we have ED, Enforcement Directorate. It investigates and arrests money launderers. We have special courts to deal with money laundering cases, and the special court can freeze or take away illegal property. Then we have regulators. These regulators like SEBI, RBI, they issue rules for banks and businesses to follow. Now, what is the offense of money laundering? It has been defined under Section 3 of the Money Prevention of Money Laundering Act. It simply states that if anyone tries to use money for a crime, if someone helps uh, someone else to do it, or pretends that illegal money is legal money, he or she has committed the offense of money laundering, and they will be guilty of the offense of money laundering. Section 4 of the Prevention of Money Laundering Act provides for the punishment. It states that if anyone commits the offense of money laundering, then he or she shall be imprisoned for a minimum period of 3 years, which can goes up to 7 years. And if the act is drug related, if it is connected with NDPS Act, then this maximum imprisonment can go up to 10 years. And this offense of money laundering is non-bailable and cognizable offense. Keep that in mind. Money laundering risk perception. So criminals exploit the financial products. Uh, what increases the risk of money laundering, uh, terrorist financing, is that there are unknown or suspicious customers. Then there are certain products like wire transfer, prepaid cards. It makes life easier to wire transfer, but again the criminals use it for the uh, destruction purposes, to harm the economy, to harm the harmony of the countries. Then there are transactions linked to risky countries, then there are high value or unusual transactions, location of the bank or its customer. So these factors increases the risk. So risk mainly depend on the type of customer, nature of the service or the product, transaction, where the branch or the bank has been located, what is the value, what is the type of transaction. So risk generally depends on these things. So a criminal opens a bank account using a fake identity, and if he sends money overseas frequently without business reason, then this is a red flag. Bank need to keep a check on it. Now, how does banks reduce this money laundering or terrorist financing risk? So they do follow KYC norms. By KYC, we mean know your customer. You understand your customer identity. You understand your customer's income sources. Then you monitor transactions. If any transaction looks suspicious, you report it. And report it to whom? FIU, Financial Intelligence Unit, the one we have just discussed before. Financial Intelligence Unit. Then you train your staff on these anti-money laundering procedures. You teach them how to spot and how to handle these money laundering and terrorist financing risks, and you comply with all the legal and regulatory norms. So bank adhere to all the relevant laws and regulations to prevent the risk of money laundering. KYC policy. KYC simply means you verify who your customer is. It helps banks make sure that they are dealing with real legal people and not criminals. KYC prevents misuse of the banking system for money laundering or terrorist financing. So now you understand what is KYC. Now, introduction system was the old practice. So before KYC rules, before 2002, bank used to open a new customer's account only if someone introduced them, like an existing customer or a staff member who knew them well. It gave the bank some protection under law, Negotiable Instrument Act, in case of fraud. But now this practice has stopped. RBI's 2002 guidelines say no need for introduction, only proper KYC verification is required. Right? So who is a customer? Now this question arises. You need to know your customer, but again, who is a customer? We have already discussed it under uh, in unit 1, if you recall, that a customer is anyone who uses any financial services, even just once. Then also he or she is a customer, and it also includes beneficial owners. Beneficial owners meaning to say people acting on behalf of someone. Uh, then they are also included. Now, who are considered as customer? Just an examples are people with bank accounts, FD, loans, credit card, anyone doing remittances using the bank account, people having DMAT, PPF, pension fund accounts, users of insurance, mutual fund, locker, safe custody, and beneficial owners. Are real owners behind a business and clients of intermediaries like brokers or lawyers. They all are considered customers. And every bank must have KYC policy. KYC policy is a rule book for customer checking and monitoring. KYC policy includes four core elements. Number one, customer acceptance policy. It decides whom to allow as customer and under what conditions. For example, you don't open accounts for fake names or suspicious backgrounds. Number two, customer identification procedure. You verify the person's identity and address using valid documents. So Aadhaar card, passport, voter ID. So you uses these documents for identification purposes. Number three, risk management. You classify customer as low, medium, or high risk. For example, a salaried person is a low risk. A large cash dealer is a high risk. So politically exposed person is a high risk. Monitoring of transactions. You regularly check for suspicious transactions. For example, a sudden deposit of 1 crore rupees in a student's account, though this seems suspicious, right? So this is a suspicious transaction. You monitor these kind of transactions. Now let's move on to organizational setup for anti-money laundering. Bank must have special officers to ensure anti-money laundering laws are followed. And in hierarchy, we have a designated director. Designated director is a senior person, a managing director, trustee, partner, and he is responsible for the overall compliance with money laundering laws. So, if a question comes like who is responsible for full compliance with money laundering laws, it is designated director. Then we have principal officers. Apart from complying with overall money laundering laws, designated director has some key duties like keep the policies updated, ensure staff is well trained, adjust system with changing risk patterns, set up proper system and teams for KYC or anti-money laundering. Principal officer is also known as money laundering reporting officer, right? And principal officer ensures that KYC or AML policies are followed. Suspicious transactions are reported to FIU India. Um, this is the duty of principal officer who reports these suspicious transactions. It is the principal officer. Then regular reports are sent to management, coordination with law enforcement. These are the duties of principal officer. Number third, AML team. A team is created in each bank for updating the KYC policy, for helping departments with customer verification, for assessing risk, monitoring customer transactions, and for sending reports to FIU IND whenever needed. So these are some of the duties of AML compliance team. Obligation under Prevention of Money Laundering Act. Now, a bank has certain obligations, like bank has to verify identity of customer and beneficial owner. For this purpose, bank uses Aadhaar card, passport, or other official documents. Banks are required to keep a record of all transactions for a period of 5 years, and all the identity proof and documents for 5 years after account is closed. Okay, so 5 years after the end of relationship or account closure, these documents have to be maintained. The identity documents have to be maintained. Bank have to keep all the information confidential, maintain a strict secrecy of all data collected. uh, Bank must, before any high value transaction, bank must verify the identity, check sources of fraud. Bank should record the purpose. For example, a 20 lakh foreign remittance must be checked thoroughly, right? Then bank should refuse transactions if verification is not possible, and bank should report transactions and monitor them closely. Risk management, risk management measures. So risk based approach, you start with risk based approach. A bank must use a risk based approach to deal with financial crimes like money laundering or terrorism financing. This means they should assess how risky a customer or transaction is and apply stronger checks for riskier ones. Bank need to have board approved policies, internal controls, monitoring system that can adapt if needed. Let's take example, a salaried employee depositing 50,000 monthly for a known source. So it will be classified under low risk. So in risk based approach, bank will classify these kind of customers as low risk, and a businessman depositing 10 lakhs in cash from unknown sources. Now this is high risk and this needs closer scrutiny. Risk assessment, bank must assess the overall risk exposure. This include evaluating who their customers are, what products, services they use, which countries or regions they deal in, and how customer carry out transactions online, in person, cash heavy. And it should be proportional, meaning big banks with international operation must do deeper assessments. A bank operating in both in India and high risk country must assess risk from that country and implement special controls. Then we classify our customers into three categories: low, medium, and high. Low, medium, and high. How do we classify them? We classify them on based on various factors like type of business they are in, the location, mode of payment, source of fund, financial and their social status. Then we have politically exposed persons. Politically exposed persons are the ones who are in public, like ministers, senior bureaucrats, relatives of such person, and they are seen as high risk customers. Uh, let's understand it with one example. A government school teacher with predictable salary transactions. Now, in which category will you categorize them? You will categorize them in low risk category. A petrol pump owner who's operating large cash inflow goes into medium risk. A real estate developer operating in multiple countries with heavy cash flow. Now, this is high risk. And bank must review the risk category of each customer at least every 6 months, and immediately if a new information or suspicious behavior is detected. Risk management is not the job of frontline staff. Other departments like internal audit and compliance play a crucial role. They independently check whether staff are following KYC norms and anti-money laundering rules. These audits are reviewed by audit committee of board every quarter. Keep that in mind. So these reports are reviewed, these audits are reviewed quarterly. For example, if a bank branch fails to verify ID documents properly, the internal audit team will report this and the branch could face penalties or corrective orders. Now, new banking services like mobile banking, UPI, net banking, e-wallet, they bring convenience, but they also bring new risks. Criminals may misuse these channels to move illegal money, so bank must apply KYC AML checks before launching these new tech products. So, for before allowing customers to transfer money through a mobile wallet, the bank should ensure their identity is fully verified using Aadhaar or PAN card. Now you have to train your staff, since bank staff have access to sensitive system and customer data. They must properly verify uh, during recruitment. So you train them regularly on risk related to money laundering and terrorism financing. Bank must also screen third party agents like loan recovery agent, DSAs, business correspondents. So before hiring a recovery agent, the bank checks police record, PAN and references. Also, staffs are trained to detect fake documents and suspicious transactions. Now let's talk about obligations under international law. So banks are not allowed to open or operate account for people or entities which are listed by UNSC, United Nations Security Council, as linked to terrorism. So these lists include Al Qaeda sanction list and 1988 sanction list. 1988 sanction list is Taliban related. Al Qaeda list, you can understand it is linked with Al Qaeda. So if a customer matches the name on the list, bank must notify FIUIND and Ministry of Home Affairs, and the assets must be frozen as per the government official orders. Uh, let's now discuss FATF, Identified Jurisdiction Financial Action Task Force. So this FATF identifies countries that don't follow proper AML CFT guidelines. Bank must take extra care while dealing with such countries. What banks must do? They should carefully check transactions involving those countries and document everything and be ready to explain the reason for the transaction to RBI or other authorities. Let's take an example. If a customer wants to transfer funds to a high risk country like Iran or Syria, the bank must investigate why, who is receiving it, and keep all related documents. Correspondent banks. So when one bank, say in India, works with another bank, say in UK, to provide services like fund transfer, so this is called correspondent banking. These relationships carry international risk. Hence, bank must have policies on how to form such relationships, verify the correspondent bank's background and compliance strength, and then never deal with shell banks, fake banks without physical presence. The correspondent bank holds deposit and provides services on behalf of another bank called the respondent. Bank should take all the precautions before partnering with such correspondent banks. So when Indian bank partners with foreign bank, Indian bank needs to check whether that bank follows FATF standards, who their customers are, and in which jurisdictions these banks are operating under. Reporting under FATCA CRS. So under FATCA, it is US law. CRS is global standard. Bank must identify customer who are in FATF. It is the banks must identify customer who are US taxpayers or tax residents of other countries, and they report their accounts to authorities who will check globally. So FATF is a US law. CRS is common reporting standards. If an American living in India opens an account, the bank must report this to Indian tax authorities who will inform the US tax departments. Reporting obligation to FIUIND, the bank must submit following reports, these four following reports. Number one, cash transaction report, also known as CTR, where cash transaction or withdrawal is equivalent to 10 lakhs or more in one go or multiple smaller groups. Number two, cross border wire transfer. Cross border is international wire transfer. So whenever a person sends money internationally, we call it a cross border transaction. So if the transfer is 5 lakhs or more, then these reports are to be sent. NGOs receiving more than 10 lakhs, and counterfeit currency report for all counterfeit currency notes. These four reports must be sent to FIUIND by 15th of every month. Suspicious transaction report. It must be reported within 7 days of spotting any suspicious activity. Even non-cash, completed or locker misuse activities can be reported. Does not um, have to be monetary. So even non-monetary or attempted transactions are to be reported. For example, a customer refuses to share source of fund, deposits large cash regularly, and avoids giving documents, then the bank must file suspicious transaction report. If a bank fails to follow these rules, then um, it may face warning from FIU or RBI. Action orders can be taken, corrective action orders, or penalties can be imposed for violations ranging from 10,000 to 1 lakh per violation. So if a bank delays STR filing by 5 days, it may fine a minimum of 50,000 rupees. Then we have secrecy obligation. Bank must keep customer information confidential. They cannot use it for any marketing purpose or give it to outsiders unless it is allowed by the customer or required laws. Again, there are certain exceptions. So there are 4 exceptions. If the law requires it, the bank can share the data. If it is in public interest, say for preventing the fraud, if it protects the bank itself, or if customer gives consent, whether verbal or written, then bank can share their data. So without further ado, let's begin our session. So PMLA and PMLR, the Prevention of Money Laundering Act, Prevention of Money Laundering rules. So these are the rules that helps to stop money laundering, that is turning black money into white. We have discussed it in detail in our unit number 2. All financial institutions like banks, NBFCs, they must follow these rules. The RBI in this direction has issued detailed rules called KYC Directions 2016 to guide banks and financial institutions on what to do. Now, what if a bank has branches outside India? For this particular scenario, RBI rules states that every branches outside India must follow these rules if local laws allow. Now, if there is a difference between RBI rules and the foreign country's rule, then the branch must follow the stricter rule. For example, if RBI says that PAN card has to be obtained and the foreign country say there is no need to obtain the PAN card, then the bank should obtain the PAN card. So, the bank has to follow the stricter regulation, right? What is KYC and KYC norms? So KYC means a bank must know who the customer is, what they do, and why they are opening the account. We'll begin with customer acceptance policy. So these are the rules whether to accept or reject a customer. And bank must not open an account when the name is fake, like Mr. X or someone else name, like in Benami. So if it's anonymous or it's a Benami name, then in that case, bank should not open the account. If the person is not cooperating or he or she is giving fake documents, if the person refuses to follow due procedure, if the person is trying to act for someone else without a clear legal reason, if the person name is in RBI's blacklist or sanction list, I hope you recall sanction list from unit number 2. If the PAN card is not verifiable, if the person gives e-documents without valid digital signatures, and if the person does not give the required information for KYC, in that case the bank must not open an account. And what if it's a joint account? In that particular scenario, KYC is needed for all the holders. And it is important that even poor or socially weak people should not be denied an account just because they don't have all the documents, and we'll see it in the later part of this unit. Also, if an existing customer fails to follow KYC rules, the bank can close the account after giving him a proper notice. Now, let's talk about customer identification procedure. It is to identify who the customer really is. For example, I say I'm Mr. X. Oh, is it really I'm Mr. X, or I'm pretending to be someone else? Now, when this should be done, when the customer identification procedure should be done by the banks. So, when opening a new account, if a non-customer is sending money abroad using your bank, using your bank, so he's remitting the money abroad. If there's a doubt about an existing customer's identity when selling any financial product worth more than 50,000, or if a customer walks in and does a transaction of over 50,000, or if the customer is trying to split big transactions into small ones to avoid limits, more particularly known as structuring. For example, say I walk in to the bank and I come thrice a day and deposit 49,000 each time. So what am I doing in this particular scenario? I'm structuring my transactions that they don't exceed 50,000 in order to avoid KYC, and this looks suspicious. So the bank should take proper precautions in this scenario. Also, if another agent or third party is doing KYC on behalf of bank, the bank is still responsible for the errors. Now let's talk about customer due diligence. So what is customer due diligence? So dear bankers, this goes one step deeper than identification. Is not just who are you. You are asking where do you live, what work do you do, how will you use this particular bank account, what services will you avail, and depending on the risk level, the information is gathered. So whether the customer is low risk, medium risk, or high risk, as discussed in unit 2, we gather more information like income source, business type, location, expected transaction background, so on and so forth. Let's talk about individuals, KYC for individuals who need to submit KYC documents. So people who are opening account, beneficial owners, authorized signatories, and power of attorney holders, they are required to submit KYC documents. And what documents are needed? So official valid documents are required. There are 6 official valid documents, 6 OVDs. Let me erase and write it again. So there are 6 OVDs. What are they? It's important for you to know these OVDs. So number 1, Aadhaar number. So Aadhaar card is officially valid document. Number 2, passport. Number 3, driving license. 4, voter ID. 5th is Narega job card signed by government official, and 6th is NPR letter with name and the address. So a question might come in your exam asking whether PAN is an OVD or not. So PAN is not an officially valid document. And if Aadhaar or OVD is not provided, then we are required as a bank to obtain certified photocopy of original documents, recent photograph if it's not an e-document, PAN card of form number 60, and other documents as needed. Now a question might come into your mind about so what about NRIs or PIOs? So for non-resident Indians or person of Indian origin, the document must be certified by Indian Embassy, Indian Consulate, overseas branches of Indian banks, notary public, judges, or magistrate. And what if the address is not updated? So in that scenario, you can temporarily give a customer can temporarily give proof of address. So utility bills can be given as proof of address, and it has to make sure that they are not older than 2 months. Property tax receipt, pension orders with address, or employer's accommodation letter, or leave and license agreement can be provided. But one thing has to be kept in mind that within 3 months, you must give a document that shows updated permanent address. When I say you, it means the customer. So within 3 months, the customer must give a document that shows updated permanent address. And what about name change? Name can be changed after marriage or for any other reason. So we need to obtain old OVD, officially valid document, plus marriage certificate or gazetted notification to prove name change. Now let's talk about rules for using Aadhaar for KYC. So consent is a must. Aadhaar can only be used if the customer gives you prior written permission. Say I go to a bank account, open an account, the bank can use my Aadhaar details only when I give my consent. Masking of Aadhaar, bank must store only the last 4 digits of Aadhaar. The rest should be hidden or covered. Say my Aadhaar number is 123456789101. So this is my Aadhaar number. So a bank can only store this number, the last 4 digits, and the rest will be masked. So this much information will be stored by the bank. And if someone wants to get subsidy or benefit from a government scheme, they must do biometric Aadhaar verification. If it's not possible due to illness or injury, Aadhaar can be verified online, offline, or another valid document can be submitted. The official's name who approved this must be recorded. If a person chooses to use Aadhaar for identification, bank can use either eKYC or offline Aadhaar verification, and only financial institution authorized by UIDAI can do eKYC. Keep that in mind. What if there are different there is a different current address? So if the customer presents address that is different from Aadhaar, a self declaration is required. Say Aadhaar has a Delhi address, but you live in Mumbai now, so you can give a signed statement with your current Mumbai address. OTP based eKYC, this is basically non face to face customers using OTP based Aadhaar eKYC. When Aadhaar eKYC is done using OTP, the bank account is opened without meeting the customer in person, and hence there are some limits for non face to face accounts. Number one, there is a balance limit, so you cannot keep more than 1 lakh in total across all such accounts. If it exceeds, the account will freeze until you submit a proper ID proof. And number two, credit limit. Total money received in a year cannot be more than 2 lakhs. Number three, loan limit. Only small term loans allowed, so it is up to 60,000. Time limit for these accounts is for 1 year. So within this time, proper KYC must be completed. If not, deposit account will be closed and no further loan money will be disbursed. And there is a one account rule. Customer must declare they don't and won't open another account using the same OTP based Aadhaar method elsewhere. Now let's talk about some different entities now. So KYC for sole proprietorship firm. First, verify the identity of the individual proprietor in a similar fashion which we use for an individual. Then you are required to take any two of these documents. So our sole proprietorship firm can submit any two documents from this list. So it can be registration certificate, GST certificate, so municipal license, municipal trade license, import exporter code, income tax return, professional license, full income tax return, not just acknowledgement, utility bill like electricity, water, phone bill. And what if two documents are not available? In that case, bank can accept just one, but must verify on field that the businesses really exist at the given address. And for company, the documents needed are certificate of incorporation, PAN card, memorandum of association, article of association, board resolution authorizing someone to operate, KYC of people authorized to act like managers. For partnership firm, if it is registered, then you require registration certificate, partnership deed, PAN card, and KYC of partners and authorized persons. For trust, we require trust deed, registration certificate, PAN, or alternatively form number 60, and KYC of trustee and beneficiaries. For unregistered associations, we require resolution of managing body, PAN form number 60, power of attorney, KYC of members, and proof of legal existence. For other legal entities like universities or panchayats, we require the name and authority letter for representatives. We need KYC of person transacting and proof of legal existence. Now let's understand who is a beneficial owner. We have also discussed in it unit number 1 and 2, if you can, if you are able to recall. So a beneficial owner, dear, is nothing but the real person who enjoys the benefit or control, even if the account is in someone else's name. So beneficial owner is basically a person controlling or benefiting from an entity. How will you identify beneficial owners? In case of company, if a person has more than 25% of share or he or she controls company's management, then he or she is a beneficial owner. And for partnership, trust and association, if anyone is holding more than 15% or more shares or interest, or anyone controls decision, then he or she is a beneficial owner. Now, what if no one meets the criteria? Then in that scenario, the person in senior management is treated as the beneficial owner. Now let's talk about enhanced due diligence. EDD means you are doing extra checks when there's higher risk in opening or operating a bank account. So for non-face-to-face customers which you have not met in person, if the bank does not meet the customer face-to-face during KYC process, extra care has to be done. It must be taken. So the first payment must come from a KYC compliant account the customer already has with another regulated financial institution. For example, if Raj opens an account online from Delhi, he never visits the bank branch. His first deposit must come from his account, which is already KYC verified. For politically exposed person, so these are the person holding important uh, political or government roles. They are considered as high risk customers. So only senior officials in the bank can approve such accounts. Bank must check online or public information are available about these persons. Bank must ask about the source of money, and same checks apply if a PEP owns a company even indirectly. So same checks and balances are applicable. So if someone in India wants to open an account and say his uncle is a former foreign minister of another country, then the bank will treat this as a high risk case. For accounts opened by professional intermediaries, these are accounts opened by professionals on behalf of client. There are certain rules which need to be followed. For single client, bank must identify the client. If there are separate sub accounts, each client identity must be known. For pool account, identify beneficial owners. If funds are commingled, they can be allowed like mutual funds. If intermediaries who can't share client details, say that the client details are confidential and that's why we are not able to share the details of my client, then the account will not be opened. These kind of accounts will not be entertained. If money is mixed in one account, you try to identify the real owner, and if the intermediary is regulated and trustworthy, the bank can rely on their KYC, but the final responsibility again falls on the shoulder of the banks. Now, we have seen enhanced due diligence. Let's also talk about simplified due diligence. So these are the relaxed rules for certain types of low risk accounts. Number one, self-help groups. Savings account. In savings account, you do not need to do KYC of all the members. Customer due diligence of only office bearers is applicable, but for loan accounts, KYC has to be obtained for all the members. Say there is a self-help group of 10 people, they open a savings account and only two are office bearers. So only two office bearers documents are required. For foreign students, we are required to open an NRO account. They need to give us their passport, visa, photograph, and college admission letter. Within 30 days, uh, we are required to obtain the local Indian address and it must be verified. We can receive foreign money up to 1000 US dollar or 50,000 rupees till the local address is confirmed, and for Pakistani students, prior RBI approval is required. Sorry. For foreign portfolio investors, If they are registered with SEBI, bank can open accounts with specified documents. They must comply with FATCA or CRS tax rules, and an undertaking is required that exempt documents will be submitted if required. Small accounts for people who do not have official valid documents. Say there is a marginal labor and he does not possesses any official valid document. So will he be deprived of opening a bank account? So answer is no. For these people, we can open small account. So these are basic accounts opened using just photograph and a declaration, and they must be signed in front of bank officer. But again, there are some limits, there are certain restrictions. uh, Credit, annual credit should not exceed 1 lakh rupees. Withdrawal in a month can go up to 10,000, not more than that. And balance is permitted to be maintained maximum up to rupees 50,000, and there is no foreign remittances allowed. Now, the customer must submit valid ID within 12 months, else account may be frozen. For example, a migrant worker without any ID opens a small savings account. He provides a photograph and signs in front of bank officer. So he can only deposit up to 1 lakh rupees till he gives his Aadhaar or any other official valid document. Customer level KYC and monitoring. Each customer should have only one identity in the bank. So a unique customer identification code is given to track all the loans, uh, all the accounts or credit cards, etc. So this UCIC helps prevent money laundering and makes KYC easier. Walk-in customers like those buying gift card may not need UCIC unless they do frequent transactions. Say if Priya has a savings account and later takes a loan, the bank should link both the accounts to same unique customer identification code. UCIC is optional unless they come often for walk-in customers. Periodic KYC updation. Customer info changes over time. Say there's a job change, customer move to a new address, so bank must update KYC periodically. Frequency depends on the risk of the customer. For low frequency, KYC needs to be done in 10 years. For medium, it is 8 years, and for high risk, it is only 2 years. So every 2 years, you are required to do periodic KYC updation for high risk customer, 8 for medium risk, and 10 for low risk. For individual, if there is no change, then just a self declaration is required. If they change an address, then take self declaration and verify the address. And if a minor turns major, you are required to take fresh photograph and verify KYC documents again. And for businesses, if there is no change, you get a letter and board resolution confirming that there are no changes. And if there is any change, then fresh KYC is required as if it's a new customer. There are some other rules. You need to replace expired documents. You need to revalidate PAN details. You give acknowledgement receipt to customers, make KYC updates available at any branch, and use risk-based approach. Higher the risk, more frequent the checks, and you avoid unnecessary harassment of the customer. PAN and Form 60 requirement for existing customer. If the customer has not given PAN or Form 60, bank must get it by government specified date. If not, account operations may stop temporarily after warning. No withdrawals will be allowed, and deposits also stopped for savings account. Uh, Say Raj has not given his PAN, the bank gives a deadline. If he misses it, the account is frozen temporarily. Now, what is customer due diligence? And then we'll move on to alternate methods. So, what is CDD? Customer due diligence means verifying who the customer is to prevent fraud, money laundering, and illegal activities. So, what are why alternate modes are required? So, bank have to do CDD for every customer, but sometimes there are too many customers, and some customer lives in faraway or rural areas. So to make things easier, RBI allows bank to use alternate methods like CDD by third party, video based customer verification, digital KYC, eKYC using Aadhaar, and let's talk about uh, each of them. Number one, CDD by third party. Basically, you are taking the help from third party, so bank can rely on another trusted entity, like another regulated entity or financial institution, to do CDD on its behalf. But again, there are some conditions attached to it. Banks must get the CDD info within 2 days from the third party. If bank asks for document later, the third party should give them quickly. And the third party must be regulated, must follow proper CDD rules, and they should not be located in a high risk country. Obviously, the final responsibility lies with whom? It lies with bank, uh, using the customer. So say bank A opens a new account for a customer by using already collected information by bank B. So provided bank B is trusted and share those documents promptly. But in this scenario, the responsibility lies with bank A. Number two, video based customer identification. Banks can now verify customer identity by doing a video call instead of asking the customer to come to the branch. It is used mainly for opening a new account, updating KYC if the KYC is outdated, and converting accounts opened without face-to-face KYC. Again, some infrastructure is required, like bank must use its own secured systems and networks. Bank data and video should be encrypted, and it is stored in India. Our video should include geolocation, GPS, and time stamping. Face detection and matching technology should be available, and there's no video call from outside India. Now, how does this work? A bank official takes you to video call. You meaning to say the customer. Bank official asks the questions in different order each time to avoid fraud. Customer shows the OBD, the Aadhaar card, the PAN, and answers certain questions. If someone is coaching the customer in background, the process will be rejected. But the bank may use officials or banking correspondents to help the customer. Say a customer lives in a remote area, so instead of traveling to a branch which might be, let's say, 50 or 100 kilometers away from his village, the customer can complete the KYC through a secure video call with a bank official by showing the Aadhaar and answering a few questions. Digital KYC. This is a digital method, but the bank official still meets the customer in person, either at the branch or at the home. So, bank develops an app to be used by its staff or business correspondents. The official logs in securely, takes a live photo of the customer with a white background, and takes the photo of the customer's original Aadhaar card, passport, or other OVDs. Now, the photos must be watermarked. The time, location, official name, employee code should be watermarked on the photos. OTP sent to the customer mobile to confirm the details. Officer verifies the customer. Officer verifies that the photograph matches. Photograph the customer matches with the ID proof, and all form fields are correctly filled. Number four, eKYC. Banks can also use Aadhaar based online verification by signing an agreement with UIDAI. There are certain steps that bank officers enter your Aadhaar number into system. The customer gives fingerprint or iris scan. Bank sends encrypted request to UIDAI. UIDAI checks the biometrics of the customer, and if there is a match, UIDAI sends the name, date of birth, address, gender, phone number, etc. to the bank. Now let's talk about wire transfer. Wire transfer is nothing but sending money electronically. So wire transfer means sending money electronically from one person to another. It can be done domestically, or it can be international or cross border. It's fast and convenient, but also it is risky. It's not only fast and convenient for you, but also the criminals. So it can be misused for money laundering, terrorist financing, or any other kind of financial crime. And to reduce this risk, bank must follow certain rules. Let's talk about cross border transfer first. A cross border transfer must include clear details of the sender, who's also known as originator. So originator is nothing but the sender of the money. So the name, the address, the account number, or unique ID must be obtained. It is not required if both remitter and beneficiaries are banks. For example, if Mr. A is in India and he sends $5,000 to his brother in US, then Mr. A's name, address, and account number must go along with the transfer. Now, for domestic transfers, for transaction of 50,000 or above, senders full information is required. Say if someone transfers 75,000 via NEFT, the bank must record full sender's detail. If someone is breaking uh, up to avoid the rule, say two transfers of 49,000 each to avoid monitoring. So this is called structuring. So the bank should identify such behavior and person is uncooperative. The bank should file an STR, suspicious transaction report to FIUIND. The sending bank must keep sender's information for 5 years. If there is any intermediary bank involved, so if there is any bank in middle of the transaction chain, it must keep all the senders information, it forward to the next bank, and if not possible for domestic, still stores information for 5 years. And then there is a receiver's bank. If sender's information is missing, the receiver bank must ask the report. The receiver a bank must ask for the information from the sender bank, and if it is not provided, it report a suspicious transaction report to FIUIND. And if they don't get any help, they may end business ties with the sending bank. Let's talk about other rules. So issue and payment of demand draft first. If someone wants a DD, NEFT, IMPS of 50,000 more, so payment must be done from their account, no cash transactions. Alright, so no cash transaction will be entertained. The bank must print the buyer's name on the DD or pay order. Check validity. Up earlier it used to be 6 months, but now the present validity is 3 months only. So check draft must be presented within 3 months. Account pay check must be deposited only in pays account. There is an exception though. Cooperative credit societies can deposit up to 50,000 in accounts of their members. Money mules are innocent people's account, you can say. They may or may not know what they are doing. Criminals may lure them in the name of say criminals advertise that if you want to earn extra money, you can contact us. You will earn say 1,000 per transaction done by your account. So criminals use other accounts with or without their knowledge to move illegal money. So this other person account, so this other person is known as money mule. So these people are known as money mule. For example, say there is a student. Okay, my student does not have a horn, so let's remove this horn. Okay, so there's a student and is he is offered a job online and is asked to receive money in his bank account and send it somewhere else. So this is the job that will send you the money and you forward this money to another account. So this particular student is acting as money mule, whether he knows it or he is he is aware about it or not. This person, the student, is acting as a money mule. Now, to prevent this, the bank must follow strict KYC norm, should track suspicious activities, and RBI says that using mule accounts means there is a KYC failure by the bank. As per tax rules, PAN must be collected and verified for certain banking transaction. If PAN is not available, obtain form number 60. Excuse me. Selling third party products. If the bank is selling products of other companies, then the bank must verify the identity of walk-in customer for 50,000 more. It keeps proper transaction records. Use AML software to generate alerts. Allow 50,000 and above transaction only through bank accounts or check after PAN verification. And banks also provide at-par check facilities to cooperative banks. Now, bank must monitor this facility quite efficiently. Cooperative banks can issue such checks only to themselves, their KYC compliant customers, or walk-in customers for amount below 50,000 in cash. The cooperative banks must maintain proper records, a sufficient balance with the main bank, and all at-par checks must be account pay only. Central KYC record registry, quite important from your exam point of view. Central KYC record registry is like a central storage system for your KYC. Documents like your ID proof, address proof, think of it as a digital locker where KYC details are safely kept so that you don't need to submit them again and again to every bank or financial institution. Now, CKYC is managed as Central KYC Record Registry. It is managed by CERC, Central Registry of Securitization, Asset Reconstruction and Security Interest of India. So it is mandated by managed by CERC, which is appointed by the Government of India. Now, how does it work? So when the customer opens a new bank account, the bank collects the customer KYC documents. The bank then uploads these documents to Central KYC Record Registry. Central KYC Record Registry assigns a unique number called KYC identifier. Uh, when the customer goes to bank B, now the customer has given the records to bank A, and the customer now goes to bank B to open another account. So he can just give his KYC identifier now and give the permission to the bank to download the KYC from Central KYC record registry. He does not need to submit all KYC documents again and again. And for individual, KYC data must be uploaded if the account was opened on or after January 1st, 2017, and for companies or legal entities, data upload applies if the account was opened on or after April 1, 2021. For old accounts, data is uploaded during periodic KYC updates, and this upload should be done within 10 days of opening the account. Now let's move on to monitoring of transactions. The bank must ensure that their services are not misused for criminal activities like money laundering. So they are required to report such activities to FIU IND, Financial Intelligence Unit IND, and who does it? Principal officer does this, as discussed under unit number 2. Now what do bank look for? So bank pays special attention to unusual transactions, transactions that don't make any sense. Say there's a student account. This student account suddenly received 25 lakhs. Now, how is it possible? Does it make sense? No. So banks pay special attention to these kind of transaction. If there is any complex or suspicious pattern, so there's round tripping of funds, frequent third party transfers. So bank do keep a check on these kind of transactions. And who is responsible for reporting? Principal officers at the bank makes the final decision of whether to report a transaction as suspicious or not. He is helped by a team of AML analysts who help to investigate the transaction. Even bank staff or audit teams can flag these doubtful transactions. What is a suspicious transaction? A suspicious transaction is one that might involve black money or illegal fund. It seems too complicated without reason, has no genuine financial purpose, or could be linked to terrorism financing. Say repeated small cash transaction just under 50,000 to avoid scrutiny. Now this is a suspicious transaction. Last topic for this unit, record management. So what record must banks maintain? So transaction record for at least 5 years from date of transaction. Customer ID and address documents for 5 years after the account is closed. Records must include the nature of transaction, amount, currency involved, date of transaction, who was involved, the sender and the receiver. Why is it important? It helps investigation by enforcement agencies. It allows the bank to reconstruct any transaction if required. Uh, how the record has to be kept in digital form or paper form, but it must be easy to retrieve when needed by authorities. So I hope unit number 3 is clear to you now. So without further ado, let's start our video. Now, as a banker, you deal with various types of customers like individuals, companies, partnership firms, and cooperative societies. Each type of customer is governed by different rules and laws. For example, while dealing with individuals, Indian Contract Act come into picture while dealing with partnership firm, Partnership Act, LLP Act, Companies Act, so on and so forth. So when a bank opens an account, it must follow the law applicable to that specific customer type. What is an account opening form? When a person wants to open an account, they fill out an account opening form. This form collects basic details like name, address, how the account will be operated, customer's declaration. Think of it like a contract between the bank and the customer. And KYC, we have already learned about KYC. Bank must follow KYC rules. They take ID proof, address proof, and other documents. They also fill out a special form called CKYCR form used for both individual and businesses. Let's move forward to personal accounts now. Personal accounts, these are accounts in the name of one person or jointly with other. Who can open an individual account? A person who is of age of majority. A person who is above the 18 years of age can open an individual account. The person should be mentally sound and he should not be disqualified by law. When we say mentally sound or of sound mind, we means that the person is able to form rational judgment for him and see what is in his or her interest, and not disqualified by law, like he is not declared financially insolvent or bankrupt by the court of law. For example, if a person aged 30 wants to open a savings account, he can do so if he submits proper KYC document and signs the form. But if the person is a minor or of unsound mind, the person has to, the account has to be opened by a guardian on their behalf, and the guardian's document are also needed. What are joint accounts? These are accounts opened by two or more persons together. When why it is opened? Why open a joint account? If a husband and wife wants equal access to family savings, if elderly parents want their son to help operate the account for easy access in case of one person dies. So, if they want to share joint control of funds or one person wants to give access to another, then joint account is opened. For example, there are two individuals, A and B, and they open a joint account, so either of them can withdraw money when needed. So their relationship and the purpose of joint account among the holders should be clear, and it should be clearly stated. All joint account holders must sign the form, submit the KYC documents, and clearly state who can operate the account. Like either one can sign or both must sign together. For example, if the sign of A or B can work, or there should be signatures of both A and B in order to operate the account. So this has to be clearly stated. What if one person is NRI? So in case one person is NRI, they must choose a close relative to open an joint account. Account of illiterate person. A person who cannot read or write is called illiterate person, but still they are allowed to open a bank account, but with special precautions. No one should take unfair or undue advantage of illiterate person. So proper rules have to be followed. Number one, bank staff must explain all account rules in a language the person understands. If he or she understands Hindi, then we cannot explain the rules to them in English. Or if they understand the rules, they understand Marathi language, then we cannot simply explain the rules to them in any other language like Malayalam or Hindi. We must make sure that the rules are explained to them in the language which they understand. No checkbook or current account is allowed for a illiterate person. No checkbook is given no matter what. Even if they operate the account jointly with a literate person, the checkbook will not be provided to them. The person must visit the bank personally to withdraw money each time with a passbook. Their left hand thumb impression is taken in front of a bank officer, and a person who is known to them, who is a trusted witness. Uh, Two passport size photos are taken, one for the form and one for the passbook. They can authorize a literate person to operate the joint account, to operate the account jointly with them, but we have to make sure that the mode of operation should be joint and not either or survivor basis. So a illiterate person, say name X, wants to open the account, he or she must come in person to withdraw the money. Now if Mr. X wants her son to help, then they must operate the account jointly. Operate the account jointly. Accounts of blind person. Blind persons are legally allowed to open the account, but again special care is required. So blind individuals can open a bank account. They must provide two passport size photos. Their signature or thumb impression must be verified by someone the bank trusts. If they face difficulty in signing, bank may take both signature and thumb impression. If the branch manager is satisfied, branch managers can allow them to operate the account themselves, or let a trusted relative do it after proper authorization. All account entries must be read aloud to them during every visit, but it has to make sure that no other person can hear these transactions. For example, if Mr. A is blind, he wants to handle his account himself, the bank will read out his balance privately, and if his signature changes slightly, they will also use his thumb impression for security. Account of minor. Who is a minor? As per Indian Majority Act 1875, a person in India becomes a major at 18 years of age. So anyone below 18 years is called minor. If a person is of 17 years and say 150 days old, he is still a minor. He becomes a major the day he turns 18. And what does law says about minor and contracts? According to the Indian Contract Act, minor cannot enter into legal contracts. They are not competent to contract. This means a minor cannot buy or sell property, sign agreements, etc. However, there are some exceptions. A minor can receive money if someone gives, if they are for essential items. Uh, so a minor can receive money or gifts. If someone gives essential items to the minor, the contract is valid. For example, if bank provides loan for the necessity, then the loan will be valid, else it will not be valid. Can minor open bank accounts? Yes, minors can open bank accounts. But again, there are some rules and conditions. Number one, minors should be above 10 years of age. They must be literate. KYC documents of both minor and guardians are required, and date of birth must be clearly mentioned and recorded. Say Arav is 12 years old and can read and write. He can open his savings account in a bank, but again, with his guardian, who can be guardian. Father is usually the natural guardian, but RBI also allows mother as guardian, are not step parents. Step parents are not allowed. Also, two minors cannot open a joint account. So, two minors cannot open a joint account. Banks may provide ATMs, debit cards, and net banking, but no overdraft facility is allowed. Meaning to say, accounts cannot go into negative balance. For example, a child named Ria, 14 years old, gets a debit card from her bank. She can spend only the money available in her account. She cannot take loans or spend more than her balance. And what happens when minor turns 18? So guardian loses control of the account. Now the now major person must confirm the account balance, submit fresh signatures, and give new instructions. So these are some important legal provisions like no overdraft in minor's account. Number two, minor can sign a check as per section 26 of the Negotiable Instrument Act. On death of a minor, a guardian must close the account, and if guardian dies before the minor becomes major, money will be paid only after the minor turns 18. Hindu undivided family. A Hindu undivided family is a joint family setup where a business or property is passed down through generations. It includes a common ancestor and all his descendants, including daughters, since 2005. Now, who are the members? Uh, let me make you familiar with certain terms like co-partners. So, family members who share the property are known as co-partners. Karta is the head of the family, usually the eldest male, but eldest female can also be Karta now, and it was ruled by Delhi High Court in the case of Sujata Sharma versus Manu Gupta in the year 2015. So, what was the name of the case? It is Sujata Sharma versus Manu Gupta. Um, Imagine Mr. R runs a textile shop and he passes away. His two sons and one daughter now inherit the business. Now the shop becomes HUF business, and one of them, say the eldest son, can become the Karta. What are the rules for opening and operating HUF account? Uh, Karta can take loans and sign papers, but it's safer if all adult members sign the papers too. Declaration should be taken to confirm who is the Karta. Bank will not get into the part like who is the Karta. So, a declaration should be taken from the HUF. Karta can sell property only if it is necessity for the family or business. Minor co-partners' name should be recorded. Their guardian signs for them, and if one member leaves the HUF, it does not close the HUF or the account. So, these are the rules. What are the documents required? Account opening form should be signed by all adult members. Signature card should be signed by the Karta. Joint Hindu family letter should be signed by all adult members. Guardian signatures for minor members and KYC documents of all members are required. And who operates the HUF account? Normally only Karta operates the account, and some other cases other adult co-partners can be allowed to operate if needed. Sole proprietorship firm. A sole proprietorship is a business owned by one person. So there is no legal difference between owner and the business. A savings account cannot be opened in the name of proprietorship firm. Only a current account is allowed. Right? Keep that in mind. Only a current account is allowed. Rules for opening and operating sole proprietorship account. Only the proprietor signs all the documents. A declaration confirming ownership is needed. The proprietor signs in the name of the firm, and even checks must be signed as firm's name. What are the documents required? Current account opening form is required, which is signed by the proprietor. Signature card signed by the proprietor. Proprietorship declaration and KYC documents like PAN, Aadhaar card, business proof. These are required. What is a partnership? Partnership is when two or more people they come together to a business and agree to share profit. It has been defined under Section 4 of the Indian Partnership Act. Section 4 of the Indian Indian Partnership Act. This act is of 1932. Okay, so it has been defined under Section 4 of the Indian Partnership Act, and registration is optional, but it is compulsory in the state of Gujarat and Maharashtra. What are the rules for opening of a partnership firm's bank account? For registered firms, the bank must collect a copy of the registration certificate. Partners should sign on behalf of the firm and not in their personal capacity. Checks in the firm's name should go only to the firm's account, not to partner's personal account. If any partner raises a dispute like stopping the account, then all transactions must be stopped until all partners jointly agree to resume. Uh, there are some rules and case laws. So, every partner is considered as an agent of the firm. Even sleeping partners, they can be held responsible. It has been decided in the case of Abbas brothers versus Chetan Das Fateh Chand. And even if one partner manages everything, it's still a partnership. Okay, so it is still a partnership, and it has been decided in the case of KD Kamath and Company versus CIT. What happens when new partner joins? So if a new partner joins, if the account has a credit balance, meaning to say the balance is in positive, it can continue. And if the account has a debit balance, say it has negative balance, then open a new account to prevent the confusion due to Clayton's rule. Now, what is Clayton's rule? So Clayton rule states that old debts get paid off first from the new deposits. What are the limitations and special situations? Let's talk about them. Our partner cannot be treated as an agent when dealing with other partners. For example, if two partners borrow money from the third partner, the other partners are not held responsible. And if a partner dies, the partnership ends automatically. Unless stated otherwise, a bank must stop operations, close the account, open new account under legal heir's name, and collect letter of administration from court. So if Mr. R dies, new account can be Mr. R deceased, and whatever the legal heirs or executors name, say Ritesh. So Ritesh bracket administrator. No partner can open account in his own name, withdraw court cases, admit liability or sue in firm's name alone, buy or sell property in firm's name, and any partner can stop payment of a check issued to other partner. What happens when a partner retires? So when a partner retires, stop the bank account. You open a new account to ensure the retired partner is not liable for new transactions, and give public notice in newspaper to legally confirm retirement. What are the documents needed to open partnership firm account? So there are account opening forms signed by all the partners, specimen signature cards, partnership letter describing the business name and account operation rules, original and copy of partnership deed, registration certificate, instructions and specimen signature of authorized signatories, PAN of the firm, and KYC documents. Now let's talk about limited liability partnership. So what is an LLP? LLP is a mix of partnership and company. It is formed under LLP Act 2008. Now, as the name suggests, limited liability. So, partners here have limited liability and they are not personally responsible for the losses. Say, if a business loss is rupees 10 lakhs, a partner will only lose their share of investment and not personal assets. LLP must have at least two designated partners and they need a DPIN. A DPIN meaning to say designated partner identification number. There will be an LLP agreement which decides the roles and responsibilities. What are the rules for LLB bank accounts? So, a resolution by designated partner is needed to open an account. Since LLP is a mix of partnership and a company, LLP is a corporate person and it does not dissolve it if a partner dies or resigns. So, an account can continue even with debit balance. If signatories change, a new resolution is required and partners are not personally liable for the dues. What are the documents for LLP? Account opening form is required, signature card, certificate of incorporation, LLP agreement, resolution for account opening and authorized signatories. Instruction with specimen signatures, PAN and KYC documents are required. Also, what is a small LLP? So, a small LLP is LLP where contribution is less than or equal to 25 lakhs and turnover is less than or equal to 40 lakhs. So, if a question comes like what is the contribution in a small LLP? So, what will you mark? It is less than or equal to 25 lakhs. Limited company, a limited company is a legal entity which means it is treated like a person in the eyes of law. So it can open a bank account, buy property, borrow money, or do business in its own name. Though there are three types of companies, type of limited companies, which we need to understand. Number one, public limited company. It need at least 7 people to start, and there's no upper limit, and they can raise money from public by issuing shares. For example, Tata Steel is a public limited company, Infosys is a public limited company, Tata Motors is a public limited company. It can invite public to buy its share on the stock exchange. And even if a company is registered as private company and if the parent company is not private, then that company will also be treated as a public company. Private limited company, it needs minimum 2 members to form a private limited company and maximum members can go up to 200. It cannot invite public to buy shares. So there are restrictions on share transfer and they cannot freely transfer the share. For example, Bennett Coleman is a private limited company. It shares are not listed on the stock market, so there are restrictions on share transfer. Boat is a uh, private limited company. Oyo is a private limited company. So there are restrictions on share transfer. It means share can be transferred, but you cannot invite public to buy or sell your shares freely. What is a government company? So this is government company. So if 51% or more shares are held by central or state government, it is called a government company and they don't need to add the word limited in its name. One person company, it is a concept of the Companies Act 2013. One person company means to say it has only one owner or member. One more person is required to be named as a nominee in case the owner dies, and it is a private limited company. How companies are formed? They are formed under the Companies Act. The company must prepare two documents. Number one, memorandum of association, what the company can do, like the objectives of the company, articles of association, how the company will run its internal function. So, MOA is a public document, AO is a private document, and once approved, the company gets a certificate of incorporation. What are the documents required for a limited company? So, a memorandum of association, article of association, certificate of incorporation, name of directors, PAN, if there are any beneficiaries, a list of beneficiaries, and board resolution and specimen signatures. Let's talk about the rules for operation. Cash withdrawals can only be allowed if the company gives written permission. So, only authorized persons can operate the accounts. To prevent frauds, bank allow operations only if two or more authorized persons sign together. For example, any 2 out of 5 directors may be allowed to sign a check. What happens if there is a death of signatory? If a director who used to sign the check dies, the company checks are still valid because the company is a separate legal person. When it comes to borrowing money, a trading company like a retailer or manufacturer is automatically allowed to borrow, but a non-trading company like a charitable trust must clearly mention their borrowing rights in MON and AOA. Uh, then we talk about the check handling. So never deposit a company check into personal account of a director or employee. That would be a legal violation under Negotiable Instruments Act, so under section 131. And starting if the company starting business post 2019, so after registration the company must file a declaration within 180 days confirming that all shareholders have paid their share money and only then it can start a business. Documents required we have already covered. Now let's move on to clubs, association and unregistered bodies. What are these? These are group of people who come together for a common purpose. Now this purpose can be social, cultural, religious, charitable or professional. For example, our local yoga group, our neighborhood music club, our resident welfare association and RWA. So they are not formally registered like a company, trust or society. Instead, they may have a written agreement like memorandum of understanding and some basic rules or bylaws. A committee usually manages the activity of the group. Let's talk about the rules for opening and operating a bank account. So the bank checks the rules to know what the committee members can do, who can use the bank account. The rules must say who is allowed to sign checks and operate the account. Any money spent from the account must be for the activities of the club and group only. Payments, if any payment is made to individual member, the bank will verify why to avoid why the payment has been made to avoid the misuse. So account rules are done. What are the documents needed to open account? Account opening form, which is signed by all committee members, signature card of authorized signatory, copy of bylaws or rules, a resolution from the committee to open the account, MOU or any document showing how the group was formed, list of beneficiaries if there are any, and KYC documents as per bank rules. So these are the documents required to open an account. A trust, what is a trust? A trust is created when one person gives responsibility of managing property or money to another person for the benefit of third person. So the person who creates the trust is known as the author of the trust. The person who has been given the responsibilities of managing the property or money or to another person is known as trustee, and for whose benefit it is managed is known as the beneficiary. For example, Mr. R give 10 lakh rupees to a trustee to be used for educating poor children. So that money is held under a trust. Here Mr. R is the author. Say the responsibility has been given to Mr. T. So Mr. T is the trustee and the poor children here are the beneficiaries of this trust money. The trust is governed by trust deed. The trust deed is the legal document that explains the rules and purpose of the trust. Now, let's talk about account opening rules. A bank must read the trust deed to see what the trustees can do, who can operate the account, are there any restrictions or on withdrawals, and if there are two or more trustees, they usually have to operate the account together unless the trust deed say otherwise. If a trustee dies, the remaining trustees continues the work. If all trustees are gone, new ones are appointed by the court. And trustees' personal problems are not trust problems. Keep that in mind. If a trustee becomes bankrupt or has a loan, the trust money cannot be touched. You cannot set off a trustee's loan with the uh, money belonging to trust. So trustees cannot give their power to others unless it is allowed in trust deed. Charitable trust in many states must be registered with the charity commissioner. All payments from the trust account must follow the trust deed, and checks payable to the trust must not go into trustee's personal account. The bank cannot use trust money to recover the loan taken by a trustee personally. Keep that in mind. What are the documents needed to open a trust account? So account opening form is required, which has to be signed by all trustees. Signature cards of authorized trustees, trust deed, registration certificate, trust letter and resolution showing who will operate the account. If no trust deed is available, some proof of trust existence, PAN or alternatively form number 60, and KYC for all the parties involved. Executors and administrator. So who is an executor? Executor is a person named in the will by someone who has passed away, and this person is responsible for managing the property of the person who died, but the executor must get permission from a court. This permission is known as probate before handling anything. Say if Mr. S dies and names his son Mr. R as executor in his will, R must get a court's probate order before he can access or manages Mr. S property. So this term executor is clear to you. Now let's talk about administrator. Who's an administrator? So if someone dies without a will, the court appoints a person to manage their property. Now this court appointed person is called an administrator. Say if Mr. R dies without writing a will, the court may appoint a person as administrator to handle his property. Uh, what are the important rules with respect to executor and administrator? So executor and administrator cannot give their responsibility to someone else. Account must be opened only after showing proper document like probate, letter of administration, succession certificate. Account should be used only for managing the property of the person who died. Name of the account must include the term like executor or administrator and also mention a state of deceased person's name. And money from this account must be used as per court instruction. What are the documents required? So account opening form signed by executor or administrator, signature card, will if it is available, letter of probate or administration, KYC documents of executor and administrator. Cooperative societies. So what is a cooperative society? This question will come into your mind. So a cooperative society is nothing but a group which is formed by members to carry out business for mutual benefit, like milk cooperative or a credit society. Some state restrict account opening with commercial banks and it requires the registrar of cooperative societies permission. So one of the important rule is this. Let's talk about some other important rules like you have to check the society rules, the bylaws to know if it can open an account with commercial bank. The money must be kept in only an account approved by registrar of companies, and who can sign it? A resolution must be passed to open an account. At least two people, the president of the cooperative society and either secretary or treasurer must sign the resolution. Account must be used only for society's activities and all legal limits must be followed like maximum balance allowed, it has to be followed. What are the documents required? Account opening form which is signed by managing committee members, specific signature card of authorized signatories, resolution signed by president and either secretary or treasurer, registration certificate, copy of bylaw, KYC document of authorized person. Government and public bodies. So these are departments like income tax, forest, railways, etc., which are governed by central treasury rules or state financial handbook. So central government governed by central treasury rules, state government as per state financial handbooks. So what is the bank's role? Bank collect payment on behalf of government, makes payment like refund of salaries, and receives challan for government fees. Then there are receipts and payments. So receipts is money is paid using challan. Treasury must approve this challan, and these challans are valid only for 10 days. Say a person depositing income tax uses a challan which must be approved by the treasury before a bank can accept the payment. What are the payments? So government departments can issue checks from special checkbooks, but no overdraft is allowed. Checks are valid for 3 months only. Payments like tax refunds are made through checks and advice notes. Some departments like forest or local department open a special current account directly with bank. So these accounts are used for specific purpose and closed after that. For example, the forest department may open a temporary account to handle funds for a tree plantation drive. So what are the rules for government accounts? It used only for the permitted purpose. Money should come from allowed sources only. Payment should go to authorized persons only. And if the authorized officer changes, new document must be submitted, but the same account can be continued. What are the documents required? Account opening form signature card, government order notification that allows the account to be opened and explain its purpose. Now let's talk about RBI guidelines on opening current account. So RBI introduced some strict rules to avoid misuse of current account and ensure borrowers don't divert bank funds for unintended purposes. Earlier, bank had to get an NOC from other banks before opening current account. Now this system is now replaced with a clear-cut norms based on borrower's total loan called exposure. So if there are no loans from scheduled commercial banks, in that case, if the customer has no loan or credit from any scheduled commercial bank uh, or payment bank, then any bank can open an account, and this include people who have taken loan from NBFCs, cooperative banks or other non-member banks. For example, Mr. R takes a 10 lakh business loan from NBFC. So he can open a current account in any bank without any kind of restriction. And if there are loans or borrowings from bank, if a person or business has any kind of loan facility from scheduled bank or any payment bank, then some rules will apply. So there are non-fund based facilities and there are fund based facilities. So cash credit overdraft facilities. So these are fund based facilities, and letter of credit, letter of guarantee. These are non-fund based facilities provided by bank. So we'll break the rules into two main categories. Number one, borrowers with fund-based facilities like cash credit overdraft facilities. And if loan amount is less than 5 CR, then there are no restrictions. Bank must take, but the bank must take a written undertaking that the borrowers will inform them if their loan reaches 5 CR or more. Second, if the exposure is greater than 5 CR, then only one bank which has at least 10% of total loans can open the current account, right? Then other lending banks can also open, but they can open collection account just to collect payment. And these banks must send money to the main current account within 2 working days, and no lending bank can open any current account, meaning to say the bank that did not give a loan, that bank cannot open any current account. For example, a company has a 20 CR loan from three banks. So a company, this is a company has 20 CR loan from bank A. The loan is 10 CR. Bank B, say 5 CR, and bank C 5 CR. So here bank A can open a current account, bank B and C can open collection account, and no other bank, say bank D, can open any of these accounts. Borrowers without cash credit or OD facility. So if the exposure is greater than 50 CR, then banks must set up an escrow account with one bank, usually the one managing the deal, and other lending bank can also open collection account and money must go to the escrow accounts. If the exposure is between 5 CR to 50 CR, lending banks can open current account and non-lending banks can open, but they can open only collection accounts. And if the exposure is less than 5 CR, banks can open current account, but written undertaking must be there that the customer will inform once loan crosses 5 CR. Then there are some monetary guidelines like bank must review accounts every 6 months to check if borrower exposure has changed. Daily expenses go via cash credit or OD if available, or else current account will be maintained. Uh, Term loan disbursal should go directly to suppliers, not into borrower's current account in order to avoid the misuse. And when we say exposure, exposure includes all credit, fund-based, non-fund-based facilities. There are certain exemptions. So there are some type of current accounts which are exempted from these rules. For example, accounts for real estate projects under RERA, escrow account for payment gateways or UPI platforms, account for credit card or debit card settlements, accounts under FEMA, foreign exchange rules will apply. IPOs, FPO, dividend accounts, tax payment account, white label ATM operator accounts. So these type of accounts are exempted. And then there are project specific accounts. So bank can open current account for a specific project if no CC or OD has been taken for that project. These project must close once the project ends. So these are project specific accounts. Obtaining photographs of account holders. Bank collect photographs of customers to help with identity verification. This includes resident, non-resident, and even Padhanashin women. A woman who stays in seclusion are known as Padhanashin women. What are the key rules? Number one, live photograph in digital KYC is acceptable. In that case, no, there is no need for physical photograph. Do not confuse photograph with signature. A photo is not a replacement for your signature. Both are needed separately. Uh, Again, there are certain exemptions. So, government departments are exempted. Local authorities, bank staff, they are exempted from providing photographs. All account operators must give photographs. So, anyone authorized to open the account must give their photo. The customer must bear the cost of photograph. A photocopy of Aadhaar or PAN card is not the substitute for an actual photograph. Keep that in mind. And one set of photograph is required. A set of photograph of two photos, one set of two photos is needed for all accounts in the customer's name. With respect to joint accounts, partnerships. So each joint account holder or partner must give their photograph. For companies, bank must collect photo of the person authorized to operate the account. And for minors, if a minor age 10 year or more opens a savings account, their photo is required. But again, uh, photograph of guardian is also required. For HUF, Karta's photograph is required. And for NRI accounts, say NRE, NRO, FCNR accounts, will study them in the units to come. From unit 10 onwards, we'll study about the foreign exchange, foreign management, and there you will see what are NRE account, NRO account, FCNR account in the upcoming units, unit 8, 9, 10. So, Karta, uh, so for HUF, it's Karta. For NRI account, you are required the photograph of account holder and power of attorney holder. What if the appearance has changed? So if bank notice that a person's look has changed, drastic weight loss or something of that sort, so they can ask for recent and attested photographs. Now let's move on to the last topic of the day, legal entity identifier. This is last but not the least. So this topic is quite important. Questions do come from this topic. So legal entity identifier is a 20 character Unicode. It's a mix of letter and numbers used to identify businesses. As the name suggests, it is an identifier. It identifies businesses and other legal entities, not individuals, when they do big financial transactions. So what it does, it helps banks and regulators to track who is doing what and helps in risk management. The first question which might come into your mind is, why was legal entity identifier introduced? So after the global financial crisis, many countries realized that they lacked a clear picture of who was involved in complex financial transactions. So LEI was introduced to fix this problem by improving the quality of financial data, managing risk tracking easier. It makes risk tracking easier and creates a global standard for identifying legal entities. Who issues LEI? So LEI is issued by local operating units that are certified by global body called Global Legal Entity Identifier Foundation. And in India, It is issued by Legal Entity Identifier India, which is a subsidy of Clearing Corporation of India Limited. Now, who needs to get an legal entity identifier in India? So, companies and organizations doing large financial transactions and not individuals, they are required to obtain LEI. Bank and borrowers where the loan exposure is above a certain limit, they are required to obtain the LEI. So, say if a company takes loan from one or the more banks and the total amount is more than 5 CR, then it must get an legal entity identifier. Okay. So what is the timeline to get LEI? So if the total exposure is above 25 CR, then the timeline was 30th April 2023. If it was between 10 to 25 CR, the timeline was 30th April 2024. And if the total exposure is between 5 to 10 CR, then the deadline is 30th April 2025. And where do we use LEI? uh, in derivative markets, in large loans from bank, government securities and money, in RTGS and NEFT transactions. So if there is any payment of 50 CR or more by a company through RTGS or NEFT, then it requires an LEI. When we talk about large loans for borrowers having 5 CR or more exposure, when we say exposure, it is fund based and non-fund based included. So at that point of time, you require a legal entity identifier. And for forex transactions above 50 CR under FEMA rules, you also require legal entity identifier. What if LEI is not obtained? So the bank will not give any new loans, and there will be no renewals or enhancement of existing loans will be allowed. Who is exempted? So government department and agencies are exempted. Also individuals are exempted. For foreign entity, a foreign mutual fund which is registered in India as foreign portfolio investor does not have a legal status in home country. So such funds can use the LEI of the parent company that manages them. So let's start. Um, like banks get most of their money from deposits. This is a known fact, and this money is then used for giving loans and making investments. So bank can engage in only two kind of activities: lending and investing. And the deposits which a bank gets are used for these two activities. But bank don't look just how much money they collect. They also focus on the cost of these deposits. Like they have to pay interest to the customers as well, because it affects how much profit the bank earns. And each bank may slightly offer different features in deposit accounts like interest rate, minimum balance, and other services. And now let's move on to different types of deposit accounts. Firstly, let's understand a current account. So, current account is like a daily use account specially made for business people, traders, and companies. What are its key features? So, no interest is paid on the money in this account. Keep that in mind. Zero interest. So, bank does not pay any kind of interest on current account, and it is useful for those who have many day-to-day transactions. So you collect money, you withdraw money, you pay money. Ideal for the businesses, traders, companies, firms, and anyone like individual company partnership club can open it. So there are no restrictions, but some certain sect are not allowed to open current account. Uh, we have already discussed it in the previous unit as well, like illiterate person, blind person, Pradhanashin women, and minors. They cannot open current account in their name. One of the key features of current account is that there are unlimited withdrawals and deposits. There is no upper or lower limit, but again, bank may ask for a minimum balance, but there is no maximum capping. You can keep as much money as you want in your current account. There is no maximum limits. So unlimited transactions are allowed, and current accounts can be operated by individuals or authorized persons like signatories or someone with power of attorney. Check, net banking, debit instructions like NECH, they can be used. Again, ATM withdrawals are allowed for all individuals, and bank can also deduct charges or interest if authorized by the company. So if a businessman needs to pay vendors daily and receive money from clients regularly, he should use a current account and not a savings account. Before moving forward to savings account, there is also a temporary overdraft in current account, which we should discuss. So if a trusted customer asks for a short-term loan more than their account balance, bank may allow it, and this is called a temporary overdraft. A written request and promissory note is required for temporary overdrafts in current account. Let's move forward to savings account now. A savings account, as the name suggests, it is mainly for individuals who want to save the money and earn interest. Some of the key features are: it can be opened by individuals jointly or singly. Interest is paid on money in this account, although interest is not very much high. But again, there's no interest in current account, and if you keep your money in savings account, you will earn a interest. A savings account may be with or without a checkbook, and money can be withdrawn by check, withdrawal slips, ATM, net banking, mobile banking, and similarly, it can be deposited via cash, online check. This type of accounts are not allowed for business or trading transactions. There's no limit on how much balance you can keep. Also, bank follow RBI rules for interest rate. There is differential interest which bank follows. For example, SBI may offer you different interest on savings account. ICICI Bank offers you different account. So this is differential interest rate. Earlier, it was controlled by RBI, but later on, RBI deregularized it, and it is up to the banks uh, to decide what interest rate they want to offer. But again, up to 1 lakh rupees, same interest rate apply for all. Above 1 lakh, bank may offer different rates but not discriminate between customers with the same amount on the same date. Now, who can open a savings account? So, any individual can open a savings account, minor above 10 years of age, Karta of HUF, and certain institutions which are allowed by RBI, and we'll discuss them just in a moment. Before that, who cannot open a savings account? So, savings account cannot be opened by government departments like municipal bodies, panchayats, political parties, businesses or companies, professionals, professional firms like doctor, lawyers, in partnership, and any organization depending only on government firms. Now let's talk about the institutions which are permitted by RBI to open a savings account. So these are special institutions that are allowed to open savings account, like primary cooperative credit societies which are funded by bank, Khadi and Village Industries Board, Agriculture Produce Market Committees, registered committees which are registered under Societies Act and not State Cooperative Acts. Section 8 companies. Section 8 companies are those companies which work for charity and they don't use limited in their name. Institutions whose income is tax free, self-help groups, farmers club. So these kind of institutions are allowed to open savings account. A student saving pocket money or a salaried person saving monthly income, they should use a savings account. But again, a merchant who deals with many customers and vendors daily, they should open a current account. Let's talk about some key regulations for savings account now. Number one, minimum balance. So some banks require the customers to maintain a minimum balance in their savings account. If the balance go below the limit, the bank may charge a penalty. But before charging the penalty, the bank must inform the customer by SMS, email, or letter. If the required minimum balance is 2000 and the account has only 500, the bank will notify the customer about the shortfall, and the customer will get 1 month to add the required amount. and if it is not done within that time, a penalty will be deducted from the account. Again, the charges must be reasonable and based on actual service cost. The account balance should not go negative only due to the penalty. Keep that in mind. Very important. And if the customer consistently fail to maintain the minimum balance, the bank may close the account or change its category, but only after a discussion. Let's move forward to withdrawals. Some banks put a limit on the number of withdrawals allowed in a month. There may also be a limit on the amount that can be withdrawn at once. So, a customer may be allowed only 5 withdrawals per month or maximum withdrawal of 25,000 in one go. Withdrawals using withdrawal slips are allowed only for account holders and the passbook must be shown. Now, what is a passbook? A passbook is given to the customer when savings account is open. The customer has to sign the acknowledgement to confirm the receipt. It is opened at account opening. It is issued at account opening and it is updated regularly. So it shows every transaction, every debit and credit which happens in the account. Transfer of accounts. A customer can request to transfer their account from one branch to another branch of the same bank. But a written request is required and all unused checks, they must be returned to the old branch. The account opening form and signature card will be sent to the new branch. And with core banking system and multi-city checks, physical transfer is not always necessary. Only the base branch gets updated. Staff accounts. A bank staff member may have a limit on how many savings accounts they can open in their name or jointly with family members. Checks issued from staff account must be carefully checked to ensure sufficient balance. Third party checks or demand draft should not be credited to staff account. If any staff account shows unusually large transaction, it must be monitored. A customer can close a savings account. So, a customer can close a savings account by submitting a written request, but also it has some steps involved in it. So, a customer has to return all unused checks and present the passbook. The bank will get the updated. Bank will update the passbook and stamp account closed on each page, and the remaining balance will be paid only after the customer submits a check or withdrawal slip. Let's understand basic savings bank deposit accounts now. So this is a special account designed for financial inclusion and mainly for customers from low income group. So there is no minimum balance requirement. There are some free services in BSBDA account like cash deposit at bank branches, ATM, cash deposit machines, credit of funds via UPI, NEFT, checks, IMPS, and unlimited deposit in a month. So there's no restriction on amount or number, but there are restrictions on withdrawal. So in under free services, up to 4 withdrawals per month are allowed. One ATM come debit card is provided. A checkbook is not included in free service, but it may be given at the bank's discretion. Bank may offer extra services like SMS alert or internet banking, but charges should be reasonable and clearly mentioned. The services must be optional for the customer and there's no minimum balance should be required for these services. And if such service require maintaining a balance or they come with extra charge by default, the account will no longer be treated as a BSBDA. One of the important condition of BSBDA is that only one BSBDA is allowed. So, a customer can open only one BSBDA in the entire banking system. If the customer already has a savings account in the same bank, it must be closed within 30 days of opening the BSBDA, right? And the customer can still open other accounts like FD or RDs, they are allowed. Uh, So let's discuss fixed deposit and then we'll move on to recurring deposit. So what is a fixed deposit? A fixed deposit is when a customer keeps a fixed amount of money in a bank for a specific time period and earns interest on it. For example, a customer a customer deposits say 10,000 rupees for 3 years. So this is a fixed deposit, and fixed deposit can be for few days, months or years, but minimum period is 7 days and usually the maximum period is 10 years. A customer can open FD with any amount, but large value FDs are called bulk deposits, and there was a revision on the amount. Last year there was a revision on the amount, and in scheduled commercial bank, FD of 3 crore or more is considered as bulk deposit, and in regional rural banks, FD of 1 CR or more is considered a bulk deposit. Term deposit receipt is provided by the bank, so the bank must give a receipt called term deposit receipt, which includes customer's name, account number, uh, deposit amount and interest, date of deposit and maturity, due date, nomination status, and branch transferability. So everything is provided under term deposit receipt. What happens on maturity? So when the FD periods end, the bank will either repay the amount or renew the FD depending on the instructions, and if no instructions are given, the bank should inform the customer in advance about the maturity. Premature withdrawals. So if the customer needs money before maturity, the bank allows premature encashments, but in some cases the bank will charge penalty, and the bank actually pays the amount after the penalty is deducted. Some FDs are issued without the option of premature withdrawal. However, for FDs held individually or jointly, a customer for 15 lakhs or below, premature withdrawal facility must be provided. If the FD matures and the customer does not claim it, the bank pays interest at savings account rate or the contracted FD rate, whichever is lower. So if the maturity amount is 20,000 or more, it must be credited to the customer's account and it cannot be paid in cash. So 20,000 or more, this amount goes directly to the account, no cash. Okay. How interest is paid? So interest on FD is usually paid quarterly. Alternatively, the customer may choose to get it on maturity along with the principal. In that case, interest is compounded quarterly. And based on these, there are two types of fixed deposits. Number one, ordinary term deposit. So interest here is paid periodically, and then there are reinvestment deposits. So interest added to principal and paid at the end. Uh, Term deposit joint holders. So in case of joint FDs, the bank can add or remove joint names if all account holders agree, and split the FD amount. Split the FD amount among the joint holders without changing the total amount of period. So this can be done. And a customer can take loan by pledging the FD receipt along with a lien letter. The loan amount is given after keeping a margin on the FD, say 5 to 20% of margin. And for example, if the customer has a fixed deposit of 1 lakh, bank may give him anywhere between 80,000 to 95,000. So bank charges interest that is slightly above the FD, 1 or 2% above the FD. So if bank is offering 7% interest on FD, the bank will charge 8 or 9% for loan against FD. If the FD is closed early, the loan is recovered from the FD proceeds, and interest is recalculated with penalty if it is applicable. Now let's move forward to recurring deposits. So in recurring deposit, the customer deposit a fixed amount every month for a set period. For example, Mr. A deposits. So this is Mr. A, and Mr. A deposits a sum of 1,000 rupees for 24 months. So this is our recurring deposit. Interest is calculated using quarterly compounding. If any monthly payment is missed, the final amount is reduced. Rule for early closure and loan against RD are same as fixed deposit. No RD is allowed in foreign currency accounts like FCNR accounts. So no FD, no RD is allowed in these accounts. Hybrid deposits. Hybrid deposits, you can also understand them as combo deposit. So it is a deposit account which offers the feature of a savings account as well as a term deposit account. So some banks offer a combo where if the money is in excess in the savings account, it automatically gets transferred to FD, keeping a minimum balance, and if needed, amount is auto reversed from FD to savings account to clear payments. FDs can be made in units as well, like a unit of 1000, and if the customer needs money, they can break only a part of FD. So whole FD has not to be touched, only a part of FD will be will be break when you do a premature withdrawal. Special deposit types. So in this we particularly have cash certificates, annuity deposits, and certificate of deposits. In cash certificates, a variant it is a variant of FD where the certificate is issued at a discounted price. Customer gets full maturity value later. For example, a person has to pay 9,000 now and he will receive 10,000 on maturity. So this is a cash certificate. And same rules as regular FD applies on cash certificates. Annuity deposits. Annuity deposit is just opposite of recurring deposits. Customer deposits a lump sum and bank return it in equal monthly or quarterly installments. And each installment includes principal and interest component. For example, a 1 lakh deposit, a person deposited a sum of rupees 1 lakh for 5 years with quarterly payout of 20 equal payments. So here the bank will pay him 20 equal payments where uh, interest is also included at the time of payments. Certificate of deposit. Certificate of deposits, they are not regular bank deposits. Keep that in mind. They are short-term money market instruments. They are issued by scheduled commercial banks, small finance banks, regional rural banks, and the minimum amount of a certificate of deposit is 5 lakh rupees, and they are issued in the multiple of 5 lakhs. They have a tenure of 7 days to 1 year. Interest can be fixed or floating, floating based on market benchmark. Certificate of deposits can be issued at discount or with interest coupons. They are traded in secondary market. Stamp duty is applicable on certificate of deposits and they can be bought back if all investors in that issue are given the option. Let's understand interest on deposit accounts now. We'll move with general rules and then we'll move specifically to types of deposits. So, as a general rule, bank must have a clear interest rate policy approved by their board or a committee. The same interest rate must be given to everyone for the same time. There should not be any kind of discrimination or favoritism. Bank must inform customers about their interest rates in advance. These rates must be recorded in the core banking system for inspection. Banks are not allowed to negotiate a bargain interest rate with customers. Rates must be reasonable, consistent, and they should be open for inspection by regulators. There's a rounding off, so round off interest to the nearest rupee, and for FCNR deposits, round off to 2 decimal places. And if there is any change in rates, they must be quickly shared with customer and branches. Fixed deposit receipt for deposits of less than 3 months or where the last quarter is incomplete, interest is paid only for the actual number of days. Bank usually calculate interest using 365 days in a year. Some uses 366 and leap years. So if a 2 month deposit is made, interest will be calculated for exact number of days and not months. Banks must tell depositors how they calculate interest at the time of accepting the deposit. What happens if FD matures on a non-business day, like on a holiday or Sunday? So interest is paid for the extra day at the agreed rate. And for reinvestment FDs or RDs, interest is paid on the full maturity value for the extra days. So if FD matures on Sunday, payment is made on Monday and you will get one extra day's interest. Transfer of branch. So if a rural or semi-urban bank branch is taken over by another bank, the original term agreed with the old bank will continue. The interest rate will remain the same till the deposit matures. Interest on different deposit types. Number one, we'll talk about current accounts. So no interest is paid on normal current accounts. There is an exception. So if the account holder dies, interest is paid from the date of death till repayment to claimant at the savings account rate. For example, if Mr. X dies with 2 lakh in his current account and the amount is paid to the families 10 days later, so interest will be provided for those 10 days at the rate of savings account rate. Uh, Savings account. So banks can freely decide the savings bank interest rate. Interest rate is calculated daily on end of day balance. For balance above 1 lakh, the bank may offer different rates, and for balance up to 1 lakh, the rate must be uniform. Interest must be credited quarterly or more frequently. A bank may pay 3.5% of balance up to 1 lakh and 4% for amount above 1 lakh. Term loans, so interest rates can differ based on tenures, size of deposit, and whether a premature withdrawal option is available or not. So when we say tenure, different rate for different periods, like for 1 year, 2 year. For 1 year, the rate can be 5%. For 2 years, it can be 6%, depending on the size of deposit. So special rate are allowed only for bulk deposits. Premature withdrawal, bank can offer higher rates for deposits without early withdrawal option. But for deposits up to 15 lakhs by individuals, premature withdrawal must always be allowed. Let's understand premature withdrawal rules. Interest paid for the actual period deposit remained, not the agreed rate. If you do a premature withdrawal, no interest is provided if it is withdrawn before 7 days. Bank must have a board approved policy for penalty on early withdrawals. Penalties can only be charged if the customers was told beforehand. No penalty if withdrawal is due to bank branch transfer, and if deposit is split after death of depositors, then also no penalty will be charged. Overdue term deposits. So if term deposit is renewed after maturity, interest depends on bank's policy. If it is not claimed and lying in the bank, interest is paid at lower of savings bank rate or original FD. A floating interest rate can be offered by banks, and these floating interest rates are linked to external benchmark rate. For example, a bank offer FD rate with 1% more than repo rate. So if the repo rate, the current repo rate is 5.5%. So if the repo rate is 5.5, the bank will give up to 6.5. And if the repo rate increases, say from 5 to 5 to 6.5, then the FD rate will also get up by 1%. So now bank will offer 7.5% of interest. Additional interest on deposit, domestic deposits. Banks are allowed to give extra interest on deposits to certain people. Now, who are eligible for these additional deposits? Number one, bank employees and top management. So, if a bank employee or senior official like chairman, executive directors open a deposit in the same bank, they can get 1% extra interest on their savings bank or term deposit. This benefit also applies if the deposit is held jointly with a dependent like a child or a spouse. So if the regular FD rate is 6%, a bank employee will get 7%. Number two, senior citizens. So bank usually offer 0.25% or 0.5% extra to people aged 60 years or above, but this depends on the bank's policy. If the normal FD rate is 6%, a senior citizen might get 6.5%. There are certain important rules for bank staff deposits. Let's understand them. Number one, extra interest is given only while the person is eligible. So if a staff member retires or leaves, the benefit continues only the till the FD is till the FD maturity and not after that. If a bank employee is working on deputation to another bank, both banks can give extra interest. And if someone is working on fixed contract or deputation, extra interest ends after the contract period ends. A federation where bank employees are not direct members, they cannot get extra interest. The depositors must give a declaration that the money belongs to the current or retired bank employee, a deceased bank spouse, or an association where members are bank staff. Inoperative or unclaimed accounts. So, inoperative accounts is an account where there is no transaction for 2 years or more. Savings with respect to savings account, interest must still be paid regularly even if the account is inactive, and no penalty should be charged for not keeping the minimum balance. And if a FD matures and it's not claimed, the interest paid will be lower of the original FD or the current savings bank rate. If, for example, if FD matures at 6.5% and savings bank rate is 3%, the bank will pay 3% until it is claimed. For frozen accounts, if a term deposit is frozen by law enforcement agencies, if the FD matures during that frozen period, the customer gives a request within 14 days, the FD is renewed from that maturity date. And if the request comes after 14 days, so renewal starts from date of request. The interest for that in between period is kept in a non-interest bearing account and it is paid later. For example, FD matures on January 1st, request is made on January 10th, so renew from January 1st. If request made on January 12, 20, so renew up from January 20. And if the customer does not request anything, the bank may auto renew the FD for the same term as before. But again, the bank must inform this to the customer as well as the enforcement agencies. And for frozen savings account, bank should continue paying interest as usual. Prohibited practices. So prohibitions and exemptions. A bank must not do any of the following things. So bank should not pay any kind of commission or fees to individual or companies to get deposits, except to the agents collecting door-to-door deposits under a scheme, direct selling or marketing agents, business correspondent or facilitators. A bank should not offer any prize, lottery, or free trips to get deposits. They can give cheap gifts like diary worth 250 rupees or less. So, a pen, a diary is fine, but a bank should not offer a free trip for deposits. Bank should not raise deposit just to give loans, especially by using agents or third parties. Should not mislead ads, should not show any kind of misleading ad that highlights only compound interest without showing the actual simple interest. Bank should not take interest free deposit except in current accounts. A bank should not accept deposits where a private financer gets the deposit receipt in their client's name or collect deposits through power of attorney or similar authority. Bank should not give loan against deposit placed in other banks, and banks should not create a fund for charity using depositor money unless it is agreed with the depositor. There are certain exemptions as well. Some rules do not apply to deposit from institutions that are allowed in money markets, deposit from which the bank issued participation certificates, certificate of deposit scheme, capital gain account scheme deposits, and interest payment for delayed collection of instruments like check, draft, bills, or telegraphic transfer. So these are exempted to interest rate guidelines. Now let's discuss in detail about inoperative accounts and unclaimed deposits. An inoperative or dormant account, so also known as dormant account. So an inoperative or dormant account is a bank account in which no customer initiated activity has taken place for a certain period. So for savings and current account, if there is no deposit or withdrawal for 2 years, it becomes inactive. and just getting interest from the bank or bank charges being debited which are not mandated by the customer, they will not be counted as activity. So say you opened a savings account in 2018 but stop using it in 2020, and if you haven't made any deposit, any withdrawal, or you have not done any online transfer say till 2022, so this account becomes inoperative. So these accounts may misused for illegal or fraudulent activities. So a special caution must be given to these accounts as well. uh, Bank should take proactive actions. What are they? Like bank must do a yearly check on all accounts with no activity for 1 year to detect if there are any nearing dormancy. If no activity is found, the bank must send a letter or email to the customer asking why the account is inactive, and they request the customer to do at least one transaction to keep them active. If there is no customer activity for 2 years, the account is officially classified as inoperative. And if there is any customer activity, like if customer has given any mandate, if there are any standing instructions, then also uh, the bank will count that as customer activities. So if a customer has mandated the bank to pay EMIs from that savings account, so that will be considered as customer activities. But if only interest is credited by bank or bank charges are debited, that will not be counted as a customer's activity. What are the exceptions? So if the customer has given instruction to credit FD interest into savings account, this is treated as a customer initiated transaction. So this will be exception to the account. If you have a FD, for example, if you have an FD and the interest is credited every quarter to your savings account, so this account remains operative as long as such credit continues. So if the bank finds that the customer has permanently moved, uh, if the customer has been moved to another city, the bank can suggest the customer to transfer the account to the nearby branch, or can ask the customer to close the account and transfer the funds to the new account. And what happens if a customer cannot be reached? So if letter or email are not delivered, the bank should make efforts, try calling the customer, use email, ask references, people who introduce the account, contact the employers, nominee, and legal heirs. If the customer may be deceased, but if the customer responds to bank communication, the bank gives a reason for inactivity. If the customer responds and gives a reason for inactivity, the bank can extend active status by 1 more year. The customer withdraws the full balance, the bank should allow it after proper identity verification. And if customer does even one transaction, account should be made operative. A bank must ensure that the customer is not inconvenienced. No charges should be taken to reactivate the account, and all necessary precautions they should be followed. Even if account even if the account is inoperative, inactive, so it should be not marked as dormant if it is inoperative under a garnishee order. If the account where only periodic activity is expected, like pension account, or it is an account under lien, or account with a negative balance where the customer owes money to the bank, so these type of accounts are not marked as dormant even if they are inactive. As a transparency measure, bank must display on their website a list of accounts that have been inactive for 10 years or more, and only basic details are to be displayed, like name and address of account holder or authorized person for company accounts. No sensitive details are to be mentioned, and they must also provide step by step instructions and forms for customers to claim their money or reactivate the account. Now let's understand Depositor Education and Awareness Fund. So it is created by RBI in 2014. This fund collects unclaimed money lying in bank for 10 years or more. What type of deposits are covered? So every type of deposit which comes to your mind is generally covered under this scheme. So savings account, current account, FD, RD, overdue demand draft, pay order, mail transfer, telegraphic transfer, unused balances in prepaid cards, pending NEFT or RTGS credits, foreign currency accounts which are converted to INR. So all of them are covered under this scheme, this fund. Uh, some of the key points are that money must be transferred within 3 months after 10 years of inactivity. Money is used for educating and protecting depositors. Customer can still claim their money even after it is moved to DEAF, Depositor Education Awareness Fund. Bank will pay the customer first and then bank can claim reimbursements from the fund. What about foreign currency funds? So if a foreign currency deposit is inactive for 3 years after maturity, it must be converted to INR. And if no maturity period is defined, bank gives a 3 months notice before the conversion. Customer can claim the amount in INR or equivalent foreign currency at the current rate. If the amount is already moved to DEF, bank can still pay and claim the refund. Interest at 3% per annum, simple interest, is payable from the time of DEAF transfer till customer receives money, and bank can claim refund only in INR. Uh, Unremunerative and undesirable accounts. So these are the accounts that are not profitable or they pose operational risk. So unremunerative accounts balance is always below minimum requirements. They are open just to get benefit like issuing demand drafts. And undesirable accounts, so customer issues check without sufficient balance, which leads to check bounce, which ultimately harms bank reputation. So what action can bank take? Bank can send warning letters, bank can stop issuing new checkbooks, and if behavior continues, the bank can even close the account after collecting unused check. And bank should always monitor such accounts closely to prevent check misuse. Operational instructions. When two or more people open a joint account, they can choose how the account will be operated. So let's now look into common types of joint operations and rules related. Number one, jointly without survivorship clause. So all account holder must sign for any transaction, and if someone dies, the account is frozen. The balance is paid to both the survivors and legal heir of the deceased. For example, A, B, and C opened a account jointly, and if B dies, the account stops working until B's legal heirs are identified and money is distributed to them. Jointly or survivor. So all holders must operate it together, and if someone dies, the remaining people can continue to operate. So, for example, if A, B, and C opened joint account with jointly or survivor mode, and if C dies, so A and B they can still use the account. Either or survivor, so jointly or survivor is for three or more depositors. Either or survivor is same, but it is for more than two people. And in this, anyone can operate. If one dies, the survivor needs to get fresh mandate to continue operations. Uh, Anyone or survivor, sorry, let's discuss either survivor one more time. So in this, either of the two can operate the account. The survivor can continue using the account or withdraw the full amount. For example, if a husband or wife open an account, so either can sign, and if husband dies, wife get access to the full amount. So in jointly or survivor, it is three or more, and if there are only two, then the name generally changed to from jointly or survivor to either or survivor. Now let's talk about anyone or survivor. So for more than two people, and anyone can operate it if one dies, then the survivor needs to give a fresh instruction to continue the account. Former or survivor, so only the first person who's former, they can operate the account during the lifetime. If that person dies, the second person, the survivor, then he can use the account. So, for example, account in the name of mother and son, where mother is former and son is survivor. Only mother can operate that account until her death. First name or survivors, so only the first person operates the account, and if the first person dies, the remaining people, the survivors, they can operate it jointly or give a fresh mandate. For example, A, B, and C opens an account. A operates, and if A dies, B and C can use the account together. Changing instruction, any change in how the account is operated. So, if there is change in mode of operation, it must be signed by all the account holders. If A and B wants to change from E or S to jointly, then they both must agree in writing. Mm, stop payment checks. So if any account holder cancels the earlier instructions, sorry, revocation by any holder. So if any account holder cancels the earlier instruction, all account holders must give fresh approval to operate the account. And even for modifying operations, to modify the way the account operates, all joint holders must sign the request. Now let's move on to some special situations. Stop payment. So any one account holder can stop payment for of a check issued by any other joint holder. For example, if A writes a check, B can stop it. So B can provide stop payment instructions. If a joint account holder is unfit, mentally unfit, or bankrupt, then operations must be stopped immediately. Checks signed by that person should not be honored. Closure of joint account. A joint account can be closed only when all joint account holder request it. There is an exception if there is a legal issue. The bank may close it without everyone's request. If no mode is mentioned, if there is no operation mode is mentioned, it will be treated as jointly. A separate request from all joint holders is needed to change it later. Joint account with NRIs. It is allowed only with a close relative and on E or S mode only. So it joint account with NRI is allowed with a close relative only on E or S mode. NRI cannot deposit their own money into this account. If the NRI becomes the only survivor, the account becomes NRO account, and NRI can operate only on behalf of the resident for domestic payments only. What are the rules after joint account holder dies? So claim on death of account holder. If one person dies, remaining account holder can access the full balance. If all the account holder dies, money goes to the nominee. In Hindu family accounts, if a husband deposits money in joint name with wife, it's still considered his money unless it is clearly gifted. And post death, all mandates by the deceased becomes invalid. Check signed by them after death must not be paid. Where there is no nominee or no joint account holder left, then the money is paid to the legal heirs. Conversion of account from single to joint. The person must submit a letter stating why they want to add someone, what is their relationship, specific signature of the new person is required, and KYC and documents of the new person must also be submitted. Joint to single account. All current joint holders must give written approval to close the account. A new single account is then operated in the name of the person who will continue. Nomination facilities. So, what is nomination? Nomination means naming someone who will receive the money from a bank account, locker, or safe custody items if the account holder dies. It's like telling the bank, if something happens to me, give the money or items to this person. The Banking Regulation Act was amended in the year 1983 to allow nomination by adding section 45ZA to 45ZS, ZF, and the government also made rules called Banking Companies Nomination Rules in 1985. The nomination rules have been recently amended and we will discuss about it also. So who can nominate? Where can nomination be take place? It can take place for joint deposit accounts, safe custody in bank lockers. What are the forms which are involved? So there are three key forms. Form DA1 for making nomination, DA2 to cancel the nomination, and DA3 to change and modify the nomination. So only individuals can make nominations, not companies or HUF or trust. Joint account holders must jointly nominate. If a minor has an account, nomination is made by the guardian. If minor plus guardian have joint account, the guardian nominates for both. A minor cannot nominate, keep that in mind, and you can nominate even in NRI, NRO accounts. So who can nominate and who can be nominated? So individual account holder, joint account holders, guardian, NRI account holder. So we have just discussed who can nominate, right? And who can be nominated? Who can be nominated? So any Indian individual, a minor with a guardian to receive money from them, NRI, foreign national of Indian origin, a foreign national of non-Indian origin, they can be nominated. What are the rights of the nominee? The nominee is not the owner, just a trustee who receives the money. Nominee is expected to pass on the money to the legal heirs or beneficiaries. Even if someone objects, once the bank pays the nominee, bank is safe. Unless there is a court order, no loan can be given to a nominee against a deceased person's deposit. And what happens when the depositor dies? The nominee will receive the entire money in the account. And if it's a joint account, the nominee receive the money only after all joint holders passes away. For term deposits like FDs, the nomination continues even after renewal of the deposit. For multiple deposits, one can do a separate nominations as well. Now, what are the recent amendments? So earlier only one nominee was allowed, but after the amendment was passed, up to 4 nominees can be appointed, and there are two ways to nominate. Number one is simultaneous nomination. So you can just divide the deposit among multiple people. For example, you have 10 lakhs and you nominate A, B, and C. So you can simply give a certain percentage to A, for example, 40%, a percentage to B, say 30%, and 30% to C. So you divide uh, on percentage basis. So this is simultaneous nomination. So you simultaneously uh, make these 3% nominee, and then there is successive nomination. So you can choose a priority order. You name A first, B second, C third. So if A is alive, A will get the money. If A is not there, then B will get the money, and B is not available, then C will get the money. Uh, Nomination for pension accounts. We have already discussed about these pointers. Pension account. So pensioner can nominate someone to receive pension account balance after their death. If a pensioner has already nominated someone under areas of pension rules, that is only for areas, not account balance, and pensioners should give a separate nomination for their bank account. What happens if a customer is dead or missing? So when a bank comes to know that the customer has died or is bankrupt or mentally unstable, is of unsound mind, the bank must immediately stop all withdrawals from the customer's account, even if check was issued before the date of death or incident, but if it is presented later. And if a customer is missing and the legal heirs or nominee wants to claim the money, the bank should have a clear policy for the same. The claims may be settled without many documentation. Only two things may be asked for. Number one, an FIR and non-traceable report from police, and then the letter of indemnity. But if the customer has been missing for a long time, so the death can be presumed only after 10 years. The legal heirs must get a court order stating that the person is presumed dead, and only then the bank can release the deposits. Now let's talk about some operational guidelines. So number one, passbook and account statement. Passbook is small and handy and useful for regular customers. Many people still don't have access to internet or computer, so passbook uh, comes to the rescue. There are certain problems with statement that they must be filed regularly. Opening and closing balance must be matched. A person may get lost in the statement may get lost in the post. ATM slips don't show all details. Duplicate statements are costly. So bank should give passbook to savings bank account holders, especially individuals. If the customer wants statement instead, then the monthly statement should be sent to them. Customers should be told to update their passbook regularly, and if the passbook has many entries, give a token and inform the customer that you please collect it after some time. In passbook, entries must be clear and understandable. There should be no usage of vague words. Don't use the code that customer cannot understand, and provide brief and clear instructions to the customers. When a customer submits passbook for update and you give them a token, the passbook has to be kept under a lock and key, and staff member should be assigned for those passbooks. For monthly statements, if a customer wants statement instead of passbook, send those monthly statements every month. Keep a record of dispatch, and inspecting officer should check if this is being done. The passbook should clearly mention the nomination register. If the nominee is added, every passbook or statement must mention full address and phone number of the branch, and passbook should mention MICR code and IFSC code. Checkbook and check handling. So, most banks centrally dispatch checkbooks by courier, but they should not force customer to accept risk or sign that courier is at their risk. They can come to the branch and collect the checkbook as well, and checkbook must be safely delivered. Checks are printed in Hindi or English, but the customer can write them in any regional language. And Saka Samvat, which is the India's national calendar, can be used for dating the checks. If a check has Saka Samvat date, the bank should convert it into a regular date and like Georgian calendar date and accept it. All core banking system banks must issue multi-city and payable at par checks to customers. These are treated like local checks, and no extra charge should be taken for these checks. Before paying a check, banks must verify some things like check leaf from the customer's checkbook, date is not too old or a future dated. So the check should be valid, it should be presented within 3 months. Pay name is clearly written, amount should be matched. In case of companies, authorized signatures and stamp should be there. If it's a bearer check, the signature, name, and address of the bearer is provided on the check. Account balance is enough to cover the check. There should be no unauthorized alterations, no stop payment instructions. There should not be any kind of legal orders. The customer should not be dead or bankrupt or becomes a person of unsound mind. Cross check must go through a bank. It's not paid in cash. Home checks can be processed directly. For account paycheck, credit should go only to the paying account. So these are certain things which should be followed by the bank. Stop payment of check. So sometimes what happens, a customer may want to stop the payment of check they issued earlier. This can happen for reasons like the promised goods or services were not delivered. The person issuing the check finds out that they were tricked into a fake investment scheme, and now they want to stop the payment. And in such cases, the customer can instruct the bank not to make the payment on that check. And this instruction is called stop payment request. There are certain steps which should be followed, like record the time and date when the stop payment instruction is received. Immediately check whether the check has already been cleared or not. If the check is not yet cleared, all the details of the check must be entered in the system. And once stop payment instructions are received, the bank must not honor the check. Right? Uh, if the customer wants to revoke uh, the stop payment, so if the customer change their mind, they can revoke the stop payment instructions by writing to the bank. Once revoked, the bank can process the check normally when it is presented. Collection of check and instruments. Bank help customers to collect payments for their check, draft, and other similar instruments by crediting the amount to their account. For example, if a shop owner deposits a check given by a customer, the bank will collect the money from the customer's bank and credit it to the shop owner's account. So, sometimes what happen is the clearing process get temporarily suspended, and this cause delay in crediting checks. To reduce inconvenience, the bank may buy the checks from trusted customers and credit their accounts in advance. But before doing this, the bank must check customers' credit history, reputation, occupation of the customer, and chances of check being dishonored. Check Dropbox facility. Banks provide check Dropbox facility where customers can drop their checks for collection. However, customer must also be allowed to submit checks at the counter and get an acknowledgement. And bank must clearly display in local language that the check can be submitted at the counter. Maintain proper records each time the drop box is opened. Use check deposit machine where available for 24 into 7 convenience. If a check is returned for technical reasons and not the customer fault, the bank should not charge return fees. Such check must be represented within 24 hours and the customer must inform through mails. And when a check is dishonored, the bank must return it to the customer within 24 hours. And the bank must clearly mention the reason code for return and get the return memo signed by the bank officials. If there are frequent dishonors of the check, say if a check of 1 CR or more is dishonored 4 times in 1 year due to insufficient fund, then the bank will not issue a new checkbook. The bank may close the account and a warning will be sent to the uh, check dishonored. So the customer, so warning will be sent to the customer. And for frequent dishonor of checks where the amount is below 1 CR, the bank must have a board approved policy for that, for how to handle such frequent dishonors. If the payee needs to go to the court or consumer forum, the bank may provide documentary proof showing that the check was dishonored, and the bank must have internal procedures to handle dishonored checks properly and fairly. There should be no delay on miscommunication and no collusion between bank staff and the check issuer to hide the dishonor from the payee. Standing instructions, a customer can give the bank written instructions to carry out recurring payment automatically. For example, transfer money every month from savings account to recurring deposits, transfer interest from FD to savings account, pay loan EMIs automatically, pay insurance premium, electricity bill, etc. Let's move on to last topic of the day, attachment orders. So, we'll start with garnishee order. So, what is a garnishee order? A garnishee order is an order issued by a civil court under Order 21 of the CPC. Its purpose is to help a judgment creditor, a person who has won a court case and is supposed to receive the money, to recover money from a judgment debtor, the person who is supposed to pay. Now, if the judgment debtor has money lying with someone else, like a bank, the court can instruct that bank not to allow the debtor to withdraw the money, and the bank is called the garnishee. So, this is a garnishee order. What are the types of garnishee orders? So, there are two types, order nisi and order absolute. So, order nisi is a temporary order. It asks the bank to explain why the money in the debtor's account should not be used to pay the creditor. Until the court gives the final order, the bank must stop any withdrawal from the debtor's account and inform the customer. In order absolute, this is final and binding order. Bank is now directed to transfer the specified amount to the court for payment to judgment debtor. What are the do's and don'ts? So, a bank must immediately enter the date and time of receiving the order in the system. As soon as the order received, all payments, withdrawal, check, clearing from the account must be stopped. The customer must be notified about the garnishee order, and to avoid any kind of uh, accidental transaction, the blocked amount should be shifted to a suspense account or otherwise clearly blocked in the system. If account has less than what the court has asked, block whatever is available. If the court hasn't specified any amount, then you have to, as a bank, block entire balance. And account and executor or administrator's name cannot be attached if the order is in individual's name. If a check is presented after the order received, it should be returned with the remark refer to drawer. Right of set off. So if the customer already owes money to the bank can adjust its dues first before freezing the account. This must be informed to the court. Money deposited after the order is received, so it cannot be attached. But if there is a special agreement allowing withdrawal of uncleared funds, then they can be attached. And the account is in joint name. It is held jointly by a husband and wife, and the order is only in one name, then that joint account cannot be attached. But if both the names are mentioned in the order, then not only joint account but their individual account can also be attached. Trust accounts cannot be attached if the customer holds the money as a trustee. Partner's personal account can be attached for the firm's debt since partners are jointly liable, but the firm's account cannot be touched for individual debts of the partner. When we talk about liquidator's account, so if the company is under liquidation, the liquidator's account cannot be attached because the money belongs to the creditor and not to the company. What if the customer's name is misspelled or unclear? Then the account cannot be properly identified and the bank can ignore the order until it is corrected. The customer has both debit and credit accounts in the same branch. Only net credit balance can be attached, and bank cannot adjust credit balance for possible future liabilities of the customer. Keep that in mind. An account maintained outside India, they cannot be attached. Then there are other attachment orders like income tax department, GST authorities. So beside court, government authorities like GST authorities, ED, income tax, provident fund, they can also issue attachment orders to the bank. And for example, if person has not paid an income tax of 3 lakhs, the income tax officer can ask the bank to freeze his account and pay that amount. Income tax officer can write to bank asking it to pay for the customer balance either immediately or when the money becomes due in future. What should bank do? Again, a bank will follow the same procedure as the garnishee order. Bank will record the date and time, inform the account holder, and the funds are in fixed deposit. No premature withdrawal or loan against FD should be allowed. For joint accounts, the default exemption is both holders owe equal share unless proof otherwise. Submission of record to statutory authorities. So if a court or government authority asks for certain documents, then bank must submit original record if needed. Keep photocopies before submitting originals. Maintain a separate file for such notices. Keep the acknowledgement received from authorities safely. And when originals are returned, then put them back to in its official records. So let's begin our today's class. Banks carry out many important functions at their branches, and the main activities include handling cash, collection instruments like check, draft, sending money to the customers. And let's understand it one by one. When I say cash transactions, every bank branch deal with cash daily, like cash deposits, cash withdrawals. Handling cash involves keeping it safe, moving it between branches, avoiding fraud or theft. For example, a customer withdraws 20,000 from a bank counter. The branch needs to ensure that the cash is counted, recorded, and securely given. Sometimes banks do not allow cash deposits at the counter and only accept cash through ATMs. So this is not a good practice because one of the basic functions of the bank is to accept deposit, and the RBI has specifically instructed banks not to follow such restrictions. Number two, collection of instruments. Customers deposit instruments like checks, demand draft, pay order, dividend warrants, tax refund orders, NSCs, fixed deposit receipts. Suppose a customer receives a dividend check from a company. Now, the customer deposit it in his bank account, and the bank will collect the money from the company's bank and credit the customer account. Earlier, clearing houses where checks from different banks were processed were managed by RBI or SBI. Each bank had an account at the nodal branch that managed the clearing. Now, to make check collection faster, speed clearing was introduced using core banking solutions, and this allowed faster processing without physical sending the check to another city. Um, in the front office of a bank, many cash and check transactions happen every day. So the bank staff must know correct procedures and use software systems, as most manual registers are now replaced by IT systems. So if a check is deposited, the staff should know whether it should be cleared locally or sent for collection. Now let's move on to check truncation system. Who introduced it? RBI introduced CTS. Why it has been introduced? Now CTS stopped the physical movement of checks between banks. Instead, only the electronic image of the check is sent for clearance. And the system became fully operational in 2008, and MICR based processing was stopped. So the truncation, this particular word truncation means stopping the physical movement of check, and instead the bank scans the check, generates an electronic image of the check, and that electronic image is sent to the paying bank through the clearing house. And now suppose you deposited a check. So this particular gentleman, consider him as you. So you deposit a check of, say, sum of rupees 10,000. All right, and this check is from another bank. Instead of sending the paper check to the bank branch, you send the bank sends its scanned copy with necessary details electronically, and this scanned check is now known as, so this scanned check is known as truncated check. And where do you find the reference? In section 6 of the Negotiable Instrument Act. Let's understand the key features of CTS. So in CTS, it's a scanned image of a physical check. Only the electronic image is now transmitted instead of a physical check. Only banks or the clearing house can scan a check. So it's not the drawer, not the drawee. Customer cannot just scan a check and send it. No, it's the responsibility of the bank or the clearing house to scan the check or make it truncated. After scanning, the paper check is not used any further. It is stored and it is not destroyed. Keep that in mind. Scanning happens during the check clearing process. The physical check is stored safely by the bank that scanned it, and digital signatures on the scanned check is added, although it is optional. But for security measures, digital signatures are added. What are the benefits? So CTS benefits two parties, bank as well as customers. First, with respect to bank, there is no need to physically move checks. So it saves time, it saves cost, less manpower and machines are required. So now there is no MICR encoding. So therefore, it saves the cost. There is no risk of loss or tempering of check in transit, because now we are remitting, we are transmitting the electronic image of the check and not physical check. So there will be no loss during the transit. It's easier to reconcile as image and data travel together. It is centralized and secured processing happens across the locations. So a bank in Delhi, say, receives thousands of check daily, and with CTS they can send all images electronically to the clearing house. This reduces their workload as well as risk. Now with respect to customers, with respect to customers, it the checks now clear faster, so there's faster clearing time. Chances of losing the check has been reduced. There are no geographical limitations now. Uh, the process of CTS is same for local or outstation checks. and there are no extra charges for clearing outstation checks in the same CTS grid. Earlier, say depositing a check from Mumbai in Delhi would take 3 to 4 days to clear. Now with CTS, it gets cleared in one day without any extra charges. So there are no extra charges to it. Approach to CTS, the check truncation system, we all know it. It means checks are cleared electronically. Why am I emphasizing it again and again? Because it's quite important for you to understand this term truncation. Until and unless you don't understand what happens in this process, you will not, you know, able to digest whatever we are talking about. So check truncation system means checks are cleared electronically. Only scanned images and data are sent and not the physical check. And in India, this CTS is divided into three zones called grids. And there are three grids: northern grid, western grid, and southern grid. Now, northern grid is headquartered at Delhi, western grid at Mumbai, and southern grid at Chennai. It's important from your exam point of view. Each grid has a clearinghouse which handles check processing for cities in that region. And who can participate in CTS? So there are three type of members. There are three types of participants actually. So number one are member banks. They are directly part of the clearinghouse. Number two, sub-member banks. They participate, but they participate through a member bank. And then there are indirect members. They go through a member bank, but have a separate settlement account. So if a small bank in Punjab is not a direct member of a clearinghouse in Delhi, it can send checks through a bigger house, say like SBI, acting as its member. How it works? Bank scans the check, create a digital file with check image and MICR data. This file is sent to the clearinghouse using clearinghouse interface or DEM, which stands for data exchange module. Only checks drawn within the same grid are treated as local checks, and they are cleared on T+1 basis, that is next working day. So a check from Jaipur, Rajasthan deposited in Delhi will be cleared next day as both fall in the northern grid. And where these checks are scanned? So bank can choose centralized methods, one location scan for all branches, distributed method, each branch scans, or hybrid, mix of both depending on technology and geography. Now let's understand the CTS process flow. So firstly, there is a presenting bank. So this is the bank where check is deposited. So this is a bank where check is deposited. It scans the check and capture data from the MICR band. It consolidates all data city-wise, then send it to the clearinghouse. So if you deposit a check in an HDFC bank branch in Surat, so HDFC bank will scan it and send it to the Mumbai clearinghouse, the Western Grid. Then there is presentation clearing. The clearinghouse receives data from all banks, calculates how much each bank has to pay or receive. It sends check, image, and data to the paying bank, the bank on which check is drawn. Then number third, there is paying bank. This is the bank where check issuer holds an account. It checks the image, processes payment, and send back a file listing checks that are unpaid if there is any. Then we have return clearing. If the check bounces, say due to insufficient funds, that info is sent back through a return clearing session. This happens the next day of the original presentation. Settlement, once both presenting and paying bank finish the part, the clearinghouse calculates the net position for each bank, and banks have to keep enough balance in their RBI account for settlement. Say if SBI has to pay 2 CR and receives 1.5, it pays only the difference, that is the 50 lakhs. So this is settlement. This is the net position for SBI in this particular example. Clearing cycle, so one cycle per day, which consists of presentation clearing and return clearing. This cycle is complete when both these sessions are completed, are done. Security features. So CTS uses public key infrastructure to make sure all images and data are secure and no one can tamper with this data. Endorsement rules. Check endorsement. So when the check is scanned, a single line endorsement like a stamp is printed on its back with a unique ID. This act as proof that the bank has accepted and processed the check. If the check is returned and later represented, the new stamp must be at different spot. So bank may use stickers to avoid stamp overlaps. So this is about CTS process flow. Now let's talk about what is different for bank and what is different for customers. This is nothing but the responsibilities of customers and responsibilities of bank. So a customer while writing a check has to ensure certain things like the customer uses only CTS 2010 compliant checks. So older checks may not be scanned properly and that is why they are not accepted. The customer, while writing the check, should use dark inks and write clearly. They fill the checks at one time using the same pen. So the customer should not use different pens for different fields. The customer should write the check properly. Amount in words should start right after rupees and ends with only. Amount in figures should be close to the box, ending with the symbol. Just a minute. So it should end with this. And strike off any unused space. The customer should sign neatly in the signature box. There should not be any type of overwriting or corrections, and they should not write in the on the MICR band, the bottom band. They should avoid writing on it. So this is used for data reading, and writing here may reject the check. What are the responsibilities of the presenting bank? The presenting bank also has to ensure that the checks are CTS 2010 standards. They are CTS 2010 compliant. They do proper due diligence as per section 131 of the Negotiable Instrument Act. They should check for signs of tampering or irregularities. They should verify that the check is filled correctly and clearly. They should check for alterations. If there's any doubt, the bank must reject the check. They should confirm the identity of the customers depositing the check. Ensure stamps do not hide important details like amount or signature, and they should make sure all important details are captured in the scanned image. And what are the common rules which are important from for both bank and customers? That the checks with overwriting or changes in key field like amount or name, they should not be allowed. So if there is any material alteration, uh, the check should not be processed. And the checks that do not follow CTS 2010 standards, they should not be allowed. They should not be processed or cleared. CTS images. Each check has three scanned images: front in grayscale, front in black and white, and back in black and white. So the image is digitally signed by the presenting bank right at the start. Images go through rigorous quality checks, and if the paying bank doubts the image, it can ask for physical check. Security and authenticity must be maintained using public key infrastructures, which is a strong digital security system. Positive pay system. It started from 1st January 2021. Okay. So it started from 1st January 2021, introduced by RBI for extra safety for high value checks. And how does it works? The person issuing the check shares check details like amount, pay name electronically via SMS, app, internet, or internet banking with the bank. These details are matched with the actual check, and if there's any mismatch, CTS flags it and the check may be stopped. It is recommended for checks of 50,000 and above. and it is mandatory by banks for checks above 5 lakhs. For 5 lakhs and above, it is mandatory. Only compliant checks are eligible for dispute resolution, and banks must educate customers through SMS, branch display, website, and internet banking. What are RBI guidelines on collection of instruments? Let's understand this. So earlier RBI fixed rules for check collection, like how quickly bank must clear local outstation checks, when to give immediate credit, and how to compensate if there is any delay. But now RBI has removed these fixed rules, and it is on the bank's discretion to create their own check collection policy. So each bank's check collection policy should include immediate credit for local and outstation checks. For example, if I deposited a check of 10,000 from another city, will the bank credit it immediately or wait for clearance? So it should be mentioned in the policy. The time frame for collection, how many days will the bank take to clear a check from my city or another city? Interest for delay. So if it takes more than the time promised, what interest will bank pay to me? So these should be covered in the policy. And what banks must ensure in their check collection policy, that it should be clear and transparent. It should aim to reduce the time taken to clear the checks. It should protect the interest of small depositors. It should make sure that the policy matches with their deposit rules. If delay happens, interest should be paid automatically. The customer should not ask for the interest, but the bank will pay it automatically. And if no specific date is mentioned, then the bank should pay savings bank account interest rate for the delay. Collection for account pay checks. So RBI says account pay checks must be credited only to the named person's account. This is to follow the law under Negotiable Instrument Act 1881, Section 131, to avoid fraud or mistakes and keep the banking system trustworthy. So if a check says pay to Ravi Kumar account, pay only, bank cannot credit this check to anyone else's account even if requested. And if pay wants to deposit it elsewhere, then the bank should ask for a new check or ask the drawer to cancel the account pay instructions. Now there are some special cases. Some members can deposit such checks through sponsor banks only if they give written confirmation that the money will go to the correct payee. And checks of cooperative societies up to 50,000 can be collected in the society's account if the payee is a member of society, and society gives a written permission, written promise that money will go only to the member's account. And the same rules apply for draft pay order and banker's check. What is the validity of the check? So earlier these are valid for 6 months, but from 1st April 2012, from 1st April 2012, the validity has been reduced to 3 months. So now the validity is 3 months. What about loss of check in transit or at bank? Sometimes checks get lost during transport or processing. RBI has laid down rules to protect customers. There are some guidelines, like the bank should inform the customer immediately so they can ask the drawer to stop payment and avoid issue. If say my check of 50,000 is lost, the bank should call me so I can alert the person who gave me the check. The bank will be responsible for the loss and not the customer, and that is why bank must reimburse expenses for any duplicate check charges and pay interest for delay. If check was lost at the paying bank, the bank that was collecting the check can recover the loss from the paying bank. Bill for collection. If a bill here means bill of exchange, needs to be collected through another bank, it should be sent directly from the sending office to the receiving bank's office and not via another branch. Interest for delay in bill collection. If a bank takes too long to collect a bill, it must pay extra interest to the customer. And what interest will it pay? 2% above the savings bank interest rate. So if the savings bank interest rate is 2.75%, then the bank will pay 4.75%. Now, how this delay period is calculated? So, what is normal time? Normal time is 2 days for each of the process, 2 days to dispatch to send the bill, 2 days to present the bill, 2 days to send money back, and 2 days to credit it. So, if there is any delay beyond this period, beyond this time, then it is bank's fault and the bank must pay interest. If the delay was caused by another bank, the customer's bank can recover that amount from that bank. Cash and its custody. So, as a general rule, the main cash and coins of the branch must be kept inside this strong room, and this cash is kept under joint control of two people, usually the head cashier and the branch manager. If the branch has a currency chest, it is also under the joint charge of two authorized officers. Just like a bank locker needs two keys, one with you and one with the bank, cash storage also requires two people to open it. And only the cashier or teller is allowed to take money directly from the customers. Proper signboards in Hindi, English, and local languages must be put in saying please hand over the cash only to the cashier and no other employee. Note counting machine should be available at tellers' counters to avoid mistake and for customer satisfaction. Strong room and safe. The strong room or safe can only be opened when both the head cashier and the manager are present. Inside the strong room, there may be several boxes or containers. All of these must be under joint custody except one small box used by the cashier during the day, which can have a single lock. Bank's cash balance. So most of the bank's cash is inside the strong room under joint control. A small portion called cashier's hand balance is kept outside for the daily use. Only the required amount is taken out in the morning and it is kept with the cashier. Notes of 100 or above, they are counted personally by the supervising officer. For other notes, the clip system is used. A few notes on the top of each bundle are clipped and counted. Another staff member counts the rest, and the officer checks the total using the clip notes. For example, if there are 100 notes in a bundle, 5 are clipped on top. The officer checks these 5 while another employee counts the remaining 95. And notes are sorted into three types. Number one is issuable. These are clean notes. Then soiled notes, which are dirty or old notes. And then there are mutilated notes, which are torn or damaged notes. And at the end of the day, officer checks if the cash balance matches with the cash book. He also checks the loose notes and loose packets with the cashier and signs the cash book. Before closing the strong room, both officer and cashier verify the bundles with the reserve cash register. This is called a gross check. And once a week, a surprise check of the entire cash of the branch is done and it is recorded. How do we deal with cash shortage or um, excess of cash? So how errors are tracked? So each deposit slip or withdrawal slips records the denomination wise number of the notes. These details are also entered in the cash register and the branch cash balance book. This system helps trace where the mistake happens if cash is short or cash is extra. And if there are any shortages, then the amount is recovered the same day from the cashier or staff responsible for it. If recovery is not possible immediately, the amount is put in a suspense account and a report is sent to the head office and the staff signs the voucher as confirmation. Now, what happens if there is extra cash? So this extra amount is credited to sundry deposit account on the same day. If a customer later complains that he got less cash or he gave more cash, then the bank agrees after checking and then the bank will pay or adjust using sundry deposit accounts. So, for example, if rupees 500 extra is found in the drawer, it goes to this separate account, sundry deposit account. And if a customer says he gave 5 extra by mistake, then the bank will verify and If it is verified, then the bank can return that amount to that particular customer. Cash remittance, how cash is sent between branches. So when we say remit means you are sending from one place to another. Cash remit, you are sending cash from one place to another. So only authorized employees should be given the job of transferring cash. Night journeys or stopping midway, they should not be allowed. Cash should be sent in a van provided by the bank, and the cash box must be changed and locked securely inside the van. A proper register must be maintained showing cash sent and received between the branches. Cash replenishment at ATMs. To ensure that the customer never face a no cash situation at ATMs, banks must refill cash regularly, but this has to be done carefully and securely. So every bank follows its own cash filling policy and security steps. The staff who handle cash, they are thoroughly verified and their photos and fingerprints are recorded. Cash is loaded in the ATMs called a bin filing in the presence of at least two people to ensure safety and avoid mistakes. And after filing, a user report is prepared. The log of when ATM was opened and it is saved. A receipt showing cash balance is printed. And if there is any cash shortage, it is investigated by checking the ATM machine report and server data. Now, a center team keeps track of the cash balance in ATMs and compares with the record. One thing which has to be ensured that there is insurance cover for cash inside ATM and cash in transit. And if a bank hires another company to manage ATM cash, if the bank outsource it, the company pick up cash from designated bank branches. The reconciliation, that is matching of the transactions between the bank and company, must be done within 3 working days. So it is T plus 3. And if any dispute arises, ATM CCTV footage can be used to resolve the dispute. Insurance. Bank insures cash to protect against theft or loss. All cash in transit being carried to or from the ATM is insured under a blanket insurance policy. There is a maximum limit per trip, and that maximum limit should not be exceeded at any cost. Cash inside the bank safe or on counter should always stay within insured limits. If the branch has more cash than insured, then it's risky, so extra care must be taken. Custody of keys. It is important keys in the branch like keys of safe, locker, cash drawers, and they must be handled with extreme care. All original and duplicate keys are recorded in a key register along with who holds them. The main keys must never leave the person assigned to them except when they are ill or unavailable. And if unauthorized people have earlier used any safe, then the locks must be changed. If key is damaged or worn out, the bank must be informed and a new lock should be ordered. No unauthorized duplicate keys or lock repairs should be done without the head office permission. And if any repair work is taken under, then it must be done under the supervision of the branch manager and cash officer. And whenever a lock is changed, it must be noted in the key registrar. Duplicate keys. Duplicate keys of safes, lockers, and cupboards. They are stored securely using some steps like officials will seal their duplicate keys in strong cloth lined envelope. These sealed packets are kept in a box, a wooden box or a metal box, which is wrapped in waterproof cloth. This box is stored at another branch, either of the same or another bank. The instructions for safekeeping, they are signed by the managers and cashiers. The branch holding the box also receives a letter with the delivery instructions, which should be signed by all key holding officials. Duplicate keys are checked and they are rotated once a year. If the original keys cannot be handed over, only then duplicate keys will be used, and uh, the duplicate keys should be returned and must be reported to the head office. Let's talk about the security measures at bank branches and ATMs. Banks handle public money, so they may face security risk like theft, robbery, fire, fraud. ATMs too are vulnerable. They can be broken open or card data can be stolen using skimming devices. And to protect people and property, bank must follow some safety guidelines. Let's start with location and layout. So branches should be located in safe area. Bank should not be opened in a say crime prone area. Police should be consulted before choosing a location. Bank should note the proximity to a police station, and a working phone line must banks must have. The branch layout should allow security visibility. For example, the manager's cabin should be near the entrance to watch people coming. Cash counters should be far from main entrance, and the safe rooms, the strong rooms, they should be hidden from the public. Protective fittings, so shutter gates and collapsible gates with chains should be at the entrance to control the access. Grills should be fitted on windows and ventilators. Then cabinets should be locked. Cash cage should be made of strong grills, and they should have automatic locks. The weak points like air ducts, skylighting, they must be covered with steel or reinforced cement concrete. Electronic gadgets. So all branches and ATMs must have electronic gadgets like CCTV cameras, electronic locks, emergency alarms, hotlines to police, motion sensors, and emergency lights and sirens must always work. Fire safety branches should ideally have two entrances for emergency exits. Fire extinguishers must be placed properly and refilled regularly. Banks should install smoke detectors and alarms, and fire drills must be conducted to train the staff. Security guards, the number and types of guards should depend on the risk level of the area. So, currency chest branch should always have two armed guards during working hours and one armed guard around the clock, even at night. That one security guard with working gun should be there, one armed guard should be there, and the guard's background must be checked thoroughly, especially uh, if he's an ex-serviceman or not. Firearms management, so gun must always be in working condition, and they should be cleaned regularly, and the expired bullets should be replaced with the fresh ones, obviously after getting permission. Currency chest security. So these are high risk zones and needs extra security. Steel barricades should be there to control the entry, separate area from the main banking hall. Guards should be placed strategically so they cannot be easily overpowered, and emergency alarm switch must be within the guard's reach. Police coordination. So branch manager should stay in touch with the local police, and they can ask police to monitor suspicious persons or areas with a high crime rate. Uh, Handling large cash. Large cash payments should be made inside safe enclosures, which should be away from public. Cash movement should must be kept confidential, and no fixed route or time should be followed while moving cash to avoid the risk. Operational safety. A marked set of new currency notes should be kept and recorded. These should help in tracing robbers if the cash is stolen. Our lights should always stay on even after working hours to detect any unusual activity. System must always be ready for emergency responses, and if someone suspicious is seen, then it should be informed to the police immediately. Fake note detection. All notes received at the counter or in bulk must be checked using the machines, and fake notes should not be returned or destroyed. They must be stamped counterfeit. They should be impounded, recorded and kept separately, and should be reported to the police. Acknowledgement slip should be given to the person who submitted them, even if they refuses to accept the slip. Then also acknowledgement slips are issued. So if a customer deposits six fake notes, then the bank must file FIR. So incident reported to the police. So if the notes are five or more, then there should be immediate FIR. And for 1 to 4 counterfeit notes, a monthly report is sent to the headquarters. These reports are also sent to the forged note vigilance cell. And if there are any soil notes, so soil notes, mutilated notes, defective currency, they can be exchanged at any bank branch during the working hours. So usually a bank account is operated by an account holder, the person who opened it, right? However, sometimes the account holder may allow someone else, like a family member or a friend, to operate the account on their behalf. But this is done using a legal document, which creates a spatial relationship between the banker and the customer. Um, this spatial relationship can be created by a mandate, number one, number two, by power of attorney. So the question arises, what is a mandate? A mandate is a written instruction by the account holder that gives permission to another person to operate the account. For example, a person named say R gives a permission to person named Y. Now this permission, this written instruction given by R to Y is a mandate. Now, mandate is used when the account holder temporarily wants someone else to withdraw money, deposit check, make payments. And some of the key features of mandate are the account holder has to inform the bank in writing. Now, why bank will believe that why has the authority to withdraw the money, to deposit the check, to make the payment? Because R has specifically informed the bank in writing about this mandate. The signature of the person is verified by the account holder. It is mandate is usually for a short period of time, and organizations or companies cannot issue mandate. They have to use power of attorney, and the mandate ends when account holder dies, becomes mentally unfit, or goes bankrupt. Now let's talk about power of attorney. Um, if you want another example on mandate, let's discuss one more example. Then we'll move forward to power of attorney. Say if Mr. S is traveling abroad for 3 months. Now, what he can do, he can give a mandate to his son to operate the bank account and pay household bills. So, by this manner, the mandate will work. Power of attorney. A power of attorney is a legal document where one person, called the principal, authorizes another person, called the agent or attorney, on to act on their behalf. Now, there are two types of power of attorneys. Number one, general power of attorney. Number two, specific power of attorney. General power of attorney gives broad powers, like opening account, signing checks, selling property, etc. A specific power of attorney limits to a specific task. As the name suggests, it is for a particular purpose or transaction. Specific tasks like selling a house or managing one bank transaction or another. Now, what are the key points about power of attorney? It gives legal authority to act in various matter. It must be notarized, meaning to say it must be signed in front of a government official or notary. The power of attorney holder must sign as per pro on behalf of say Mr. X, HD constituted attorney, and the principal can cancel this power of attorney at any given point of time. The power of attorney also becomes invalid when the principal dies. When this principal dies, goes insane, or is declared bankrupt, similar to mandate, right? Now, let's take example. Company director gives a general power of attorney to the company secretary to manage all bank related tasks, sign checks, or attend meetings on his behalf. So, in this manner, power of attorney will work. Now, you have to remember that a company cannot issue a mandate. A company can use power of attorney. Let's talk about declaration of powers with respect to mandate slash power of attorney. Now, joint account, all account holders must sign the mandate or power of attorney. With respect to partnership firm, all partners must approve the mandate or power of attorney. With respect to companies, only authorized person as per board resolution can give power of attorney if they are allowed to do so. Legal guardian or executors like fiduciaries, they cannot appoint someone else unless clearly allowed. If multiple agents are authorized, the bank must receive the clear instructions for multiple agents. Clear instructions should be given, should be stated whether agents can act individually or jointly. Bankers lien. So let's talk about some of the banks, right? A lien. What is a lien? A lien means the right to keep someone else's property until the person repays the loan or clear dues. In banking, a banker's lien means the right of bank to hold or even sell the customer securities or goods to recover its dues. Now, why it is also known as implied pledge? It is treated as an implied pledge. Why? Because even without an express agreement, the bank can act as if the customer has pledged the assets. Now, let's take an example. If a customer, say a customer, takes a loan and gives fixed deposit receipt to the bank, FDR, fixed deposit receipt, or shares as security to the bank or any kind of security to bank. Now, if this loan has not been repaid, the bank can sell the securities to recover the money, the loan amount. There are two types of lien. We'll talk about exceptions later. Yeah, there are two types of lien: general lien and particular lien. In general lien, the bank can retain any assets of the customer until all dues are paid. Example: bank holds FD even if not linked to a specific loan. What is particular lien? The bank hold property only related to the particular loan or transaction. For example, if gold is pledged for a loan, the bank can keep the gold until that specific loan is repaid. Now, where this lien can be used? It can be used for goods received in normal course of business, goods received in the normal course of banking. This is one. Secondly, this should not be used for any special purpose for which goods are mentioned. There should not be any agreement between the customer and the bank. There should no agreement stating that lien cannot be used. Stating what? That lien cannot be used. And number four, goods held in the same capacity as the account. Now, what are the exceptions where bankers' lien cannot be used? Number one, if articles are kept only for safe custody. So, if gold is put in the locker, bank cannot use the lien. Documents given for any specific purpose. So, if there is any specific purpose for which documents are given, then also bank cannot use lien. If things are left by mistake, for example, a person visited the bank, he has a file with him in which the life insurance policy documents are there, share certificates are there. So, and he left it mistakenly in the bank premises. So, the bank cannot use those policy documents or share certificates. So, articles left unintentionally are not subject to banker's lien. If the loan has not been matured yet, the banker's lien cannot be exercised. For stolen goods, a bank cannot claim lien on such stolen goods. And if bank has a right of set off, then lien cannot be applied at the same point of time. Now, we were talking about set off, so let's understand what is a set off. So, set off means adjusting money a customer owes to the bank using the money the bank owes to the customer. Okay, let's simplify it. If you have two accounts in the same bank, one has a loan, you owe money to the bank, and one has a deposit. So, if a person has a loan account, what does it imply? That he or she owes money to the bank, and if he or she has a deposit account, what does this imply? That bank owes money to this customer. And now, if you have two accounts in the same bank, one loan account, number two deposit account, the bank can use the deposit account to reduce this loan. Say you have savings account of 20,000, you are money with the bank, a loan account with an unpaid amount of 15,000. Now the bank can use the 15,000 from your savings account to settle the loan. So this is called set off. What are the conditions for set off? Number one, it can be based on law or agreement between you and the bank. The bank should normally inform you before using set off, unless it is automatic. There must be no agreement that removes the bank's right of set off. The bank and you must owe each other definite. There must be a certain amount. Bank cannot use set off for unknown or future liabilities like guarantees not yet triggered. If the account is under the trust, the bank cannot use set off against your own loan. Keep that in mind. And the bank cannot mix your account with an account of deceased person for set off. Let's talk about the term we have just introduced, automatic set off. So when does it happen? So for automatic set off, generally no notice is required to be given. So when does it happens? When the person dies, when the customer dies or becomes insane, when the business is declared insolvent, when bank receives a court order, when bank is told that someone else has right over the customer's money, then automatic set off works, and when mortgage assets become due. And who cannot use this set off? When can bank cannot use this set off for trust account amounts, for any future dates or uncertain amounts, or there is a credit in another branch. So bank cannot use set off for this. So branches are one unit for bank, but not for customers. Okay. Let's move on to the last right of appropriation. What does we understand by right of appropriation? When a customer pays money to the bank but has multiple loan accounts, multiple loan or accounts, the question is which loan or account should the payment be applied to? For example, say you have two loans, one personal loan, one car loan. You deposit 5,000, personal loan for 10,000, say, and car loan for 5,000 only. You deposit 5,000. Now the question is to which loan this amount should go, right? Whether it should be applied to personal loan or car loan. Now there are three scenarios for it. Say customer say clearly, now you tell the bank that this 5,000 is for the car loan. Now the bank must use it for car loan only. When you don't give any instruction, meaning to say when customers gives no instruction, in that case the bank can choose to use the amount for any loan, like the older one or higher priority one. When neither says anything, the law says the money should go to oldest date first, and if dates are of same age, then it should be split equally. There's a famous case, Sarewal Industries versus Odisha State Finance Corporation case, 1985. In this, the court stated that if there is no agreement, the bank will use the payment to pay interest first. So the question was whether to pay the interest first or the principal, or whether they should be paid off simultaneously. What should be the scenario? So if there is no agreement, the bank will use the payment to pay interest first and then the principal amount. Why there was a need for foreign exchange? So one of the main reasons the world has grown economically is because countries trade and persons travel with each other. When businesses and people from different countries deal with one another, they use different currencies. So there has to be a system to convert one currency into another currency. For example, if someone from India wants to buy goods from the US, they'll need to pay in dollars. And that's where foreign exchange comes in. It's a system that helps convert currencies, making global trade and travel possible. But here's one thing, not every country has the same amount of foreign exchange like US dollars or euros or Kuwaiti dinars. So each country has to manage its foreign exchange carefully. And in India, this job is done by the Reserve Bank of India. The RBI makes sure there's a proper system in place to handle the exchange of currencies and support both businesses and personal needs. Now let's move forward to evolution of FEMA. Now after independence, India didn't have much foreign exchange. So India didn't have much foreign currency. So it was considered precious and limited. So strict rules were made to control its use. And when we talk about the timeline, in 1939, during World War II, India started controlling foreign exchange under special defense rules. So there were special defense rules. And then in 1947, there was a law called FERA, Foreign Exchange Regulation Act. It was introduced to strictly monitor foreign currency uses. And again in 1973, so in 1939, we have special defense rules. In 1947, so FERA actually originated in 1947 with a base of 1939 rules. So in 1947, FERA came into force, and in 1973, a stricter version of FERA came into force. However, over time things changed. Indian economy started opening up and global trade increased. So a more flexible and business-friendly law was needed. That's why in the year 2000, FERA was replaced by FEMA, Foreign Exchange Management Act. And what was changed? So, under FERA, breaking foreign exchange rules was a criminal offense. It was a crime. But under FEMA, it is treated as a civil offense, like a rule is violated, but nobody has committed a crime. So, you will not put a person behind the bars, just like in a criminal offense. So, in FERA, it was a criminal offense, and in FEMA, it became a civil offense. FEMA made foreign currency dealing easier, especially for businesses doing international trade. Why managing foreign exchange is important? What is the need for this management? So, the foreign exchange market. So, what's the need? So, the foreign exchange market is the largest and fastest moving market in the world. It is activated 24 into 7 and it's very competitive. While this brings opportunity, it also brings risk. For example, if the value of rupee falls suddenly, it could increase the cost of imports, right? So India needed to keep enough foreign currency reserves to avoid problems during emergencies and focus on exporting more goods to earn foreign currency. This is a shift from the old strategy of avoiding imports to promoting exports. Now let's understand key features of FEMA. So FEMA was designed to support easier foreign trade and payments, and it is designed to support a smooth and well managed foreign exchange market. So what are the main features? Number one, the central government can make rules. The central government can make rules to control foreign exchange activities if needed. Only those approved by the RBI, known as authorized persons like banks, licensed dealers, they can carry out foreign exchange transactions. And sending and receiving money to or from someone outside India is restricted, and rules must be followed. Uh, People living in India cannot just go and buy property abroad freely. So it is controlled. If someone wants to receive money from outside or invest in foreign securities, they usually need RBI's permission. So RBI's permission is required. And with respect to current account controls, the central government can restrict spending in foreign currency under the current account. For example, for education, medical treatment, travel, if it is in public interest. RBI can place restrictions on capital account for investment loans to ensure economic stability. And if someone had foreign currency shares or property when they lived abroad or inherited them from someone who lived abroad, they can keep it even after returning to India. So these are some of the key features. Before moving forward to the definitions, let's take some examples to familiarize ourselves with this Foreign Exchange Management Act. Let's say Mr. R. Mr. R lived in US and he bought a house there. Later, he returned to India from US to India. Now, keep that in mind. He already has a house in US. And according to FEMA, Ramesh can still keep that house because he bought it while he was abroad. And now there's a person called P. Now, P wants to send money to his brother in UK to invest in foreign shares. Now he will have to follow foreign exchange management rules and he may require permission from the RBI. Now let's move on to some important definitions. Authorized dealers. So an authorized dealer is a person or company, usually a bank, that is officially allowed by RBI to deal in foreign exchange. For example, HDFC Bank, SBI, they can be authorized dealers. And in authorized dealers, we have three categories, category 1, 2, and 3. Now, category 1, these are the dealers, banks, or institutions that RBI allowed to do all type of foreign exchange transaction, both current and capital. So, SBI doing remittances and NRI account operations. So, SBI is AD category 1. AD category 2, these are institutions that are allowed to do non-trade related transactions like private remittances or travel related exchanges. And it includes upgraded money changers, some RRBs, some UCBs, urban cooperative banks. So they are included in AD2 category. AD3, these are businesses allowed by RBI to do specific foreign exchange transactions connected to their business. So a travel company allowed to accept Forex for booking tickets is AD category 3. So I hope authorized dealer is clear to you. Authorized person, so this is a broad term and it includes authorized dealers, money changers, offshore banking units, anyone else allowed by RBI to handle foreign exchange. Capital account transaction, so any transaction that changes ownership or asset or liability across countries is a capital account transaction. For example, an Indian buys property in US or an NRI invests in shares in India. So these are capital account transactions. Current account transaction, these are regular transactions like payment for business and trade, interest on loan or investment income, family maintenance, which is sent abroad, foreign travel, education, medical expenses. So these all are current account transactions or transaction which does not alter asset or liabilities of a person is a current account transaction. So sending money to a child who's studying in US. So in which category will you categorize this transaction? It will come under the current account transaction. Foreign exchange. It includes foreign currency, deposits and credits in foreign currency, checks or letter of credits drawn abroad but payable in India, and checks drawn in India but payable in foreign currency. Foreign portfolio investments. So investment made by a person outside India in Indian shares or securities, which is less than 10%. So we'll categorize it as foreign portfolio investment. Not permanently resident. Someone staying in India for a specific job or time, which should not be more than 3 years. So they are not considered a permanent resident and they are known as not permanently resident. NRI, an Indian citizen who is living outside India. So a person is living outside India, but he's a citizen of India. He is known as non-resident Indian. Overseas citizen of India cardholder. So a foreign citizen who earlier was Indian or has Indian ancestry, say his parents were Indian or grandparents were Indian, or he or she is married to an Indian, is an overseas citizen of India. Please note, citizen of Pakistan and Bangladesh, they are not eligible for overseas citizen of India cardholder. PIO, person of Indian origin. So he is a person who is a resident of foreign country, who is a citizen of foreign country. Again, excluding the citizens of Pakistan and Bangladesh, and who was an Indian citizen earlier or has Indian heritage. So his parents, grandparents, great grandparents were Indian citizens. So this person is automatically a person of Indian origin, or he or she is married to an Indian. So we'll call them as person of Indian origin. So what's the difference between an NRI and PIO? So NRI is a citizen of India. PIO is a citizen of foreign country, not India. He resides in a foreign country. He's a citizen of foreign country, but again he has Indian heritage. Person resident in India. So a person who stays in India for more than 182 days in the previous year is known as person resident in India, but it excludes those persons who have gone abroad for a job, business, or a stay which is indefinite period of time. It is not certain when they will return to India, and the person who have come to India for a temporary basis, so they are not person resident in India. But person resident in India also includes a company which is registered in India, an Indian office of foreign firms, or foreign offices of Indian firms. They are included in the definition of persons resident in India. Remittance of assets. So sending money outside India from bank deposits, sale of property, PF or superannuation, insurance maturity, shares or other assets. If it is done legally under FEMA rules, so it is remittance of assets. Remittance is sending money from one place to another place. So when you send money outside India from your bank deposit, sale of property, PF, superannuation, insurance maturity or shares, it is it falls under the ambit of remittance of assets. Bringing foreign exchange to India. So any person, whether a resident or a non-resident, can bring foreign exchange into India without any limit. But there are certain rules attached to it. So a person has to declare his or her foreign exchange to customs by filling currency declaration form. If he or she is carrying more than 10,000 US dollars in cash plus traveler's check, or he or she is carrying more than 5,000 US dollar in foreign currency notes. Otherwise, currency declaration form is not required. For example, if a person comes from US and he brings $15,000, so here this person should declare this currency by filling out currency declaration form. Purchase of foreign currency from publics, bank and their agents, authorized persons mainly, so they can freely buy foreign currency from residents or non-residents. But there are important rules. If someone declare foreign currency at arrival, the bank must ask from that form, like currency declaration form, while buying it. And banks can give cash in INR for small transactions. Who can sell? So resident Indian can sell up to USD 1000, and non-resident or foreign visitors up to USD 3000. For example, if a US tourist gives the bank USD 2000, the bank can give them equivalent Indian rupees in cash if it's within the limit. Foreigners can also buy Indian rupees using their international credit or debit cards. And if the transaction is large, the Indian rupees will be given via check, draft, bank transfer. or debit card. Uh, there are encashment certificates. It is given when foreign currency is converted to INR, and it is required if a foreigner wants to reconvert unspent Indian money back into foreign currency. For example, a person came to India with, say, 5,000 US dollars. Now, he converted 2,000 or 3,000 US dollars into INR, but he only spent 1,500 INR, $1,500 worth INR, and 1,500 dollars worth INR is still left with him, and he is going back to US. Now, what will he do with this INR? So he wants to reconvert this unspent Indian money into dollars. At that point of time, he needs to give that encashment certificate, which was earlier given to this foreign tourist taking foreign exchange out of India. So foreign exchange cannot be taken out of India unless it was obtained legally from an authorized dealer, or it is allowed by journal or special permission from RBI. A tourist who bought USD 5,000 can take back only that much if it was declared on arrival and converted with an encashment certificate. Reconversion of Indian currency into foreign currency. A foreign visitor leaving India can reconvert unspent Indian currency into foreign currency if they show a valid encashment certificate. But what if they misplace their encashment certificate? So reconversion is allowed without encashment certificate in two cases. Number one, where the INR is up to rupees 10,000, and if the authorized person is satisfied with the reason for not having the encashment certificate and the departure is within 7 days. So this is case one. And case two, a foreign tourist can reconvert up to 50,000 withdrawn from ATM if they show valid passport and visa. Number one, confirm air tickets and departure is within 7 days, and the ATM withdrawal slip, the original ATM withdrawal slip. In that case, they can convert INR, they can reconvert actually Indian currency to foreign currency without encashment certificate. Inward remittances. Inward remittance means money sent into India. The money is coming to India from a foreign country. An NRI working in Dubai sends money to his parents, say in dirham. So in Dubai, dirham is used. So he sends in dirham, converted into INR, received by parents. So this is an inward remittance. So the purpose is to support the family, support the business, or for investment. There are some general rules for inward remittances. So there is no restriction on how much money a resident can receive from abroad. Authorized dealers can buy draft, bill, other payment instruments in foreign currency from the public, and foreign exchange received must be sold to an authorized dealer within 180 days. And what happens if it is not surrendered within 180 days? It can be surrendered afterwards. But as a general rule, foreign exchange received must be surrendered within 180 days of its receipt. Now let's talk about some common methods of receiving money in India. So number one, there is bank transfer, bank wire transfer, in which there is a direct bank to bank transfer. It is most secure, most common. Bank money order, it works like a postal money order, but it is issued by banks. So postal money order uses postal services. Here it uses. So bank money order, it works like a postal money order issued by banks, and it generally takes more time. Foreign currency checks. So it is a check sent by post and deposited in the Indian bank account. It usually takes 20 to 25 days, but courier services can speed up this time. So it reduces the time. Foreign currency draft. Bank draft in foreign currency, it uses for businesses or payments to unknown person, and it usually take 21 days. Remittance cards. So they are reloadable prepaid cards in the name of the receiver. NRI loads money, receiver can withdraw from ATM in India. It is easy and cost effective. ACH transfer or direct deposit. So NRI authorizes their Indian banks to pull money from their foreign banks regularly. And it is good for regular family expenses. So is there any limit on inward remittance? What do you think? Will there be any limit? So no, there is no limit under FEMA. Anyone can send any amount to India either to their own account or their relatives. Uh, FIRC is a foreign inward remittance certificate. It is not required when NRI send money to relatives, but it is required if money is received for business purposes, mainly to claim tax benefits. Outward remittance. So money is going out from India. So when someone living in India wants to send money abroad for travel, studies, gift, or other reasons, it is called an outward remittance. Now, the rules for sending such money are guided by Foreign Exchange Management Act, especially the current account transaction rules 2000. So, who can release foreign exchange for the now? Who can release foreign currency? So, only authorized dealers, mostly banks or approved by RBI. They can release foreign exchange for such purposes, but the government has created three categories of current account transactions to control how much money can go out and for what purpose. So there is no limit for inwards, but again there is limit for outwards. Number one, schedule 1 transactions. So these are prohibited transactions. These are the transactions for which you cannot send money abroad under any circumstances. What falls under schedule 1 transaction? So sending money abroad for lottery winnings, for horse racing, gambling, for buying banned magazines, or to participate in lottery schemes, for paying commissions for export if it relates to setting up your own company abroad like a joint venture, if sending commissions under certain government sponsored export scheme except small amounts like 10% commission for tea and tobacco exports. If a person wants to pay for callback telephone services or sending interest earned from certain special NRI accounts, so it is prohibited. So, in short, if it's lottery gambling suspicious scheme, it is prohibited under Schedule 1. Schedule 2 transactions, these are allowed but only after you get permission from the right ministry or department of the government of India. For example, if the purpose is culture tours abroad, Ministry of Culture's approval is required for ad in foreign newspapers costing over $10,000. So, Ministry of Finance sending freight charges for chartering a ship by PSUs. So, Ministry of Surface and Transport for sending money to become a member of some club for for shipping insurance. So, again, Ministry of Finance approval is required. So, two transactions require prior approval of government. Then there are Schedule 3 transactions which are allowed by authorized dealers. So these are the most common transactions that banks can allow directly without any special government permission as long as they are within a limit. What is the limit? So USD 2,50,000 per person per financial year under LRS, it is the limit. For example, going on vacation abroad, sending gift or donation, going abroad for a job, shifting permanently abroad, sending money to close relatives, business travel, medical treatment, studying abroad. So these are scheduled here transactions. And what are the exemptions? Uh, so where can you exceed that 250,000 limit? So you can go beyond that 250 only in three specific cases: immigration, medical treatment, and education. So keep that in mind. And what are the exemptions from approval? So if someone has a resident foreign currency account or exchange earnest foreign currency account in India, they can use that money for permitted transaction, even those under Schedule 2 or 3 without needing government or RBI approval. And there's one also a special case which is worthy to discuss. So the people who are resident but not permanent resident. So these people live in India for work temporarily, like a foreign citizen working here or an Indian working for a foreign company's Indian branch for a short time, which is less than 3 years. Now they are allowed to send abroad their entire net salary after tax and deduction without any ceiling, because they are not permanently settled in India. Schedule 1 transactions 2, 3, we have already discussed these transactions. Also, one thing which needs to be discussed is if you are traveling abroad and you are using an international credit card, which is issued by a reputed bank, so you don't need RBI's approval for your expenses, even if they cross 2,50,000 mark. So this applies only if the card was issued by an overseas bank or an international agency. Keep that in mind. Fraudulent offers. So some fraudsters cheat innocent people by asking them to pay money like processing fees, conversion charges, tax clearance fees, by saying they will receive large funds later. And victims are tricked into depositing money in bank accounts in India, and that money is quickly withdrawn. So to manage this, banks must be very careful when opening accounts or allowing such transactions, especially when multiple accounts are opened in the name of different people or small firms for collecting these so-called charges, right? So for example, if someone tells you you have won a lottery abroad, but you must pay 50,000 for processing and ask you to deposit it in Indian bank account, so this is a fraud. All right. So be careful. Release of foreign exchange by authorized dealer category 2. So RBI has allowed some entities. So what are these entities? So travel agents, foreign forex service providers, basically authorized dealer category 2, to help people with foreign exchange for non-trade purposes. What are non-trade purposes? Going abroad for vacation, business travel, medical treatment. If a person wants to study overseas, for paying fees for global events, competitions, paying for exams like GRE, TOEFL, film shooting abroad, visa and immigration related services, or paying international membership fees. So these are non-trade related transactions, and here edit category 2 deals in this transactions. Medical expenses. So if a person living in India want to pay medical bills for their close NRI relative, now they can pay in Indian rupees. This is treated as a resident to resident transaction, and it is allowed. It includes payment for stay, payment for food, for travel inside India. So if your NRI brother visits India and needs hospitalization, you can pay for his hospital bills. Uh, Withdrawal of foreign exchange. So it is prohibited for. So schedule 1 transaction. So you cannot take foreign exchange from India for anything which is listed in schedule 1 to travel to Nepal or Bhutan, or dealing with people living in Nepal or Bhutan, unless RBI gives special permission. International credit cards. So you can use your ICC outside India, ICC's international credit card outside India or online for legal purposes, but it cannot be used for banned items like for lottery tickets, banned magazines, callback services, and there's no RBI limit on how much you can spend, but the card issuer again may set a limit. And people with foreign currency accounts in India or abroad, they can use ICCs freely, but this international credit card cannot be used in Nepal or Bhutan. And NRIs, PIOs can also get international credit card, but they must pay their card bills only through inward remittance or by their NRE or FCNR account. For example, a resident with a US dollar account can use ICC to book a hotel in Europe and pay from that account. So it is permitted. International debit cards. So these cards can be used only when traveling abroad. Payment and cash withdrawal allowed only for permitted current account expenses, and again they can also not be used for buying any prohibited items, which we discussed earlier. card payment for airline tickets. Some foreign airlines let you pay in INR, but processes the payment through a bank outside India. So this is not allowed under FEMA rules. And banks in India should inform airlines not to use overseas bank for INR payments. This has to be remembered. Store value charge or smart card. So bank can issue these cards to people going abroad for personal business trips, and they can be used for buying things for from shops overseas or for withdrawing money from ATMs abroad. But the usage is limited to legal and permitted current account purposes. Refund of unused foreign exchange and travel cards. So if a person has money left in his prepaid travel card, he can get it back, but after a cooling off period, which is 10 days from the last transaction. And the bank can deduct any unsettled authorized amount. A small balance can be kept, say up to USD $100 for pending transactions, and bank can deduct transaction fees. So if you return from a US trip and have say $300 left in your forex travel card, the bank will return your money, but after 10 days and after deducting if any payment charges and keeping a small buffer account. Liberalized remittance scheme, short for LRS. So the liberalized remittance scheme or LRS, it was introduced by RBI in India in 2004. Its current limit is 2,50,000, but earlier, initially the limit was 25,000 dollars only. So it allows resident individuals in India to send money abroad freely for certain purposes and without needing RBI approval. So who can use this? So LRS is available only to resident Indians, and it cannot be used by corporates, like companies, partnership firms, HUF trust. So they cannot use liberalized remittance scheme. It can only be used by resident individuals. Family members can combine the limit, but only if each of them meets LRS rules. For capital transactions like buying properties or share abroad, clubbing of limit is allowed only if family members are joint owners or they are co-investors. For example, if a father and son wants to buy property abroad jointly, they can combine their LRS limit. And what are the permissible amounts? Meaning to say how much can be remitted. As discussed, the maximum limit is USD 2,50,000 or 250,000 per person per financial year. So you can make any number of transactions as long as you don't cross this total limit. And if you want to send more than this limit, more than 2,50,000, RBI's prior permission it is required. And what are the permitted uses? What are the permitted purposes? Meaning to say, what can the money be used for? So LRS can be used for current account and capital account transactions. For current account transactions like travel abroad, gift and donations, if you want to study abroad, medical treatments, immigration, maintenance of close relatives who are living abroad, or for business trips. And for capital account transactions, opening a foreign bank account, buying property abroad, investing in shares, mutual funds, starting a business, or giving loans to NRI relatives. Uh, and what are the restrictions? So you cannot send money for margin payments or speculations, or you cannot give money to another Indian who has foreign account, or say any transaction which is banned under FEMA, it is also not allowed. And so you cannot send money to the countries which are blacklisted by FATF, or entities or people which are linked to terrorism as per RBI. So we have to keep this in mind. Of what are the conditions for specific purposes? So say private visits for tourism, USD 2,50,000 per financial year is permitted. it covers all travel costs like hotel transportations, and no forex is allowed for Nepal or Bhutan. For most countries, the cash limit is USD 3000. For Iraq and Libya, it is 5000 USD, and full amount in cash for Iran, Russia, or CIS countries. And for Hajj or Umrah, full cash as per Hajj committee rules. For gifts and donations, maximum you can gift is USD 2,50,000 a year. You can give to people abroad or donate to foreign organizations. For immigration, up to 2,50,000 or as required by the destination company. Extra funds are allowed only for settling in cost and not for getting immigration points. For maintenance of close relatives, up to again 2,50,000 annually. Close relatives which are defined under Companies Act. The limit is same for business trips up to 2,50,000. It includes training, conferences, apprenticeship, and if employer pays, so this is outside LRS. Medical treatment again 2,50,000 without estimate. More is allowed if the estimate is shown. So this limit can be crossed, and an attendant can also take up to 2,50,000. If studying abroad, up to 2,50,000 without an estimate, and more is allowed if you show university fees detail. So if it is required, more money can be remitted. What are the remittance modes? How can you send the money? So you can open and maintain a foreign currency bank account, or remittance can be done through demand draft, bank transfer, or other standard banking channels. And again, a self declaration by the remitter is needed for remittance. Prohibited transaction, we have discussed it a while ago. So banks cannot give loans to help people to send money abroad. So no bank can credit to fund capital remittances. Remittance listed under Schedule 1 or 2 of FEMA, they are not allowed. You cannot send money to FATF blacklisted companies or to group or peoples which are linked to terror activities as pointed out by RBI. And what documents do you need? So a person need to choose one branch of an authorized dealer, and that authorized dealer bank handles the LRS transaction. Form A2 needs to be submitted to buy foreign currency, and PAN number is provided for verification. Period of surrender of foreign exchange. So foreign exchange bought for a specific purpose can be used for any other permitted purpose later if not used for the original purpose. And if a resident individual receives or has unused foreign currency, they can surrender within 180 days. For example, if someone has bought USD 5,000 for studying in UK but didn't go, they can use that money for medical treatment abroad. Um, and so what happens if that 180 days are crossed? So even after 180 days, if the person comes to surrender the currency, the bank should not refuse just because the time is over. So if someone returns from the US, and after 200 days they want to deposit their leftover dollars, the bank must accept it. A returning traveler is allowed to keep up to $2,000 in the form of foreign currency or traveler's check for future use. Keep this limit in mind. Uh, this might be asked in your examination. Operational guidelines for authorized dealers, authorized persons. So what are the responsibilities of authorized persons? The bank must take declaration from the customer that the transaction is not illegal or violating any FEMA rules. Bank must collect proof or documents from the customer to be reasonably sure that no rule is being broken. Bank must keep all records, copies of all documents related to the transaction. If the bank suspects any violation or misuse, so they must refuse the transaction in writing and report to RBI. Bank must follow all income tax laws while allowing any foreign exchange transaction. Banks must strictly follow KYC and AML guidelines, and for capital account transactions like buying property abroad, the applicant should have had a bank account with the same bank for at least 1 year. And if the customer is new to the bank, the banks must do extra checks like asking for bank statement from another bank or income tax return to verify the source of funds. Payment for foreign exchange must come from the customer's own funds, either by check, account debit, demand draft, debit or credit card, or prepaid card. And bank must certify that remittances are not being made to or received from banned people or organizations. Again, no loans or credit cards should be given to customer for making capital account remittances. All remittances made under LRS, they should be reported to FETRS. So what is FETRS? Foreign Exchange Transaction Electronic Reporting System. And for remittances below 25,000 US dollar, banks can keep a dummy form A2, a basic record of Forex transactions. Uh, TDS on remittance to non-residents. So when sending money to someone outside India, banks must follow income tax rules and ensure that uh, TDS, tax deducted at source, is applied if required based on the latest Central Board of Direct Taxes instructions. Last topic of the day, Indo-Nepal Remittance Scheme. It was started by RBI in May 2008 along with Nepal Rashtra Bank. So it was designed to help Nepali migrant workers in India to send money easily and safely to their families in Nepal, and it uses NEFT system. So now National Electronic Fund Transfer is used in this remittance scheme. What are the key features? Um, the target group is Nepali workers in India sending money home, and it is only one-way remittance. So money goes from India to Nepal, not the other way around. Maximum limit per remittance is 2 lakh rupees. For non-customers or walk-in customers, the cash limit is 50,000 per remittance, and maximum 12 remittances per year are allowed. Money is sent in Indian rupees from India and given in Nepalese rupee in Nepal. It is available to both account holders and non-account holders. So how does it works? Remittances are processed through NEFT batches in Mumbai and they are routed through SBI's payment gateway made specially for Nepal. Money is received by the beneficiary through Nepal state bank branches or their approved agents. Banks must comply KYC and AML checks on the person sending the money. For cash transactions for non-customers, the sender must give valid ID proof and this information must be recorded. Addresses and mobile number of both sender and receiver must be recorded before the money is sent. Foreign Exchange Management Act empowers the Reserve Bank of India to make rules about how people living in India and those living outside India can maintain bank accounts and do foreign exchange transactions. Since many Indians live abroad and still have strong ties with India, they send money, invest, or keep accounts here. Now, Foreign Exchange Management Act allows special facilities to them. Who is an NRI, who is a PIO? So, NRI is an Indian citizen who lives abroad for work or business. Now, this particular person resides in a foreign country but is a citizen of India. And PIO, person of Indian origin, he resides in foreign land. He is a citizen of a foreign country, but he has ancestral ties with India. His father or grandfather or great grandfather belongs to India, but they are citizen of foreign country. OCI, overseas citizen of India, to someone with lifelong visa and special rights is an OCI, and PIO is includes this term OCI. Permitted bank accounts in India for NRIs and PIOs. To make banking easy for NRIs and PIOs and to manage India's foreign exchange properly, RBI allows three special types of accounts: NRE account, FCNR account, and NRO account. Let's discuss about NRE account and we'll go chronological order. Then we'll discuss SNRR account and what are the permitted investments. So let's discuss about NRE account. What is an NRE account? An NRE account is a bank account in India that non-resident Indians, NRIs or PIOs can open to keep their foreign income in Indian rupees. Think of it as a bridge between foreign income and Indian banking. Although money is sent in foreign currency like US dollar, dirham, pound, it is converted into Indian rupees and maintained in Indian rupees. Now, who can open it? It can be opened by NRIs or PIOs. It is maintained with authorized banks, the banks which are authorized by the RBI, and it includes scheduled banks and some cooperative banks as well. What are the types of NRE accounts? NRE account can be a savings account, a current account, a fixed deposit, or a recurring deposit. Joint holding on operations. So, joint account is permitted. A joint account can be opened by an NRI with another NRI or PIO. Number one. Number two, it can be opened with a resident relative, but the mode of operation will be former or survivor basis. This means the resident can operate it only after NRI passes or as a power of attorney holder. Now, what can a resident who is a power of attorney holder can do? This must come to your mind. So, let's say an NRI gives power of attorney to their brother in India. Now, his brother can pay bills in India from the account. He can send money to the NRI abroad, or he can invest in India, but following the rules and guidelines. And what he cannot do? He cannot open a new NRE account. The person resident in India with a power of attorney who cannot open a new NRE account. He cannot send money to someone else abroad. Neither he can gift to other residents using this account or transfer money to another NRE account. What are the permissible credits and debits? So, money sent from abroad, inward foreign remittance, is permitted to be credited in this NRE account. Foreign currency which is carried by the NRI or the PIO is permitted to be credited, provided the NRI declares it properly. Interest earned on the account is permissible to be credited. Any income which is earned in India like rent, dividend, salary, after taxes, they are permitted to be credited in the account. Any type of transfer from another NRE or FCNR account is permitted. So, this is also a permissible debit, and a refund from builder in India if the originally uh, the original mode of payment is from this NRE account or through a foreign remittance. Let me explain you this with an example. So, for example, a person, he's an NRI. He wants to purchase a flat, and for this he paid a certain amount. Now what happens is his flat booking got cancelled. Since he has paid money, he is eligible for a refund. Now this refund can come directly to this NRE account, provided this NRE account is the original mode of payment or he has paid via foreign remittances. So what are the permitted debits? Local disbursement or the NRE account can be used to pay expenses in India, to send money abroad, or to transfer to another NRE or FCNR account. Here, fixed deposits, minimum tenure should be 1 year. In general, the minimum tenure of fixed deposit is 7 days, but here it should be a year. And for interest rules, we follow RBI rules. For savings account, it should be same as regular Indian accounts. For FD, it is based on the duration and the deposit size. So, interest can vary for different tenures. For longer duration, the rate of interest is usually higher, and uh, for bulk deposit, a bank can have different rates. But uh, just like domestic banks, this account will not incentivize any bank staff or senior citizens. So there will be no extra interest for staff or senior citizen. What if the NRI wants to break his NRE account FD early? So penalties may be applicable, and bank must inform this about uh, the bank must inform the NRI or the PIO about the penalties in advance. No penalty is applicable is if account is converted into RFC, resident foreign currency account. So when a NRI comes back to India permanently, his NRE account can be converted into an RFC account. And if the account is converted into an RFC account, there will be no penalty. And if there is a change in the banking business, like business is transferred to another bank, in that scenario also there will be no penalty involved in case of premature withdrawals. And once an NRE account is converted into RFC account, we have to see two things. Number one, whether the FD has run the minimum period of 1 year. If not, the interest will be provided as per RFC savings account. And if it has run for more than a year, the original rate which is contracted, it will be applicable. What after the death of account holder? So on NRI's death, balance can be transferred to non-resident nominee, and if nominee is resident Indian, they need RBI permission to send money abroad. Loan against NRE deposit is permissible. So RBI allows bank in India to give loans using NRE FD as security. Also, branches of Indian bank abroad can give NRI loans based on these NRE deposits. Tax benefits. So no income tax will be applicable on the interest earned in NRE account, and there will be no wealth tax on the amount in NRE account. Loan against NRE deposits. So we'll classify these loans into two categories: loan in India and loans outside India. Let's first discuss loans in India. Who can take the loan? The NRI himself, who owns the account, or someone else in India, a third party, can also take a loan with NRI's permission. There is no limit on the loan amount. The bank can decide the amount based on the rules, and uh, there is no lien allowed on savings account as well. So there is no lien on NRE savings account. Only fixed deposits can be taken under the lien. What about the margins? So usual margins of the bank are applicable. Bank will apply the margin rules. And where can we use this loan? So what are the permissible uses? Only for personal needs like medical needs, education, or a person wants to do business in India, wants to invest in Indian firms, but on non-repatriable basis. So here, what do we understand by non-repatriable basis? Meaning to say the person cannot send money to abroad. On repatriable basis, when we say repatriable basis, the person can send money to abroad. Non-repatriable basis, he cannot send money to abroad. And the loan can also be used to buy a residential property for own use. So in real estate business, a person cannot invest, but the loan amount is permissible to buy residential property provided it is for own use. Where this loan must not be used, so for relending, lending to others, for farmers, for farming, plantation, agriculture activities, or for buying property for resale. You cannot do real estate business with this loan amount. Let's talk about repayment. So if the loan is taken by the NRI himself, it can be repaid using the same NRI deposits by sending money from abroad or from the NRI's NRO account. If someone else takes the loan in India, the NRI cannot get any payment even indirectly in foreign currency. Keep that in mind. this happens in order to avoid the misuse. Now let's talk about loans outside India. A bank in India can allow its foreign branches to give loans based on NRI deposits. These loans can be given to the NRI himself or to someone else for genuine or bona fide purposes. The Indian bank can also send money abroad to help repay that loan. This is it for NRE account. Let's move forward to FCNR account now. So this is a type of account which is designed especially for NRIs and PIOs to keep money in India in foreign currency. So we maintain NRE account in Indian rupees, but FCNR account is maintained in foreign currency only. It can be opened by NRIs and PIOs, and these accounts can be opened with authorized dealers or other banks which are allowed by the RBI. Now, you can deposit freely convertible foreign currencies in this account like US dollar, pound, euro, Japanese yen, or any other currency which is approved by RBI. You can only open a term deposit. Recurring deposits are not allowed for FCNR account, and the deposit period should be a minimum of 1 year and maximum of 5 years. It is divided into 5 fixed blocks. 1 year to less than 2 years, this is the first block. 2 years to 3 years, 3 years to less than 4 years, 4 years to less than 5 years, and then exactly 5 years. So these are the 5 fixed blocks in which FCNR account is maintained. With respect to interest rate, both fixed and floating interest rates are allowed. For floating interest rate, the reset period is 6 months, meaning to say they change every 6 months. Interest is based on something called reference rate, which is usually decided by the international benchmarks like overnight alternative reference rate or swap rate from Financial Benchmark India Limited. So this FBIL is Financial Benchmark India Limited. When we say interest rate limits, the ceiling, so for deposits less than 3 years, maximum 2.5% is permissible over the reference rate. So 1% equals to 100 basis point. 1% is equals to 100 BPS. So when we say 250 BPS, it is nothing but 2.5%. So for deposits less than 3 years, maximum permissible limit is 2.5% plus reference rate, and for deposits with a tenure of 3 to 5 years, the maximum which the bank can offer is 3.5 plus the reference rate. And for interest rate calculation, a year is counted as 360 days. Interest is calculated every 6 months, and for the remaining period, interest is calculated on actual number of days. For example, if a person does an FD in FCNR account for a tenure of 1 year and 3 months, so interest will be calculated for first 6 months, second 6 months, and for the remaining 3 months, interest is calculated on the actual number of days. So if January, February, March, so it is 31 plus 28 plus 31, and not like 30 into uh, 90. All right. For renewal of deposits, if you renew within 14 days after maturity, interest is paid for the overdue period at the lower rate, either rate on maturity or renewal date. And after 14 days, it is treated as a new deposit. If NRI withdraws before the minimum tenure of 1 year, after renewal, bank may take back the extra interest which bank has paid. In case of death of depositor, there can be 5 scenarios. Number one, the amount is paid on maturity. In that case, full contracted interest is paid. Second, it is paid before maturity. In that scenario, interest for the actual period is provided and there will be no penalty. When death happens before maturity, but the amount is paid after maturity, in that particular scenario, interest at contracted rate is provided till maturity, and after maturity, simple interest is provided. But if there is a death happens after maturity, so in that particular scenario, interest will be provided as per resident foreign currency savings rate till the payment is made. and if the resident is the nominee, then the amount is converted to INR and future interest as per regular domestic FD is provided. What happens if NRA returns to India permanently? In that scenario, the deposit can be continued till maturity at the original or the contracted interest rate, and from date of return, this account is treated as a resident deposit account or a resident foreign currency account. So on maturity, it can be converted into two types of account: resident rupee account or resident foreign currency account. An interest rate of new deposits will be provided as per the residential norms. Now, if FCNR account is converted to RFC account before maturity, interest will be given for period it has done at RFC savings bank rate, and even if the deposits was withdrawn before minimum 1 year period. So this is what we have discussed a while ago also, but it is important, that's why I'm repeating it. Now, what happens with respect to premature withdrawals? So bank can deduct a penalty based on its internal policy. If foreign currency has been swapped, then bank can recover the swap cost. But for this, bank must inform the depositor about the penalty rules, and if bank fails to inform, then the bank must bear any exchange losses. No penalty will be levied if deposit is split into smaller parts, but the amount and time remains the same. If FCNR account is converted into RFC account, similar to the NRE account, NRE when converted to RFC, there will be no penalty. So if FCNR is also converted into RFC, there will be no penalty. And if there is a transfer of banking business, if the bank branch business is transferred to another bank, then no penalty will follow. And all other rules they are same as NRE account. Let's move forward to our third type of account, NRO account. So an NRO account is a type of bank account in India that can be opened and maintained by any person who is living outside India. Now, this includes NRI and even foreign nationals of non-Indian origin who come to visit India. It is used to manage income earned in India like rent, pension, dividend, or any other legitimate Indian earnings. And it is denominated in Indian rupees, meaning to say it is maintained in Indian rupees. And who can open it? So, any person living outside India or any foreign national visiting India can open the NRO account. Where can you open this NRO account and what are the types of account? So you can open this account with the banks and post offices in India that are authorized to deal with non-resident accounts. And with respect to types, savings account can be opened, current account, term deposit and recurring deposit can be opened. Joint account holdings are permissible. NRI can open a joint NRO account with a resident Indian, but again it will be only on former or survivor basis. Or NRI can open a joint account with another NRI or PIO. Here the minimum tenure for fixed deposit is 7 days only, unlike NRE account and FCNR account where the fixed deposit tenure is minimum tenure is 1 year. The interest is paid as per RBI guidelines and the saving interest is same for same as the regular Indian accounts. For fixed deposit rates, the interest can vary depending on the tenure and deposit size, but the rate cannot be higher than what's offered for similar domestic deposits. There will be no extra interest allowed for foreign citizens or bank staff, and interest is paid quarterly or more frequently. Now, what are the permissible credits and debits? So, with respect to credits, inward remittance from abroad is allowed. Income earned in India can be credited if there is any transfer from other NRO account, or gift or loan in rupees from a resident relative which are within LRS limits. They are permissible credits in this NRO account. With respect to debits, now this NRO account can be used to make payments within India to transfer to other NRO accounts. Remittance abroad are generally not allowed except for the current income like rent, pension, interest, or up to USD 1 million per financial year by the NRIs or PIOs. Now this can also be transferred to NRE account. So only the current income and the limit is USD 1 million per financial year. Loans against NRO accounts are permissible. So banks can give loan in India using NRO deposits as security either to the account holder or a third party. But the loan cannot be used for relending, for agriculture or plantation business, or for real estate investments. And what happens if NRI returns to India? So if the NRI comes back to India and decides to stay in India for an uncertain period, then the NRO account will be converted to a resident account. And if the resident becomes NRI, then the existing resident account will be changed to NRO account. Power of attorney: a resident person holding power of attorney can make local payments or can remit money to NRI as allowed under the rules. Issue of international credit cards. So banks can issue credit cards to NRIs or PIOs, and the payment on these cards can be settled from the inward remittance, NRE account, FCNR account, or from the NRO account. Income tax requirements. So when money is sent abroad from the NRO account, it should be of net of taxes, and the person has to submit required tax documents as per CBDT, Central Board of Direct Taxes. Bank accounts in India for foreign national visiting India. So foreign nationals who visit India, they are allowed to open bank accounts, but there are some rules based on who they are and how long they stay. So if a foreigner who is not of Indian origin comes to visit India, they can open an NRO account. But this account has to follow certain conditions. Number one, the money in this account should come from abroad. Either they send through a proper banking channel or brought physical currency with them and convert it in Indian currency. And no Indian money can be deposited into this account. Only interest earned on the account can be credited locally. The account can be used for a short duration, up to 6 months. And when the foreigner leaves India, the money in this account can be taken back with the foreigner. And what happens when a foreign national leaves India after employment? So here they come for a tourist purpose. Here they come for a employment purpose. So suppose a foreigner was working in India and had a regular resident account. Now after leaving the job in the country, their resident account is changed into an NRO account. And this is allowed so that the pending payments like any salary, rent or refund can be received into that account. The bank must ensure that these payments are bona fide, they should be genuine, and after paying all applicable taxes, the money can be sent abroad. Again, there is a capping of 1 million US dollar per financial year, and the money from this account can be used only and only for sending abroad, not for local payments. And once all dues are received and sent, the account must be closed. Individuals, entities from specific countries. So for nationals of countries like Pakistan and Bangladesh, special rules apply. A Pakistani national or Pakistani owned entity, they require RBI's prior approval. With respect to Bangladesh nationals, they can open bank account if they have a valid visa and a residential permit issued by the immigration offices, so the FRO or FRRO. And if the entities are owned by Bangladesh citizens, then in that scenario, the RBI's approval is required. For minority communities from Pakistan and Bangladesh, which includes Hindus, Sikh, Buddhist, Jain, Parsi, and Christian. So, if they have a long term visa from the Indian government, banks can allow them to open one NRO account. Keep that in mind, only one NRO account is permitted. And this account can run for 6 months and can be renewed every 6 months if the LTV long term visa application is still under process. Once they become Indian citizen, this account can be converted into a normal resident account, and all such accounts must be reported quarterly to the Ministry of Home Affairs. Special non-resident rupee account, so short for SNRR. The SNRR account is a special type of rupee account open in India by a person living outside India but who has some business interest or transaction in India. Now anyone residing outside India can open this account provided they have valid business reasons connected with India. And keep a note that the companies or people from Pakistan, Bangladesh, they need special permission from the RBI. So why it is opened? So it is open for genuine business transaction in rupees. This can include investment in Indian rupees, importing or exporting goods, giving or receiving trade credit, borrowing or lending money under external commercial borrowings, or business dealings by IFSC, but outside IFSC itself. The tenure is maximum for 7 years, so the account can be held for as long as the business activity or the contract lasts, but for not more than 7 years. For extension beyond 7 years, RBI's approval is required. Business specific naming, so the account should be named after the business activity it is used for. For example, if the account is used for exports, it is called SNRR, export transactions. And bank may allow one account per business type or a single account for multiple activities if transactions can be separated. Now we use this account to do business. For businesses, you already know what type of account is open. Is it savings or current? Yes, obviously current account is allowed. And do we pay any interest on current account? No. So will we pay any interest on SNRR account? So the answer is no. We do not pay any interest on the balance which is in SNRR account. What type of transactions can be done? Only keep that in mind, only those transactions should happen which are directly connected to the business, and the money in this account should match the nature and size of the business. The SNRR account cannot give foreign exchange to any Indian resident, and there is no transfer allowed for NRO account from NRO account to the SNRR account. The money in the account can be taken back abroad after payments of applicable taxes, and all business done through this account are subject to Indian taxes wherever applicable. The SNRR account will be converted into a resident account if the account holder becomes a resident. And with respect to nomination, if the account is in the name of individual, they can nominate someone to receive the funds in case of death. And in case of death, the balance can be credited into the nominee's NRO or NRE account or can be remitted abroad through regular banking channels. Now let's talk about the remittance and property rules for NRIs and PIOs. So NRIs and PIOs are allowed to send money outside India from their Indian assets. This is allowed up to 1 million US dollar per financial year, but again certain rules have to be followed. Uh, what assets can this remittance be made from? So money in NRO account, sale proceeds of the property or the property inherited, asset received through a deed of settlement. So deed of settlement is valid after death of the person who made the deed, and all remittance installments should go through one bank branch. And for money from NRO account, they must declare that the money is not from loans taken in India. Cases where RBI's approval is required. So prior permission of RBI is required where more than one US a dollar more than 1 million US dollar in a financial year is to be remitted if the recipient is a foreign citizen and the money is from inheritance, if not remitting the money would cause hardship to someone, and if the asset is not covered under RBI's direction. So over and above 1 million US dollar, and if it is not remitted, then the hardship will cause if the recipient is a foreign citizen and the money is from inheritance, and if the asset is not covered under RBI's direction. Income tax. Uh, so before remitting, all applicable taxes must be paid in India. Keep that in mind. Acquisition and of immovable property by NRI. So NRI, PIO and OCI, they can buy and receive property as gift, or they can purchase the property. They can buy from resident individuals. But uh, agriculture land, farmhouse or plantation property cannot be bought or cannot be made as gift. Keep that in mind. With respect to joint property with foreign spouse, so a foreigner married to an NRI or OCI can jointly buy one property except for agriculture, farm or plantation land, but the money must come from abroad or from NRE or NR account. No cash or traveler check is allowed. Marriage should be registered and at least 2 years old, and the foreign spouse must not be banned from such transactions. Acquisition by LTV holders. So minority community members like Hindu, Sikh, Jain, Buddhist, Parsi or Christian from Afghanistan, Pakistan or Bangladesh living in India on long-term visa, they can buy one property for residential purposes and one property for uh, business purposes. They cannot buy property in the restricted area or near the military area. They must declare the source of fund to the local authority from where they are getting the money to buy the property. The property papers must clearly state their nationality and long-term visa status, and they can sell property only after becoming Indian citizens. And if not, they need approval from DCP, FRO or FRRO office, and the property must be taken over if they are involved in any anti-Indian activities. Transfer of immovable property by NRI. So NRI can transfer property in India to residents, but payment must be made via banking channels, and if any transfer is not covered under RBI rules, prior approval of RBI is required. Repatriation of sale proceeds. Repatriation means sending money back abroad after selling property in India. When is RBI approval required? So if the property was acquired under FEMA or inherited, FEMA section 6 subsection 5 to be particular, or inherited, then RBI's permission is required. AD can authorized dealers can bank can allow repatriation if the property was bought using foreign money or NRE FCNR account balances. If bought using home loan, repayment should have been made from foreign funds or from NRE or FCNR account, and a maximum of 2 residential properties are allowed for repatriation. If in case of default loan, that is, if an Indian resident took a loan from overseas lender and defaulted, the bank can sell the mortgage property and send the money to the foreign lender. There are certain restrictions on certain nationalities. The people from certain countries need RBI permission to buy or sell property in India, except for leasing for up to 5 years. So, the citizens belonging to the countries like Pakistan, Bangladesh, China, Iran, Nepal, Sri Lanka, Afghanistan, North Korea, Macau, and Hong Kong, so they require prior RBI permission to buy or sell property in India. There is one exception, that this rule does not apply to OCIs from these countries. Creation of charge on immovable property. Sometimes an NRI or OCI who owns a property in India and is also a director in a company outside India, they may need a loan from a foreign bank. In such cases, an authorized dealer bank in India, which act as representative of that foreign lender, can create a mortgage on the NRI's property in India. But two conditions are to be followed. Number one, the loan must be used only for the business purpose of that foreign company and not for personal use. And if the loan is not repaid, the property is sold. The AD bank must sell it to an eligible buyer in India and send the sale proceed to the overseas lender. Repatriation of income and sale proceeds of asset held abroad by NRIs. So, when NRI return to India for good, they become resident in India, and now they have two options. They can bring their foreign assets to India, or they can keep those assets abroad as per FEMA rules. And they are allowed to hold, transfer, invest their foreign assets if they had acquired or held them while living abroad, or they inherited them from someone who lived abroad. As for example, if Anita worked in Canada and bought a house there, she can still keep it after returning to India. And this includes foreign bank account maintained while living abroad, income earned abroad like salary from a job outside India, business profit earned abroad, investments made while living abroad, gift or inheritance received abroad, and any income earned from foreign assets like interest or rent. So even after returning to India, they can use the foreign income or asset sale proceeds for any purpose abroad. Uh, they can make new investments abroad, and for this they will not require RBI's approval, provided they use only their eligible foreign assets and they do not violate FEMA rules. Investments by NRIs or PIOs in India. So NRIs, PIOs and OCIs, they are allowed to invest in India, but again certain rules and exceptions are there. They can invest either by FDI or FPI, foreign portfolio, or foreign direct investments. So what is a foreign investment? So if a resident Indian invest on behalf of someone living outside India and declares their beneficial interest, then it will still be treated as a foreign investment. So beneficial owners are also the beneficial owners is a person. If the beneficial owner is a person resident outside India, then that investment will be treated as foreign investment. What are the prohibited sectors? So some business areas are completely prohibited from foreign investors, including NRIs or OCI. These include lottery business, gambling or betting, chit funds, but chit funds are allowed only on non-repatriation basis. Nidhi companies, TDR trading, transferable development right trading, real estate business, farmhouse construction, tobacco products manufacturing like cigarettes or cigars, atomic energy, railway operations, foreign technology tie-ups are also not allowed in lottery and gambling related sectors. So when can NRI or OCI invest? What are the permissible activities? So there are several permitted routes for investment in India. It can be a capital investment or a current amount investment. So with respect to capital investments, shares of Indian companies, units of LLPs or contributions in partnerships on non-repatriation basis, listed shares through foreign portfolio investments are allowed. Uh, Other securities are also allowed, like NRIs can invest in LLPs, alternative investment funds, venture capital, foreign venture capital investments. Investors can invest too. NRIs can also invest through investment vehicles like AIFs, and then there are depository receipts. So Indian shares can be given to a foreign depository for issuing depository receipts. and for foreign depository receipts abroad, and foreign companies can issue Indian depository receipts in India. So how can NRIs and FCIs uh, buy shares or other investments? So they can invest in three ways, mainly by subscribing to new shares, or uh, by buying shares in the secondary market, or by conversion of dues, meaning to say by receiving shares in place of money owned to them by the Indian company, if allowed and without RBI or government permission. What are the payment sources? How do they pay for the shares? So they can send money from abroad through banks. They can use funds in NRE or FCNR or escrow accounts. They can adjust it against money the company owes them, or swapping shares with other shares in sectors where automatic route is allowed. Sale proceeds after tax can be sent abroad or deposited into NRE or FCNR account. Buying or selling listed shares on stock exchange on repatriation basis. So NRIs and OCIs through a special NRE PIS account can do this via authorized bank branch. There are investment limits. So one NRI or OCI can invest up to 5% of the total equity or each series of preference shares or debentures, and NRIs or OCIs together can invest up to 10%, which can go up to 24% with company's approval. Now, what is this NRI PIS account? So, it is a dedicated NRE account used only for buying and selling shares on repatriation basis. What money can go into this PIS account? So, remittance from abroad, transfer from other NRE or FCNR accounts, sale proceeds from earlier investments, dividend or income from investments, and this account can be used for the payment with respect to buying shares, sending money or dividends abroad, paying brokerage or charges, or to transfer to other NRE or FCNR account. So NRI and OCIs of firms trust they can also buy capital instruments on non-repatriation basis. So it is allowed in the shares of listed or unlisted companies, units of investment funds, capital in LLPs with there is no limit, and convertible notes or startups. Now, when we say non-repatriation basis, these investments are treated as domestic investments, and the money cannot be sent to abroad. Again, there are certain restrictions. So, it is not permissible to invest in nidhi companies, companies doing agriculture, plantation activities, real estate business, farmers construction, or transfer of development rights. How do the NRIs or OCIs pays for investment? They can send money from abroad, or they can use funds from NRE or FCNR or NRO account. Sale proceeds, so sale or maturity proceeds must go to NRO account. They are credited to NRO account, and they cannot be sent on they cannot be sent abroad because it is on non-repatriation basis. Investing in a partnership or proprietorship. So NRIs and OCIs can invest but only on non-repatriation basis, and they cannot invest in agriculture, plantation business, print media or real estate business. And the money should come from abroad or from their NRE or FCNR or NRO account, and the profits or capital they cannot send it to abroad and must be credited only in NRO account. Securities other than capitals instrument. So NRIs or OCI can buy government bonds, T-bills, mutual fund, ETF, PSU bonds, IDF unit, listed preference shares, debentures, regulatory capital debts from banks or national pension system if they are eligible, and they can use these securities as collateral for derivative trading on Indian stock exchange. How do they make this investment? By remitting money from abroad or using their NRE or FCNR account. And when it is on repatriation basis, they can send their money abroad or keep it in NRE or FCNR account, and it also includes NRO account. They can also buy securities other than shares on non-repatriation basis, and when it is done on non-repatriation basis, the money cannot be sent abroad and the credit happens in NRO account. LLP investments. So NRIs or OCIs can invest in LLPs under automatic route. Any resident company outside India can invest except for Pakistan or Bangladesh. So there must not be any performance link conditions to invest in LLPs, and the proceeds can be sent abroad or credited to NRE or FCNR account. Convertible notes. So NRI and OCI can sell or gift convertible notes bought on repatriation basis to another person abroad, but caution has to be maintained. If the sector needs government approval, then prior approval is required, and if buying from stock exchange breaches that NRI or OCI limit, the extra portion must be sold within 5 working days to an Indian resident. Transfer of capital instruments. So NRIs and OCIs uh, may transfer to a person outside India as per foreign investment rules to another NRI or OCI on non-repatriation basis or as a gift to another on non-repatriation basis. Sell on stock exchange. So any foreign investor can sell shares on an Indian stock exchange as per the rules, except when those shares are held on non-repatriation basis. Securities held on non-repartition basis can also be gifted to a non-resident, but prior RBI approval is required. So let's start. Uh, People living in India, they also need to deal with foreign currency sometimes, like US dollar, euros, and this can be for business or personal use. But again, holding a foreign currency account in India is not completely free. It is regulated by FEMA, Foreign Exchange Management Act. Earlier, such accounts were not allowed easily, but now FEMA has relaxed rules to help people who often earn or spend in foreign currency, like exporters, freelancers, consultants, etc. Uh, why is this helpful? Let's say a person earns in dollar but lives in India. Every time they convert dollars to rupees, they lose money in currency exchange and pay bank fees. Now, if they can keep money in dollars, they can avoid that hassle. Also, if they spend in foreign currency, uh, having a foreign currency account acts like a natural protection against currency rate fluctuations. Now, what are the types of accounts permitted? So, we'll understand about 4 types. EFC exchange earn a foreign currency account. It is for exporters, professionals who earn in foreign currency. RFC account. It is basically for returning Indians, those NRIs who want to keep their foreign earnings in foreign currency. RFCD account for resident Indians who get foreign currency legally and want to keep it in India. Last but not the least, DD account, diamond dollar account. It is especially for diamond traders. So, foreign currency denominations account in India. Resident can also hold foreign currency accounts abroad. Keep that in mind, but only for specific purposes, right? Uh, with respect to foreign currency accounts in India, these accounts can be savings, current, or term deposits if they are held by individuals. Then current or term deposit for companies or firms, and they can be in single name or joint name, but among only among eligible persons. If the account holder dies, what happened in that case? So if the nominee is living abroad, their share can be sent abroad directly. If the nominee is in India and want to send money abroad to clear the deceased person's due, RBI approval is needed. And if the account was outside India, the resident nominee must close the account and bring the money to India. Now let's move on to our specific accounts. We'll start with EEFC account. So exchange earner foreign currency account. This is most common type and it is mainly for people living in India who earns in foreign currencies like exporters, freelancers, consultant, IT service providers, startups with foreign clients, so on and so forth. Now, what are the permitted credits? What money can be deposited? So, 100% of
the foreign exchange earnings received through the banking system are permitted to be credited. Advance payment for goods and services from foreign clients, consulting fees, honorariums, lecture payments received from abroad, unutilized foreign currency withdrawn earlier, and if it is returned, it can be credited to the account. If any repayment of trade loan by the importer to the exporter is done, it is a permissible credit. Disinvestment proceeds and foreign earnings by Indian startup or their overseas branches. So these are the permissible credits. What are the permissible debits? Foreign payments can be done for business, investment, or personal expense. Payment to special economic units in foreign currency. Custom duty can be paid under export-import policies. Loan to importer, customer abroad uh, can happen through this account. And payment to resident in India if they agree to be paid in foreign currency. For example, paying airline ticket or hotel bill in foreign currency to an Indian travel agency. It is permitted. Now, there are some important rules, some important key conditions. If the person withdraws in rupee, it is permissible. But once the amount is withdrawn, you cannot put it back in this account. So, it is not recreditable. This account is meant for business transactions. Um, Hence, no interest will be earned on this account, no interest will be paid on this account. Insurance claims paid in rupees cannot be credited into this account, and no loan can be taken using this account as security. Also, a person can use it to repay export packing credit loans, which is taken in any currency. Now, let's move on to RFC accounts, resident foreign currency accounts. An RFC account is a bank account in India that a resident Indian can open with foreign currency. This account is maintained with a bank that is authorized by RBI. Well, authorized dealer banks, we have learned about it in the previous unit as well. What are the permissible credits? So, a person can deposit foreign exchange into an RFC account if he or she has received a pension, retirement benefit, or any other money from job abroad. If he or she brings money from assets owned as an NRI, or if inherited or received as a gift from someone who lived outside India. If a foreign asset is held before 8th of July 1947 or earned income from them with RBI's permission, then it is permissible to be credited. And if the person received foreign exchange from an Indian insurance company as a part of life insurance claim or maturity amount, and the money settled in foreign currency, then it is permissible to be credited. What is a permissible debit? So the person can use the money freely outside India or convert it into Indian rupees and use it in India because the currency has been earned while he was working in abroad. Now again, there are some other conditions. Uh, that is, the person can add a resident relative as a joint holder, but only on former or survivor basis. And if the person had an NRE or FCNRB account as an NRI and then returned to India, the balance can be transferred to RFC account. RFCD account, resident foreign currency domestic account. This is another type of account for resident Indians to keep foreign currency in India. What are the permissible credits? So, suppose you have an RFCD account and you can want to deposit foreign currency. So, you can deposit foreign currency into RFC account if you got money in foreign currency while traveling abroad and the payment was not related to any business or work in India, or you have received honorarium or gift from a foreigner visiting India. For example, a tourist from the UK gave you $200 as a thank you. Uh, so you can deposit this amount, or you got a gift or honorarium while visiting abroad. So a family member gave you dollars during your USA visit, or you got a gift from a relative in foreign currency, or you had some unspent foreign currency from your foreign trip which you had purchased from the bank. You can deposit it into RFCD account, or you sold your shares and received money in foreign currency by converting them into ADRs or GDRs, or you receive insurance proceeds in foreign currency from an Indian insurance company. So in these all scenarios, credits can be made. What is a permissible debit? So you can use this money for any permitted current or capital account transaction. Current account like paying for education, travel, or capital account which alters the asset and liabilities. So like investing in foreign shares or property, or buying the property. If you buy property abroad, it is a capital account transaction. So you can use this money for any permitted current or capital account transaction. Diamond dollar account. This account is specifically meant for businesses in a diamond industry that meet certain rules under foreign trade policy of the government of India. It is a non-interest bearing current account because meant for businesses. That's why current account, and if it is a current account, it is non-interest bearing. What are the main features of DDA? So you can credit this account with money from exports or local sales of rough cut or polished diamonds, foreign currency loans like pre-shipment or post-shipment finance, permissible can be credited into the account. When we say what is permissible debit, then it is for uh, trade in diamond. So you can buy diamond, rough cut or polished diamonds, or you can transfer funds to a rupee account. Now, there are some other conditions for foreign currency accounts. For EEFC, RFCD, and DD account, when a person earns foreign currency like dollars or euros and deposit it into an EEFC, RFCD, or DD account, they must convert the unused amount into Indian rupees by the end of the next calendar month. However, before converting, they can use the foreign currency for approved uses like imports or payment abroad. For EFC and RFCD accounts, if the account holder becomes a non-resident, then the balance in their EFC or RFCD account can be transferred to an NRE or FCNRB account, which are meant for non-residents. Let's understand now some specific categories permitted to maintain foreign currency. Number one, these are agent of foreign shipping or airline companies. So Indian agents can keep a foreign currency account to manage local expenses of their foreign shipping or airline company. They can deposit freight or ticket collections in India or remittances from their foreign principal. Ship manning agencies or managing agencies. So these agencies manage ship crews on behalf of foreign currencies. They can hold non-interest earning foreign currency accounts. Uh, so only inward remittances from the foreign ship owners are allowed to be credited into these accounts. And with respect to debits, expenses for crew management are valid debits. And no loan or overdraft is allowed using this account. No EFC benefit on funds received. A banks must maintain certain reserves, and the account is valid only for the duration of the agreement. Project offices of foreign companies. So foreign companies setting up a project office in India can open one or more non-interest earning foreign currency accounts. If RBI and project authority have given the approvals, the project contract specifies foreign currency payments, and only one account per project is allowed. Project related expenses can be debited, and funds from the parent company, project authority, or international agencies can be credited. Accounts have to be closed after project ends, and transfer between projects are permissible only after the permission of RBI. If any dispute arises, the balance is converted into Indian rupees and it is kept into a special account. Organizer of international conferences. So these are temporary accounts. They can be opened for temporary foreign currency accounts. Organizers of international seminars. Registration fees, sponsorships, donations are can be credited. Travel, stay, honorarium for foreign guests, refund to delegates, bank charges. So these are permissible debits. Any other transaction needs RBI approval and account must be closed after the event ends. Exporter on deferred payment terms. So exporter supplying goods or services with payment to be received later to be deferred can open a foreign currency account only if they have approval from the project or export or they follow the approval condition. For example, an Indian firm building a power plant in Africa can, under a 2-year payment plan, can open this account to receive future payments in foreign currencies. Units in special economic zones. Special economic zone units can hold foreign currency accounts in India to receive all foreign exchange earnings, and it can use these accounts for business transaction with Indian or foreign entities. Foreign exchange deposits cannot be, you cannot deposit foreign exchange purchase using INR, and you cannot use balance for gifts or loans to non-special economic zone residents. Indian companies with FDI, if a company gets foreign direct investment and has upcoming foreign currency expenses, it can open a temporary foreign currency account. But again, it must close the account within 6 months or when the expense is done, whichever is earlier. Reinsurance or insurance broker. Uh, Reinsurance and composite insurance brokers which are registered with IRDA, they can open non-interest bearing foreign currency account for regular business dealings. Foreign currency account denominated accounts outside India. So the Reserve Bank of India allows Indian resident to keep a foreign currency account with a bank outside India only for a specific purposes, like for business use. So Indian companies or professionals can keep a foreign currency account abroad for doing regular business, like exporting or opening a branch. For study abroad, if you are studying abroad, you can open and maintain a foreign currency account during your stay. For example, if Rahul goes to UK for his MBA, he opens a bank account there in British pounds to pay for his expenses. And after his studies, this account is treated under LRS rules. Foreign visits. So if someone is visiting a foreign country, they can hold a foreign currency account during their stay. But once they return, they must bring back the remaining money to India. For exhibitions or trade fairs, if an Indian company is participating in a trade fair abroad, it can open a foreign currency account to deposit money earned from the sales. Resident in India can use foreign currency account to send money abroad under LRS. And if company raises money through external commercial borrowings or instruments like GDR, ADR, it can maintain an account to receive those funds. If an Indian startup has a branch or subsidiary outside India, it can maintain a foreign account to deposit earnings from sales or export during bench abroad. Business entities eligible, so business related accounts who can open, so these specific persons or organizations are allowed to open and use foreign currency accounts. uh, Authorized dealers with branches abroad, Indian banks with overseas branches, Indian shipping or airline companies like Air India or Shipping Corporation of India, insurance or reinsurance companies registered in India, Indian companies having foreign office or branches, or exporters, especially those dealing with projects like construction or engineering, where payment come in phases. Temporary visitors. So the people working in India temporarily can maintain a foreign currency account abroad to receive salaries. A, a foreign national on deputation to the Indian branch of a foreign company, a foreign national working for an Indian company, or an Indian citizen deputed to the Indian branch of a foreign company, so they can maintain an account outside India, temporary who are working in India temporarily to receive the salaries. Remittance of assets by foreign nationals. So foreign nationals can send money or asset out of India, but again under certain conditions, like they are retired from their Indian-based employment, they can send their savings. They have inherited property or asset from someone who is covered under FEMA laws. a widow or widower who inherited from their Indian spouse, or a foreign student who completes education in India can remit his savings. Acquiring property outside India by residents. So a person living in India can legally own property abroad by if the property is owned earlier or it has been inherited. If someone already had property abroad before becoming Indian citizen or received it by inheritance, they can continue to hold it. Or if a person has received gift, then a person can receive the property abroad as gift or inheritance from someone who was living outside India, or from a resident Indian who bought such property before 8th of July 1947, or from another Indian who bought the property as per FEMA rules. And resident can also purchase, right? So a resident Indian can purchase property abroad using money from RFC account or under LRS, or he or she can jointly own the property with a relative abroad. So a person can buy property jointly with a relative who lives outside India as long as no money goes out from India for the purchase. For example, if Anita's brother lived in Canada, he buys a house there and includes Anita's name too, but the entire payment is made by Anita's brother. Then this is allowed. Money should not go from India, right? Foreign Contribution Regulation Act, FCRA. So the Foreign Contribution Regulation Act is a law that controls how foreign money and help called foreign contributions can be received and used in India. It is especially important for NGOs, media houses, political parties, public servants, and this law came into effect on 1st of May 2011. It replaced the earlier 1976 Act, and it ensures that foreign funds are not misused in India and are only used for genuine causes. So let's understand what is a foreign contribution. A foreign contribution means any donation or gift given by a foreign source. So this can be money, any article or object, except for personal gifts like wristwatch and a certain value, or this can be a share or security. So we say that foreign contribution means any donation or gift given by a foreign source. So what is a foreign source? A foreign source includes foreign government or their department, foreign companies, foreign citizens, foreign trusts, NGOs, foreign clubs, or international organization, except uh, a few like UN or World Bank. So they will be considered as foreign sources. So who cannot receive foreign contribution? FCRA strictly prohibits some persons and groups from accepting foreign contributions, like persons contesting for elections, media persons like reporters, editors, cartoonists, publishers, government servants, judges, public servants, MPs, member of state assemblies, political parties and their leaders, politically active organizations, owners or editors of news companies or companies or associations that make or broadcast news or current affairs. So these uh, people and groups are prohibited from receiving any foreign contribution. Foreign hospitality means getting free stay, free travel, free food, or medical treatment in another country paid by a foreign source. And this is not allowed without government permission for MPs, MLAs, leader of political party, judges, government servants, employees of government controlled organization. So they cannot receive any foreign hospitality without government permission. If government permits, they can enjoy that foreign hospitality as well. Then this restriction on foreign hospitality. So all of them have to be take central government's permission if they want to accept the hospitality. The reason is to avoid foreign influence of people in important position. This is all. So restriction on transfer of foreign contributions. So can foreign contributions be transferred to others? So answer is simple no. A person or organization that is allowed to receive foreign contributions cannot give it to another person unless the other person has also has approval under FCRA. Requirement for accepting foreign contributions. So, when any person or organization in India wants to accept money or donation from a foreign country uh, or foreign source, certain rules must be followed under FCRA. Number one, if a person or an organization is involved in cultural, economic, educational, religious, or social work and they want to accept foreign donations, they must get registered. Uh, they must apply and get registration certificate from the central government. Or if they are not registered, they can still accept a foreign donation, but only after getting prior permission from the central government. And this permission is only for specific amount, for a specific donor, and for a specific purpose. This registration is valid for 5 years and it must be renewed within 6 months before expiry. And prior permission is valid only for that specific donation and purpose. Suspension or cancellation of registration. So, the central government can suspend or cancel the FCRA registration of an organization if they break the rules or misuse the funds. So, what happens if registration is suspended? The organization cannot receive new foreign funds unless they get special permission for a specific donation, and the organization can use existing fund in their account only with prior approval and in a specific manner. Uh, Also, if government thinks that the organization has violated the FCRA rules, it can issue the order stating that they cannot receive any foreign currency rules. They cannot receive any foreign currency, and uh, they cannot spend any unspent foreign funds without the central government's permission. Just a minute, yes. Now let's understand where to receive foreign contributions. So from September 2020, there's a new system to receive foreign funds. Number one, you have to open an FCRA account in SBI New Delhi main branch. All foreign contributions must first come into this account only. Then you can transfer to other FCRA account. From that SBI FCRA account, the organization can transfer funds to another FCRA account in any other scheduled bank for keeping or spending. And the organization can open more bank accounts in scheduled banks to use the funds for different projects, and these accounts must be used only for foreign contributions, so no local funds should be deposited here. The SBI New Delhi branch or any other scheduled bank where the FCRA account exists must report the uh, certain things to the government, like the amount of foreign contribution received, the source, the method, like how it was received, wire transfer or check. And every person or organization who receive foreign contribution must inform the government by submitting a statement showing the amount of each donation, the source, the mode of receipt, the purpose for which it was used, and the manner of utilization. Also, they must submit a bank certified copy of the statement confirming the receipt of foreign contribution along with the intimation to the central government. Prohibition and restriction on transfers utilization. So, if a person or organization get money from a foreign source and they are registered under FCRA or have prior permission from the government, they cannot transfer this money to someone else unless that other person is also registered or has prior permission under FCRA. And the FCRA allows uh, the FCRA lays down rules for using the foreign contributions. So, if the money was received to build the school, you cannot use it to buy office furniture. So you have to use only for the purpose for which it was received. And no speculative activities allowed. You cannot invest the money into stock market, cryptocurrencies, FNOs, uh, betting activities to make profits. And the administrative expenses should be limited. So the money spent on office rent, salaries, electricity must be within the prescribed limit by the government. So this current capping of 20% unless special approval is taken from the government. Rules under FCRA and reporting by banks. So any person or organization receiving foreign funds under FCRA must do two important disclosures. Number one, annual disclosures, and number two, quarterly disclosures. With respect to annual disclosures, they must upload audited accounts including income and expenditure statement, balance sheet, receipt and payments for the financial year by 31st December. That is within 9 months after the end of the financial year. And with respect to quarterly disclosures, for each quarter, the detail of money received must be uploaded within 15 days after the quarter ends. And details must include name of the donor, amount received, and date of the receipt. Unutilized foreign contribution. If a person or NGO FCR's registration is cancelled and they still have foreign funds lying in the FCRA bank account, they cannot use or touch that money anymore. The bank will hold that money until the government tells them what to do. Even if that money was already transferred to someone else before cancellation, the same rules apply, and that person cannot use the money until the government gives the permission. Bank reporting. So bank also have duties under FCRA. Bank must report to the government within 48 hours of any foreign contribution received by anyone, even if that person is not registered under FCRA. Every single receipt must be reported. There is no minimum limit. And a special online software has been made by the Ministry of Home Affairs for this purpose. Bank must use this system to send the reports.
So let's begin the video. Um, let's quickly get an introduction to cash management. What is cash management? Cash management means managing the money. Okay, you manage the cash that flows in and out of the business. This means that uh, cash management includes collecting money from customers, number one. Number two, holding or investing extra cash wisely. So concentration, so you hold or invest. And number three, third, you uh, paid off your employees, you paying employees and suppliers on time. So disbursement of cash. What is the main goal? Main goal is to make sure that the company always has enough cash to run smoothly while avoiding too much idle cash, unused cash. So imagine you are running a business. So you need to collect money from customers, you need to pay rent and staff, and you need to invest more into your raw material and stock. So now the managing this inflow and outflow of money is called cash important. Why is it important for you? Because it saves money. It increases your efficiency. It helps your company to grow faster. And there was a Canadian study which founded that companies could save up to $23 billion just by using electronic methods for cash management. Um, how cash management has evolved? So, why it has changed? So, there's higher interest rates now, and money idle, keeping too much money idle is will cost the company dearly. And again, there has been improvement in technology. Now, computers and internet-based payments like NEFT, RTGS, UPI. Now, this makes um, cash inflow and outflow very easy and fast, right? Say there are some major corporations like IBM. A big company like IBM may have offices in many countries. Do you agree with that? If one office has extra cash and another needs cash to pay bills, the cash management system helps to move the fund quickly between them. There are various RBI initiatives. RBI has developed several initiatives like NEFT, RTGS for electronic fund transfer. Then there are MICR, NACH, CMFS, CTS to secure and faster check and clearing systems. So RBI has taken these initiatives to create and develop a strong payment infrastructure in India, in this country. Now, why cash management is important? So, cash management is important for corporates as well as for banks. Why is it important for corporates? So, good cash management means you know when and where you will need cash. Now, you are being ready with your funds. This reduces paperwork and errors. It saves a ton of time and bank interest, and you are making your payments to your staff, to your suppliers, to other businesses on time. Now, say Unilever sells product worldwide. It collects money in different countries, and it uses a system to move fund from one location to another whenever in need. So you can predict, manage cash accurately. You know when where you need cash, being ready with your funds. It reduce paperwork, it reduce error. To electronic cancellation leads to effective fund management, right? Saves time. Now you know that where do you require money, where you don't require a loan, so it saves interest, and you can pay your staff on time. For banks, with this technology, even non-banks now offer financial services. So bank have started offering fee-based service. So bank will earn a fee for this cash management service, like managing payment for companies to make steady income. A bank now offers services like salary transfer, electronic vendor payments, etc., and charges fees for them. So apart from earning interest from giving loan, bank is also indulging itself in fee-based services. A major revenue comes from fee-based service as well. And cash management services is one of the service offered by banks in India. Let's understand type of cash management for services which are offered by bank. So number one, there is cash collection service. Now for businesses that deals with physical cash, bank offers that will collect your cash, will arrange the pickups for your cash daily from store safely. Excuse me. Number two, for fund transfer services, it is used to pay salaries and taxes. A company can directly transfer salaries to bank employees, to employees' bank accounts. Um, Now, then there is check and DD issuance. Here, bank help companies to issue checks, demand draft, even in remote locations. NEFT, bulk disbursement used for large or bulk payments to multiple peoples or vendors. NACH payments for regular payments like EMI, utility bills, dividend, etc. It is used. Auto sweep facility. It moves extra money from current accounts into FD to earn interest. Advanced services are being offered by foreign banks as well, which includes, but it's not limited to, global cash pooling, investment advice, treasury management, so on and so forth. Now, let's quickly understand the challenges in cash management. Even though tech has made things easier, banks and businesses still face some challenges. Now, what are they? Number one, understanding the client's business. Bank must know the nature of the business to offer the right cash solution. So, bank has to offer the customized solution. So every company is different. So, one size fit all does not work. Bank has to choose the right software, whether to build it, buy it, or outsource it. Many firms in India are small, and they need simple and affordable services. And bank must coordinate with different departments like finance, IT, marketing teams of the company to make this thing work. Um, there are security risks with online banking, we cannot deny it. Fraud and hacking are big concerns, and so reliability on the internet is sometimes also a challenge. So we need to make sure that the internet must be secured, it must be fast, and always working for real-time cash movements. So let's begin today's class. So when a customer writes a check from their bank account, they are giving instructions to their bank to make a payment to someone. Now the banker has a legal duty to honor this check, but only when there is enough money in the customer's account and that balance is properly applicable. However, the bank must also make sure that the check is written properly and meets all legal conditions. Now, the law that deals with checks and other financial instruments is known as the Negotiable Instruments Act of 1881. So, this particular act defines negotiable instruments. In section 4, it defines promissory note, section 5, bill of exchange, and section 6, it defines the term check. And these instruments are called negotiable because they can easily be transferred from one person to another to receive the money. Uh, we'll start with promissory note because we'll cover section by section. So, we'll start with section 4, then we'll understand bill of exchange, and then we'll move to check. So, a promissory note is a written promise by one person to pay a specific amount of money to another person. It is not a currency note or a bank note. According to section 4 of the Negotiable Instrument Act, it must be signed by the person who is promising to pay, and the promise must be clear and unconditional. For example, if the note says, I promise to pay B 500 rupees, this is a valid promissory note. But if the note say, I promise to pay B rupees 500 after I win a lottery, it is not a valid promissory note because the payment depends on a condition, and only statements that are clear promise to pay a fixed amount of money are considered promissory notes under the law. Now let's move on to bill of exchange. A bill of exchange is slightly different from a promissory note. Here, instead of a promise, bill of exchange is an order. It is a written document where one person orders the another person to pay a specific sum of money to a third party. According to section 5, this order must be unconditional and clearly written. For example, a businessman might order his customers to pay a certain amount directly to the supplier. That written instrument becomes a bill of exchange. Even if the payment is to be made after some days or on a future date, it is still valid as long as the event is expected to happen for sure. And the person who's making the bill is known as the drawer, and the person or bank directed to pay is known as the drawee. Now let's understand check, and will I'll make you familiar with the other terms like holder in due course, etc. So a check is basically a written order. It is a type of bill of exchange drawn on the bank. So it is basically a written order from the account holder to their bank asking it to pay a certain amount to a person. According to section 6 of the Negotiable Instrument Act, a check is a special type of bill of exchange. It must be made payable only on demand and must be drawn on a specific bank. A check can be given from a savings account or a current account, but not from a fixed deposit. The bank is legally required to honor the check if it has been properly drawn, there is sufficient balance, and uh, the balance is properly available. Check can also be issued in electronic form using computer or digital signature. This is called electronic check. And we have understand about truncated check in CTS. So truncated check means physical check is scanned and only the image is used for clearing without moving the actual paper. Now let us understand about drawer, drawee, holder in due course, etc. So in both checks and bill of exchange, the person who makes the instrument is called the drawer. This is the person who gives the instruction to pay. The person who's supposed to pay and the to pay the payment is called the drawee. For example, if Mr. A writes a check to Mr. B from his account in HDFC Bank, Mr. A is the drawer, HDFC Bank is the drawee, and Mr. B is the payee. So, who's a payee? Payee is the person who will receive the money. Payee is the person who receives the money. Holder, a holder is someone who has the check, bill, or promissory note in their name and has the legal right to receive the payment. Even if check is lost or destroyed, the person who originally held the instrument in their name remains the rightful owner and can claim the money. Holder in due course. A holder in due course is a person who received the check or instrument in good faith and he has given something in return, such as money or goods, and had no reason to suspect that the check was stolen, forged, or involved in fraud. This person is protected under the law and has a full right to claim the money from the instrument. Negotiation simply means transferring a check, bill of exchange or promissory note to someone else so that they becomes the new holder. Payment of a check. When a bank receives a check for payment, it cannot and should not blindly pay it. And the bank has to follow certain things. The bank checks the branch on which the check is drawn. Normally, the checks should be presented at the branch where the account is held. However, with the core banking systems, checks can now be paid at any branch of the bank, not just the one where the account is located. Number two, date. Banks look at the date on the check. The date must be current, and if the check is dated more than 3 months, so it was dated 3 months earlier, it is considered stale. So the validity period is 3 months. Earlier it used to be 6 months, but in 2012 it was reduced to 3 months. So it is considered stale and cannot be paid. If it is dated for future, it is called a post-dated check, and the bank cannot honor it before that date. This is because there may be a risk of the drawer cancelling it or other events like death or insolvency happening before the future date. Pay details. The bank check pay details. The check may be written in the name of one person, a joint person, say X and Y, or it can be written to either of the two persons, say X or Y. So either one can receive the payment when it says X or Y, or if it says X and Y, then both must be present to receive the payment. Sometimes the check is made payable to cash, which means anyone can present it. However, if it says X only, it must be paid to only to that person X and not to anyone else. Order or bearer check. Now the bank has to look into whether the check is an order check or bearer check. An order check can only be paid to the person named on it or someone to whom they have endorsed it. The bank must check the identity of the person presenting it. If it is a bearer check, it can be paid to anyone who presents it at the counter. The bank usually takes signature of the presenter on the back of the check as the receipt. Amount in words versus figures. So, another important thing to check is that the amount written in numbers and in words matches. For example, if the check shows rupees 1000 in figures and 1000 in words, then it is fine. But if shows 1000 in figure and 100 in words, then the bank will return the check. As per the law, the amount would be taken as a final, but in practice, if there is any mismatch, the checks are returned. Crossed or not. So the bank also check whether the check is crossed or not. Cross checks cannot be paid in cash and must be deposited into a bank account. So this is a security feature, and we'll discuss about later. We'll discuss all about types of crossing. The bank also has to check whether there is endorsement or not, and bank has to verify that endorsement. If the check has been signed on the back and passed on to another person, the bank checks if the endorsement is regular and proper. For alterations, if there is any alteration or correction on the check, like changing the name or amount, it becomes invalid unless the drawer signs next to the change to approve it. Any major change without the drawer signature will make the check void. Mutilation means the checks get torn or damaged. So if the check was accidentally torn by the account holder, they can sign it again to confirm it is still valid. If was torn by the bank can still honor it by writing on the back that they guarantee the check. Signature verification. So the bank check the signature of the drawer, and signature must match the bank's record. If the signature is forged, the bank must not pay the check because there is no valid mandate exists if the signature is forged, and we'll discuss it in detail in unit number 13. There's a plenty of case laws on it. Bank should check for stop payment instructions. So bank must also check if there are any stop payment instructions. So if the customer has told the bank to stop payment of a check, the bank must not honor it. In a joint account, any one holder can give stop payment instructions. But for partnership firms, companies, cancellation of such instructions must be made by all authorized person. So basically, one person can provide stop payment instruction, but to revoke it, uh, the instruction of all the partners or all the authorized persons is required. The bank will also check that the balance is sufficient. There is no court order, there is no attachment order, and bank has no notice of draws, death, insolvency, or insanity. Payment in due course. So under the Negotiable Instrument Act, a bank is protected from liability only if it makes payment in due course, and this has been defined under section 10 of the Negotiable Instruments Act. Payment in due course means that the check is paid as per the clear instructions visible on the face of the check, in good faith, without negligence, and to someone who is in legal and lawful possession of the check. This protection is important for bankers because it prevents legal action against them if they have acted carefully and honestly. So apparent tenure means the visible and clear instructions of the check, such as date, name of the payee, amount returned, whether it is bearer or order check. So this is apparent tenure. When we say good faith and without negligence, so good faith means being honest, and without negligence means being careful and not careless. So if a deposit slip has the correct name of the customer, but the account number is wrong, and the bank credits the money without verifying the name and the number together, it is negligence. In such cases, even if the bank is honest, bank is acting in good faith, the protection will not apply because they did not act carefully. At last, the check must be paid to a person in possession of it, meaning someone who is holder in due course. This means that the check is being handed over to someone who received it lawfully and not found it or stole it. Bank also has to ensure that the person receiving the payment is entitled to get the money. There should be no reason for the bank to suspect that the person is not the true owner. Liability of paying bank. So according to section 31, a bank must honor a check if there is enough balance in the account and there is no reason to stop the payment. If the bank refuses without valid reason, it must compensate the customer. However, even if there is money, payment may not be allowed if that fund is not properly applicable. So what do we understand by properly applicable? For example, there are stop payment instructions, or the drawer is deceased, or there is garnishee order or attachment order, or the funds are earmarked for a specific purpose, or the balance is not clear. In that case, the funds are not properly applicable. The law also provides protection to the bank if uh, in certain cases like order checks, the bank is protected even if the endorsement is fake as long as it looks regular. For bearer checks, the bank can pay anyone who presents it even if there are fake endorsements. Drafts get similar protection, and if a check is materially altered but it is not visible and the bank acts in good faith, it is protected under section 89. So in unit number 13, we will discuss about the protections of the paying bank. We will discuss about section 31, section 85, 89, 128. So we'll discuss in detail in unit number 13. So we'll discuss about 85, 89, 128, 127, and 129. So these sections provide protection to the paying bank. Section 85 provides payment. Basically, if the endorsement is forged and it is uh, the bank acted in good faith, then the bank is protected. 82 provides for bearer check, 85 aids for draft, 89 is for materially altered checks where there are no visible changes. So the changes cannot be detected by a naked eye. Duties of collecting bank, again we'll discuss it in detail in unit number 14, but for brief, let's understand it here as well. So collecting bank is one that collects check and draft for its customer. If the bank collects a check for someone who is not the owner, the bank will be held liable, uh, because this is conversion, wrongfully dealing with someone else's property. And to avoid this, the bank must meet three conditions. Number one, bank collects only for the known customers with proper KYC. Secondly, the check must be crossed before it is received. And thirdly, the bank acted honestly and carefully. If these conditions are fulfilled, the bank is protected under Section 131. Endorsements of check. So endorsement means signing a check or any negotiable instrument by the person who has it, the maker or the holder, for the purpose of transferring it to someone else. This signature is usually made on the back of the check or sometimes on a separate slip of paper attached to it, which is called along. So endorsement, signing the instrument for transfer. Let's understand different types of endorsement. Blank endorsement. It means the person just sign on the back without writing anyone's name. This makes the check similar to the bearer check, so anyone who holds it can claim the money by just presenting it. Full endorsement is where the person signs and also writes the name of the person to whom it is being transferred. For example, pay to Rahul or order. Signed Amit. This means the check is now payable only to Rahul or someone Rahul further endorses it. A conditional endorsement. Here the endorser attaches a condition to the payment and the person can receive payment only if the condition is met. Restrictive endorsement limits the use of check. For example, if it say pay to Ramesh only, then only Ramesh can receive the money and the check cannot be further transferred. Facultative endorsement is when the endorser gives up certain rights, like the right to get a notice if the check is dishonored. So even then the endorser remains liable if the check is not paid. Crossing of check. Crossing a check is a way to make it more secure. It tells the bank that the check must be paid only through a bank account and not in cash over the counter. This helps in keeping the record and avoid misuse. Now, Section 123 to Section 131 of the Negotiable Instrument Act deals with the crossing of check. So there are two main types of crossing. The first is general, second is special. So general crossing is where two parallel lines are drawn on the front of the check. Sometimes word like and company or not negotiable are also written between the lines. This means that the check can only be deposited in a bank account, not in cash directly. Second is spatial crossing. So spatial crossing is where the name of the particular bank is written across the check along with the two lines. This means that the check must be paid only to that specific bank. For example, if the check says State Bank of India, then only State Bank of India or its collection agents can collect it. Not negotiable crossing. So a not negotiable crossing does not stop the transfer of the check, but it removes special right of a holder in due course. This means the person receiving the check cannot get a better title than the person who gave it. Account pay crossing. Account pay crossing is not defined in the law, but it is widely used in practice. It is written as account pay or pays account only. So this instructs the collecting bank to credit the check only to the account of the named payee. As per RBI instructions, bank must follow this strictly. And even if a check has been issued, the holder can add a crossing. If it was not crossed earlier, the holder can cross it generally or specially. Also, the holder can write non-negotiable if they want to restrict its negotiability. Forged instruments. A forged instrument is one where someone has made changes or signed it falsely without the permission. This could include forging the draw signature, changing the name of the pay, altering the amount, or modifying the date. Such instructions are not valid and the law does not protect their use. If someone tries to cash a forged check, even if bank pays it by mistake, the payment is not considered legal, and if the signature is forged, the bank will not get the protection because there was no legal mandate, and the person who received the money must return it because forgery gives no legal title. The rightful owner of the check has the right to claim the money back. fraud or forgery affects only those involved in the fraud. It does not affect a holder in due course who took the instrument in good faith or and sorry yeah, the holder in due course took the instruments in good faith and without knowing about the fraud. But if someone knowingly takes a check obtained by fraud, they also loses the right to recover their money. So when a bank receives a check for payment but the required conditions are not met, it has to dishonor or return the check. And the bank must mention what are the reasons of dishonor. So the common reasons why a check may be dishonored includes uh, there was not enough funds in the account, there was no prior arrangement with the bank, the amount exceeds the arrangement, there was a stop payment instruction by the drawer, or the account is closed. And in the modern CTS environment, other reasons may include like check presented in the wrong clearing zone, it required documents missing, the original check has not been received, there was a failure in digital verification, so on and so forth. Now, what happens when dishonor is due to insufficient fund? So, when a check is returned because of insufficient funds or exceeds arrangement, it is treated as a criminal offense under Section 138 of the Negotiable Instruments Act, provided three conditions are met. Number one, the check is presented within 3 months of its issue date. Number two, the payee, the person who received the check, sends a written notice to the drawer within 30 days of check return demanding payment, and the drawer fails to make the payment within 15 days of receiving the notice. So, if these three conditions are met, a person will be liable under Section 138 if the check has been dishonored due to insufficient funds or if it exceeds arrangement. If all this happens, so the drawer can be punished with imprisonment of up to 2 years or a fine up to twice the amount or both. There were some important case references. So, in case of Bhupender Lima, the court held that the legal heir of the drawer cannot be held criminally responsible. In G. Venkateramaiah case, it was held that even if a check is dishonored because the account was closed, it is still an offense under Section 138. In S. Bhadram, if a check can be presented, it says that a check can be presented multiple times during its validity. And in N. Sivalingam, the court held that for post-dated checks, the validity period is counted from the date mentioned on the check. Let's understand some legal provisions. Section 141, offenses by a company. So, if a check is bounced by a company, not only the company but also the persons responsible for running the account, like managing director, they are also considered guilty. However, government nominated directors are not held liable. Also, once a cause of action arises, the legal time starts ticking, and the presenting the check again does not start a new legal time. Section 143, summary trial. The offence under Section 138 is usually tried by judicial magistrate or metropolitan magistrate in a summary manner. The magistrate can impose a jail sentence of up to 1 year and a fine of up to 5,000 rupees. Summons may be sent via speed post or courier. So, the magistrate may direct that the court summons to the accused or witness can be served using speed post or court approved courier services to speed up the process. Section 145, evidence by affidavit. So, the complainant can submit their statement in the form of an affidavit. Affidavit is a written sworn statement. So, this can be used in the trial unless there is a valid objection. Banks dishonor memos prima facie evidence. So, when the bank returns a check, it gives a return memo with a stamp or mark stating the reason. In court, this memo is treated as proof that the check was dishonored unless the drawer proves otherwise. Section 147, offences are compoundable. So, offences under Negotiable Instrument Act are compoundable, which means that both the parties can settle the matter outside the court and end the case with mutual consents. Section 148, appeal and deposits. So if the drawer files an appeal against conviction, the appellant court, the higher court may ask the drawer to deposit at least 20% of the fine or compensation order by the lower court before proceeding with the appeal. So section 31 of the Negotiable Instruments Act says that if a bank, when you say the drawee, has enough money of the customer, the drawer, uh, and the money is properly available for payment, the bank must pay the check when it is properly presented. And if the bank refuses to pay without a valid reason, it must compensate the customer for any kind of loss. So what are the key features? Number one, section 31 available is applicable. It applies only to banks because a check is always drawn on a bank as defined in the law. Secondly, sufficient funds should be available. The customer must have enough balance in his account. For example, if a person named um, say A has 10,000 in his account and writes a check of 14,000, the bank will refuse to pay the money. But if the person writes a check of 7,000 rupees, the bank should ideally pay. So the customer must have enough balance in his or her account. Number third, the funds are properly available, meaning to say the money in the account should be free to use and not under any restriction. For example, if the account is frozen by the court, the bank cannot pay even if the balance is enough. So there should be no garnishee order, no attachment order. It should not be under lien, so on and so forth. The check must be properly drawn. The check should be filled correctly and signed by the account holder. The signature does not match the one registered with the bank, the check is invalid. And if the bank wrongfully dishonors the check, if the bank refuses to pay a valid check without any valid reason, it must pay damages, but only to the customer and not to the person holding the check. Again, there are certain exceptions to it. If the bank goes bankrupt, the check holder becomes a creditor and can claim money, and the bank wrongly ignores the crossing on a check, the real owner can also claim in that particular scenario. And if the bank wrongfully refuses a check and the customer suffers a financial or reputation loss, the bank must pay for the damages. Now, section 85 and 89, these two sections provide protection to the paying bank. So, section 85 states that if the bank follows proper procedure while paying, it is protected even if the check later turns out to have problems. We'll discuss it in detail. We'll discuss with case laws, don't worry. And section 89 states that if the check has been altered but the change is not visible, like someone changed the amount with invisible ink or very skillfully and it is not visible to the naked eye, the bank is not liable if it acted in good faith. If the signature is forged, what to do then? So now let's talk about a very important situation: forged signatures. So if a forged signature appears on a check, the bank must not make any payment. This is because it's not the real signature of the customer, so there is no mandate from the customer. So when there is no valid mandate, the bank cannot pay. Let's discuss a few important case laws. Number one, Canara Bank versus Canara Sales Corporation. In this particular case, the company's accountant forged the signature of the managing director on 42 checks. But the bank paid those checks. When the fraud was discovered, the company demanded the money, but the bank refused. So, the matter goes to the court, and the court states that the bank should have detected the forgery. It had no authority to debit the company's account because there was no valid mandate. That is why the bank will be held liable. Number two, Beta Cooperative versus Bank of Bihar. So in this particular case, a cooperative society had a joint account operated by two persons, joint secretary and the treasurer. A check was signed by one real person, but the other signature was forged. The bank paid the check. A matter went up to the court. and the court states that there was no valid mandate to the bank, there was no valid instruction provided to the bank because one signature was forged. The bank was wrong in paying, and that is why the bank was held liable. So even if one signature is forged in a joint account, the check is invalid. Uh, let's now discuss Section 85 a bit. To get legal protection under Section 85 of the Negotiable Instruments Act, the bank must make the payment in due course. So, what is due course? Due course is defined under Section 10 of the Negotiable Instrument Act. When the payment is done, the payment should be made to the rightful person, to the holder, to the agent, or the servant of the holder. The payment must be according to the apparent terms of the check. It should be in good faith and it should be without any negligence. What do we understand by the term apparent tenure? It means what has been instructed on the check, the bank has followed. And if the bank fails to do so, it cannot get legal protection and it may be held liable for the loss. There are three important case laws. Number one, Bank of Bihar versus Mahabir Lal. What happened in this case was a firm took a cash credit loan from a bank. The bank agreed to pay the clothes supplier directly and take the clothes as pledge, the security. A check was drawn and the bank gave the cash to its own employee to go with a partner to the supplier. Now that employer ran away with the money. Bank asked the firm to return the money, but the firm refused. The bank sued the firm claiming protection under Section 85. Now the matter went up to Supreme Court. Supreme Court states that there will be no protection to the bank. Reason being, the payment was made to the bank's own employee, not to the supplier and not to someone from the firm. So this was not payment in due course. Hence, the bank had to bear the loss. So, what is the takeaway from this case? That bank must ensure that the money is paid to the rightful party and not just any person. Case number 2, Bhutoria Trading Company versus Allahabad Bank. In this case, a company sold jute and got an uncrossed check from the buyer. The check was made payable to BTC or order. One of the BTC's manager took the check, endorsed it using company seal, and cashed it at the bank's counter. Later, the company said that the bank should not have paid the money to the manager and hence sued the bank. The matter went up to the court, and court held that the bank was not liable. The check was correctly endorsed with an official seal. The bank had verified the identity of the manager. There was no negligence and the payment was made in good faith. This was a valid case of payment in due course. So if the bank follows proper checks, pays in good faith, there is no fraud, there is no negligence, then the bank will be protected. Third case, Madras Provincial Cooperative Bank versus official liquidator. What happened in this case was a liquidator of the company got a check in his official capacity. He went to the bank and encashed the check over the counter. He misused the money and he was removed. The next liquidator who was appointed sued the bank. Matter went up to the court and the court states that the bank was negligent. Law required that a liquidator must deposit all money into a bank account, not take it in cash. So the check was in his official capacity and the bank even verified his appointment. So the bank should not have allowed cash payment. Hence, this was not a payment in due course and the bank had to return the money. So the key takeaway which you can learn from this case was if the check is for someone acting in an official or legal position, bank must follow the legal process strictly. Any shortcut can make them liable for the loss. Payment in good faith without negligence of an instrument on which alteration is not apparent. So under section 89, a bank is protected if it pays a check that has been altered, but the alteration is not visible and the check appears genuine. However, this protection applies only when the payment is in good faith, without negligence, and as per the apparent tenor of the check. So let's understand it with a case law. Bank of Maharashtra versus Automotive Engineering Company. So in this case, a man altered a check chemically using fraud. Originally, the check was for some 95 rupees, 95 9.98 paisa in favor of Mr. Pardawala, but it was changed to approximately 6,500 rupees and the name was altered. This check was deposited in another bank and passed through clearing. The Bank of Maharashtra paid it, thinking it is genuine. The issue arises that the firm who issued the original check found it and objected about the payment. The trial court said the bank was negligent because it did not use a UV lamp to detect the alteration, even though forgery was common in that area. So there was a check which was chemically altered. Visual inspection showed no sign. Uh, a UV lamp for that particular purpose, if used, could have found that the check was forged. The bank did not use that UV lamp, and therefore the trial court held that the bank is negligent. The matter went up to the Supreme Court, and the Supreme Court states that the bank is not required to use high tech tools like UV lamps for every check. If the alteration is not visible to the eye and the check looks normal, then the bank is not negligent. In this particular case, the bank had checked every possible thing like signature, date, serial number, and everything appeared fine. Hence, the bank was protected under Section 89 of the Negotiable Instrument Act, and the suit was decided in the bank's favor. So the lesson is a bank is protected if it pays a check in good faith and does all the usual checks. There's no negligence, there's no fraud on bank's part, and no tampering is visible. Second case is Brahma Shumshri versus Chartered Bank. So in this particular case, a prince had an overdraft account. He sent a check for 256 rupees, but someone intercepted it and changed the amount to 2,34,000 rupees. The bank still paid the amount, and the prince claimed that the bank should have inspected something wrong because the handwriting was different. The matter went up to the court, and the court viewed that the check was signed by the prince and he had earlier issued checks written by others. There is no visible alteration. Therefore, the bank was protected under Section 89. Case number 3, Tanjore Permanent Bank versus S.R. Rangachari. So in this case, Mr. R gave the bank three blank signed checks. One check was correctly used for 16,000 rupees, but the other two checks were altered by the bank's accountant and amounts of 7,600 rupees and 4,200 rupees were filled in with the names of two clerks. The alteration were clearly visible. The Mr. R sued the bank, went up to the court, and the court decided that the alteration were visible and not authenticated by Mr. R. So bank cannot claim protection under Section 69. If alteration is apparent and still paid, then the bank is at fault. Bank cannot claim protection under Section 89. Bareilly Bank Limited versus Naval Kishore. In this particular case, Mr. N opened an account with approximately 20,000 rupees, and to be precise, it was around 19,900. After 17 months, when he wrote a check for 5,900, he was shocked to find only some 430 rupees were left in his account. Bank said that the three checks were already paid. Uh, it was a long time ago, but the truth is, those three checks were not from Mr. N's checkbook. The specimen signatures used was forged, and the ledger entries were tampered, and even the bank's employees were involved. Matter went up to the court, and the court held the bank liable because the checkbook issued was not used, signature was forged, and there were signs of fraud by bank employees. So, in this particular case, bank was not able to get the protection under Section 69. Payment by bank under mistake, whether it is recoverable or not, let's understand. So, there was a case, United Bank of India versus AT Ali Hassan and Company. A check for 5,000 was presented to the paying bank by another collecting bank. The check looked perfectly genuine, but actually the signature and writings were completely forged. The paying bank did not realize and make the payment. So the forgery was so perfect, even it was undetectable to a trained eye, right? Uh, the paying bank did not realize and make the payment. Later, the paying bank found out that it was a forgery. Bank filed a case to get back the money from the collecting bank and the pay. The collecting bank states that we did a normal job. We collected the check, gave the money to our customer in good faith. The pay said some people came to me claiming they were from a company. They gave me this check to buy the goods. I supplied the goods only after the bank told me that the check had been cleared, and I have no idea about the forgery. The case went to Calcutta High Court, and High Court dismissed the bank's appeal. Why court dismissed the appeal? So, because the forgery was so perfect that even trained bankers could not detect it. Everyone acted in good faith. No one tried to cheat. The pay changed his position. He already gave away the goods before knowing the check was forged. The court held that if someone acts honestly and suffers a loss because of a forged check, they should not be forced to return the money. The paying bank made the mistake, and that's why the paying bank should bear the cost. Now, what is principle of equity? That the principle of equity means fairness and justice, doing what is morally right. It helps to protect innocent people who acted honestly and fairly. So, equity principle states that there should be no unjust enrichment and innocent parties should not be made to suffer. Hello everyone, welcome to JIB CIB Prep. In today's video, we're going to discuss about unit number 14. In last class, we discussed about the responsibilities of the paying bank, and in today's class, we'll discuss about the responsibility of collecting bank. And in this particular unit, we will understand about section 131 of the Negotiable Instrument Act. What are the conditions for getting protected? What are the different duties of the collecting bank? And we'll follow a routine of practicing the questions. So, let's begin today's session. Under section 131 of the Negotiable Instruments Act, a collecting banker, the bank which collects a check on behalf of its customer, so it's a collecting bank. The collecting bank is protected from liability in case the check turns out to be a stolen check or a forged check. But again, this protection is not automatic. The bank gets this protection only if it follows certain conditions. So, what are these conditions? Let's understand one by one. To get protection, the collecting bank must follow these 6 conditions. Number one, the bank should be honest and should not have any malified intention, meaning to say, the bank must act in good faith. So, if a check looks genuine, the bank can collect it for the customer. The bank should act without any negligence. The bank should be careful and follow normal rules and checks. So, if a check has signs of tampering, like overwritten amount, the bank must not ignore these signs. The bank should not be negligible on its own part. The bank must the check must be collected for a customer, meaning to say the check must be collected only for someone who has an account in the bank. So, if someone walks in without an account and gives a check for collection, the bank must not collect it. Check must be crossed. The check should be crossed either generally or specifically. Generally with 2 lines or specially, meaning to say in favor of that particular bank. So, a cross check is meant for account deposit and not for cashing at the counter. So, that what cross check do. the bank should check the genuineness under CTS. So the bank must verify if the check looks genuine when scanned under check truncation system. So if the check image shows irregularity, the bank must investigate in that particular scenario, and the bank must carefully examine the check to catch any visible signs of fraud, forgery, or any changes. So the bank should follow due diligence. If a check shows the name or amount has been altered, the bank must not collect these kind of checks. So due diligence has to be followed. Now let's understand duties of the collecting bank. Although the law does not give a list of duties, but Section 131 says that bank must not act carelessly. The bank should act in good faith. The bank should act without any negligence. And to prove that the bank is not negligent, the bank must show it followed all standard safety steps like a responsible bank should do. So let's understand these duties one by one. First duty is to open the account with sufficient proofs, with sufficient documentary proofs rather. So the bank should follow KYC norms. The bank should collect photograph, ID proof, address proof, and the bank should verify customer details before opening any account. So the first case which we need to understand with regard to this duty is Ladbroke versus Todd. So this is a old case, 1914. What happened in this case was a thief stole a check and forged the payee signature. He opened an account in a bank without giving any reference or proof and deposited that stolen check. After the check was cleared, he withdrew the money and obviously he disappeared. So the bank was held liable because bank did not follow the basic checks and balances. The bank should have taken proper documents. The bank should have identified the customers, should verify the customer's identity, and the bank should have asked for a reference before opening the account. So this case shows that if a bank is negligent, it will not get protection under Section 131 of the Negotiable Instrument Act. Second, we have Syndicate Bank versus Jayashree Industries and others, 1994, All India Record. So what happened in this case was Syndicate Bank opened an account in the name of Messrs. Axel Conductor Industries Limited. But the bank staff did not verify whether this was actually a registered company or not. So no documents like memorandum of association or board resolution were collected, and the account was actually treated like a sole proprietorship instead of a company. So you imagine someone opens an account claiming to be a limited company, but the bank does not check if the company really exists. They treat it like a shop owned by one person. So that's what exactly happened in this case. A draft for 2,50,000, uh, 2,50,000 was deposited into this account. The money was withdrawn the next day, and then later the original buyer of the draft filed a case saying that the money was wrongly credited and withdrawn. Matter went up to the court. The High Court found negligence on the part of bank. The bank ignored the word limited on the account name, even though it is meant as a company account. Staff did not bothered to cross check or ask for any proper documents. So the bank claimed protection under Section 131 of Negotiable Instrument Act, which protects bank when collecting checks. But in reality, the bank did not follow the conditions in order to get this protection. So the bank, uh, to get the protection, the bank should act in good faith. The bank should not be negligent. Bank should collect the check for a real customer, and the check must be crossed. But this bank failed on all accounts, and that's why the bank was not entitled to get a protection under Section 131. Indian Bank versus Catholic Syrian Bank. So, in this case, a person named D opened an account in Indian Bank at Salem branch. So, he was introduced by an existing customer of the bank. The bank believed that the introducer, the person who already has an account with the bank, was a big businessman. But in reality, he was a small time account holder with a meager odd 190 rupees balance in his account. So let's say a stranger comes to you, comes to open an account and introduced by your friend who has 200 rupees in his account. The stranger says he's from Delhi, want to do business. So would you believe him just like that and open an account? So that's what happened in this case. Soon a demand draft for 20 was forced and altered to 29,000 in favor of D. D deposited, bank credited his account, and the next day D withdrew most of the amount through a self check. Now the bank which issued the original draft found out and asked for the return of the money. The matter went up to the court, and the court, this matter was listed before Madras High Court. So the Madras High Court said that Indian Bank acted without caution. It opened the account without checking D's background, business or address, and the manager didn't even bother to ask the permanent address or proof of business. And that is why the court held that Indian Bank, the collecting bank, was negligent, and that's why the bank is not entitled to any protection under section 150, under section 131. Second duty is to duty to confirm reference where referee is unknown, where introducer is unknown. So earlier what happened is Indian banks often opened new accounts only after receiving an introduction from existing customer. But when this was not possible, especially in newly opened branches, banks started accepting references from known people in that locality or from other banks. So even when a reference is provided, the bank must verify the referee and ensure that the customer being introduced is genuine. Any failure to verify can lead to legal consequences, of course. And let's understand important case, Harding versus London Joint Stock Bank. So in this case, a person opened a new account in the bank. He did not deposit cash, which was a usual practice. Instead, he deposited a check issued by someone else. And to prove he was authorized to use that check, he showed a letter from his employer, but this letter was forged. The check was actually stolen, and the bank failed to verify with the employer whether this person had permission to use the check. The court held that the bank was negligent because it did not take the basic step of verifying with the employer. The court said that if there is any doubt, the bank must make inquiries, and not doing so amounts to negligence. Duty to follow KYC norms under PMLA and KYC directions of RBI. So KYC, know your customer, is a process where banks verify the identity of the customer to prevent fraud, money laundering, and misuse of the banking system. And how does bank do so? By collecting the documents and verifying it. So our documents like official valid documents, Aadhaar card, passport, voter ID. Bank also collect PAN cards. Bank collects proof of current address. And for small accounts, the rules are relaxed. We have already discussed about these documents in our previous units. So we'll not going to discuss here in detail. But the bank has to verify customer's identity via various checks and balances. So, bank collects official valid documents, PAN card, proof of identity for small accounts. These documentations were relaxed, but again, time limit is provided within which these documents have to be provided to the bank. Duty regarding check crossings. So bank must be extra careful when handling cross checks. And there are two types of crossing: general crossing and special crossing. Crossing is basically check has two parallel lines and it must be deposited in a bank account. With respect to special crossing, check mentions a specific bank name and it must be deposited in the account at that bank only. Also, if a check is marked account payee or non-negotiable, bank must not credit it to any other account. One important case law with regard to this is Crumpling versus London Joint Stock Bank. So a check with non-negotiable crossing was deposited, and the question was whether the bank was negligent for collecting it. The court held that just because a check is marked not non-negotiable does not mean that the bank is automatically negligent. But the bank still has a duty to act carefully and check whether it's handling the check as per instructions or not. Duty to verify instruments for any apparent defect in the instrument. So, if a check or instrument clearly looks suspicious or does not belong to the person presenting it, the banker has a duty to ask questions. Ignoring red flags can make the bank liable for negligence. Let's discuss some important case laws. Underwood Limited versus Bank of Liverpool Martin Limited. So here the managing director of the company took company checks and deposited them into his personal account. The bank did not question why company money was going into a private account, and that's why the bank was held negligent, because it failed to ask simple and obvious question: why is the company money going into your personal account? Bank ignored these things. Bank was clearly negligent. Hence, no protection will be provided to the bank. Case number 2, Chevry and Company versus Lloyds Bank. In this particular case, two dishonest clerks working for a stockbroker stole bearer checks that were meant for the company. They deposited these checks into one of the clerk's personal account and his wife's account. The bank never collected details like employer's name or husband's occupation, and that is why the bank was held liable, because it failed to carry out basic due diligence and ignored suspicious circumstances. Case number 3, ANG Bank versus Ateliers. So an agent of a company deposited the company's check into his own personal account. The bank was careless and did not ask any explicit permission. However, the court found out the company had in fact implicitly allowed the agent to do so. So even though the bank was negligent, it escaped liability because the principal had given implied authority. So the bank was saved because of implied authority here. Case number 4, Morrison versus London County and Westminster Bank. So in this particular case, the manager of a company had authority to sign checks on behalf of the firm, but he used this authority to write checks payable to himself and deposited them into his personal account. The bank allowed this without making inquiries, and that's why, even though the manager was authorized to sign, the bank should have asked question when the checks were made payable to himself, and that is why the bank was held negligent. Duty to take into account the state of customer's account. So when a bank collects checks on behalf of customer, it must pay attention to the customer's background, job profile, lifestyle. So this is to ensure that nothing suspicious is going on. Suppose someone is working as a clerk in a company and its salary is 10,000 per month, and suddenly a large check amounting to 10 lakh start coming into his account. So the bank should not blindly collect those checks. Instead, the bank should ask question or check whether such large amounts match the person's income or business. And if the bank ignores and just collect the money, it may be held negligent. So let's understand a case law. NU Stilo Footwear Limited versus Lloyds Bank. So in particular case, a company that made ladies footwear was cheated by its own secretary, who opened a fake account, a fake bank account in another name. Now he deposited 9 checks worth somewhere around 4,800 pounds, which actually belonged to the company. So the bank did not check whether this new account holder had a real business to justify these large amounts. The court said that the bank was careless, the bank was negligent because it did not make proper inquiries. The money being deposited did not match the customer's profile, so the bank should have suspected something out of it. negligence of collecting bank in collecting checks payable to third parties. So just a minute. So banks must also be careful when collecting checks that are written in someone else's name, the third party checks. So if person brings in a check that is not in his own name, the bank should verify if he has the right to collect it. Let's say a check is written in the name of the officer in charge, military office, and if normal individual comes to the bank and say deposit this in my account, the bank should not simply accept it. The bank should ask for proof or check whether the person is actually the officer or has permission from the officer, right? So let's understand this Ross versus London County case now. So a man used checks meant for Canadian military office to pay his personal debts. The check clearly stated that they were meant only for officers in charge, but the bank did not inquire or check anything. The court said the bank was negligent because the name written on the check clearly showed it was meant for third party, not the person depositing it, and hence the bank will not be able to claim the protection under section 131.
So remittance, what is a remittance? It simply means transferring money from one bank branch to another, either within the same bank or to a different bank. For example, you are in Delhi and you want to send 10,000 rupees to a friend's account in Mumbai. Now, what you will do? You will use a remittance method. So there are different remittances method like demand draft, mail transfer, telegraphic transfer, NEFT, RTGS, MT and TT, mail transfer and telegraphic transfer. They are now outdated. Electronic modes have made them redundant. So you can use different ways. Say you want to send the money within the same city, so you can say use banker check, else you can use DD, MT, TT, NEFT, RTGS. So bank charges service fees for these remittances, and with the arrival of core banking fintech apps like phone pay, Google Pay, and online transfers, MT and TT are now almost never used. Before understanding about demand draft and banker checks, let's quickly understand how does a customer make a remittance. So you need to fill a bank application form and mention mode of remittance, name and address of the person you are sending money to. The person who is receiving the money is known as beneficiary. So in this unit, whenever we say beneficiary, he or she is the person who receives the money. Now amount to be sent. Now beneficiary's bank name and account number needs to be given, and what is your name, your address and your account details. Now you give all this information and then you do remittance. Remittance means sending money. Now let's move forward to demand draft and banker check. So what is a demand draft? A demand draft is a kind of order from one bank branch to another to pay a fixed amount to someone. For example, if you're applying for a college in another city, they may ask you for fees to be sent through a DD. Now, it is not a check, but for the purpose of law, for Negotiable Instruments Act, it is treated like a check, though it is not a check, and it cannot be made payable to bearer. Bearer meaning to say, if you handed over the DD, anyone can encash it. So this will amount to currency, and that's why a demand draft cannot be made payable to a bearer, as that would make it like a currency, which is not allowed under RBI Act section 31. Banker check. What is a banker check? So a banker check is used for local payments only, meaning within the same city. If a bank wants to pay to a contractor for office repairs, it may issue a banker check. And when can a banker check be used? So at the request of customer, or to pay money from a deceased person's account to legal heir, to pay local bills or contractors for local statutory dues like electricity bill, or for all other local check payments, banker check can be used. But there are some important rules like if amount is 50,000 or more, then it must be paid through a bank and not in cash. If the amount is 20,000 or more, it must be issued as account pay and paid only into a bank account and not in cash. And from September 15, 2018, purchaser's name must be printed on the demand draft or banker check. It has the same validity as a check, that is 3 months, and it can be revalidated but only once, for once, and that too within a year. So demand draft can be revalidated but only for once, and that too within 1 year, and after 1 year it is cancelled. Now What about cancellation and refund? So refund is given only if original DD or banker's check is returned unused and with no signs of endorsement. The customer must also prove their identity. In case of loss of DD or banker's check, a duplicate can be issued if it is lost and payment has not been made. Purchaser or beneficiary must give an indemnity. So indemnity is that I will save you from the loss, and bank must issue the duplicate within 15 days. If delayed, bank must pay interest for the extra time taken, and kindly note that no interest is paid if the request is made by the third party holder. All right. Mail transfer and telegraphic transfer. So earlier you can send money from one bank branch to another via post, which is called as mail transfer. So if a person in Chennai wanted to send money to his son's bank account in Delhi, he could request a mail transfer. The money would be directly credited to the beneficiary's account, and it will generally take about 7 days. But again, this is now obsolete. So we'll understanding it for just for the sake of understanding. TT was similar to MT, but the message was sent through Telegram. It is quicker than MT, but again, it takes somewhere around 2 days. And these two methods are no longer used. So these two are no longer used. NEFT, National Electronic Fund Transfer System. It is an electronic system started by RBI in November 2005. It allows people to send money from one bank account to another anywhere in India safely and quickly. Now, it works in batches and not instantly. If you send money using NEFT, it is processed in the next available time. So, there are 48 batches in a day, half an hour batch. So, money is transferred into batches. All payment in that slot are settled together in what it is called as a deferred net payment system. So, DNS, deferred net settlement system, is used. For suppose you want to transfer 5,000 rupees through NEFT at 2:15 p.m. So the transaction will include the next batch, say 2:30 p.m. and process then. The beneficiary will get the money within few hours. Now, one thing you need to understand is that there is no minimum or maximum limit on the transfers. Each bank branch that supports NEFT has a unique IFSC code. IFSC is Indian Financial System Code, and uh, you can also send money using NEFT from India to Nepal using Indo-Nepal Remittance. Remember it. So it is the NEFT payment system which supports Indo-Nepal Remittance Scheme. What are its benefits? So it is fully automated and easy to use. It is safe, secure fund transfer. There are no courier or paperwork needed. Easy refund if money is not credited. It is quite useful for regular payments like bills, EMIs. Again, bank charges are very low. Money reaches within a few hours and you get the confirmation when the money is sent. RTGS, real time gross settlement system. It is also an electronic fund transfer system, but it works in real time on a gross basis, unlike NEFT. This means the money is transferred immediately. Each transaction is settled one by one without combining with others. So, NEFT use DNS, deferred net settlement. RTGS uses gross settlement system. One key point is here the minimum amount is 2 lakh rupees, no upper capping, but there is a minimum transaction amount to use RTGS facility. So, which is 2 lakh. RTGS is available 24 into 7, all days, all hours. And you need some information before doing RTGS, like the amount to be sent, your account number, beneficiary's bank name, branch, IFSC code, beneficiary's name, and beneficiary account number. Now, RTGS credits money based only on account number and not on name. So, make sure you enter the correct account number. What are its benefits? Very safe and secure, available 24/7. It is fastest way to transfer large sum of money. It can be done online or through branches, and it is real time processing. There is no waiting time, and fund must reach to the beneficiary's account within 30 minutes and no later than that. Electronic benefit transfer. So EBT is a system used by the central and state governments to send money directly to the bank account of people who gets benefit from schemes like social security scheme, rural employment schemes, old age pension schemes, insurance scheme for the poor. And why EBT? Why electronic benefit transfer? To avoid delays and remove the middlemen. to make sure money reaches the right person and to support financial inclusion, that is bringing everyone into the banking system. How does it works? So EBT started under the idea of one district, one bank, now called direct benefit transfer, and the government selects one bank as the leader in each district, and this leader bank works with other banks in that district to make sure everyone gets the money. Now let's understand the steps involved in EBT. So the state government deals with one leader bank per district. That leader bank signs contract with other banks for sharing the work. Now the nodal department of the state gives list of the people who will receive the money. Other banks open accounts for those people and give them smart cards using business correspondents. The government send money to the leader bank, and leader bank send this money to other banks, and those banks credit the money to the people's account. So it is like this: state government send money to the leader bank send money to other banks, and these banks send money to the people's account. Now, all this happens on the same day, and people can also get services like deposit accounts, small loans, remittances, and credit for farming, Kisan credit card. Now, what are the key important initiative or measures? So, open bank account for all beneficiaries and link Aadhaar, set up a DBT coordination committee in each district, show the names of the business correspondents on state level bankers committee website and village wise. Each bank must set up a grievance redressal system and appoint officers to resolve Aadhaar related issues. Public sector banks again uses Aadhaar payment bridge system, and banks are installing ATMs in rural banks, issuing debit cards and appointing business correspondents in places where banking was not available. Now let's understand about safe deposit lockers. A safe deposit locker is a secure storage space that a bank provides to its customers so that they can safely store valuable items like jewelry, property papers, or other important documents. And to use this locker, the customer pays a fixed rental fees per year, and that determines the relationship between bank and the customer. So there are two relationships. When the locker is given on rent, the relationship is that of lessor and lessee, and when the customer puts item for safekeeping, then the relationship between the bank and the customer is that of bailey and bailor. So there are two relationships, lessor and lessee. It is like landlord and tenant. So the customer uses your locker, gives a premium or a rent in for using the locker facility, and when item is uh, given for safe custody, when it is put in the locker, then the relationship is that of bailor and bailey. The customer is the bailor and bank is the bailey. Now, how does it work? So each locker has two keys. One key is with the customer, also known as the hirer, and the other is a master key, which lies with the bank officer in charge of the lockers. And to open the locker, first the bank officer uses the master key, then the customer uses their own key. To lock the locker again, the customer key alone is enough, but for opening, both the keys are required. And who can get a locker? So individuals can get a locker, companies, partnerships, trusts, societies, associations can get a locker. Individuals singly or jointly can avail locker facility, but kindly note that minor cannot use the locker facility. Locker cannot be issued in the name of minors. So even businesses like diamond traders uses lockers to keep their stock safe, and in some cases multiple parties may rent a locker to share or uh, to store a shared item like devices that contain confidential software codes. Hiring out a locker. So RBI issued guidelines in 2021 to make locker operations safer and more transparent and customer friendly. While hiring out a locker, before giving a locker, the bank check the customer's KYC details. So KYC and customer due diligence needs to be done before the allocation. Their photographs of the locker hirer and the person allowed to operate the locker must be taken. A clear agreement must be signed saying no illegal or hazardous item will be kept inside. If the bank suspects any illegal use, it can take all the necessary actions which are required. When lockers are allocated, Bank should keep a list of available lockers and a waiting list, and the process of allotting locker, it must be transparent. Bank should follow the model locker agreement created by IBA as per Supreme Court guidelines in the case of Amitabh Dasgupta versus United Bank of India. And the terms of the agreement should be fair and not too harsh for the customer. Locker rent varies. Locker comes in different sizes like small, medium, large, and with rent charges in advance. If the rent is not paid on time, the bank may charge a penalty. And if rent is overdue despite notice, the bank can break open the locker and recover its dues from the content. And if the locker is surrendered early, the bank must refund the unused rent. The term deposit as security as a safety measure, banks may ask for a fixed deposit equal to 3 years rent plus locker breaking charges. But this is not compulsory for old customers or those with well managed accounts. And bank cannot force customer to open FDs unnecessarily. Keep that in mind. Infrastructure and security. So lockers are kept in a vault with strong protection. Entry and exit points are covered with CCTV and recordings are kept at least for 180 days. If someone complains about unauthorized access or theft, the CCTV footage must be kept until police investigation is completed. The locker room should be protected from flood and fire, and lockers should follow BIS standards. Mechanical lockers require both keys, and electronic lockers must follow RBI cyber security rules and a keep for permanent log of activities. The all locker keys should be marked. All the keys must have the bank branch code for identification, and the bank should regularly check that the keys are safe and working. Locker operations. So only the locker holder or a person authorized by them can operate the locker. Each entry is recorded in an access register with the date, time in, time out, and signature. No bank officer or other locker holder is allowed to stay inside the locker room when someone is opening the locker. And every time a locker is operated, a SMS and email must be sent to the customer mentioning the date and time. Also, when a locker is given up, when it is surrendered, the locks must be changed and keys of empty lockers are kept in a sealed cover. Duplicate master keys are kept safely in another branch and proper record should be maintained. There should be end of day checks. So bank officer checks whether all lockers are closed properly. If a locker is open, it is sealed immediately and the customer is informed. And the room is also checked to ensure no one is left inside and no item is lying outside. And all details of locker usage and key management are maintained in bank software, that CBS systems. Nomination and death claims. So if a locker is operated, earlier only single nomination was allowed, but with recent changes, up to 4 nominees can be appointed, but on successive nomination basis, that is priority basis. We have already discussed it. We are not discussing it in detail now. And if a locker is operated jointly by two or more, then again nominations can be up to 4. Earlier, there was a single nomination, and for jointly there can be more than one person. The bank must take nominee's photograph if the customer agrees, and if the customer signs with a thumb impression, 2 witnesses are required to attach the nomination form. So if the customer provides thumb impression, 2 witnesses are required for the 2 witnesses are required to attach the nomination form. And the bank must give an acknowledgement when a nomination is made or cancelled. Now, what about death claims? So, bank must follow IBS model policy for settling claims. The death certificate of the locker holder and identity proof of the nominee are usually sufficient. Bank should not ask for succession certificate, court order, indemnity bond. So, bank should not unnecessarily harass the nominees, and the claim must be settled within 15 days. Keep that in mind. It is quite important from the exam point of view. So the claim must be settled within 15 days from the date of the claim is received. And there can be different situations. Let's discuss them. So what if a sole logger holder dies? In that case, nominee is given access after verification and an inventory is made. If it is a joint locker and one dies, so the surviving holding Member plus nominee are allowed to open the locker after inventory is made. If the joint locker with either or survival clause and one person dies, in that case, bank follows the instruction already given. And if there is no nominee or no clear instruction, in that case, bank may allow legal heirs to access locker based on proper documentation and bank policy. But a few caution has to be maintained by bank. That is, the bank must verify the identity of the nominee or legal heir. Bank must confirm the death via documents. Bank should ensure that there is no court case or order is pending and the information that exists, and it informed that the excess is only as trustee. The nominee is not the owner but only act as a trustee. Closure and discharge of locker items. So there can be multiple reasons when lockers can be broken open. For example, a customer loses the locker key and requests break open. If the government agencies get a court order to seize the locker, if the customer does not follow the terms, not paying rent, not cooperating, so there is a break open process. If the customer loses key, so locker opened only after customer is identified, gives written request and is present with the bank staff. If there's a law enforcement seizure, in that case, bank must ensure the order is genuine and inventory is made in the presence of government officers and two witnesses and a bank officer. Video recording is to be done and copy of inventory is sent to the customer. If there is non-payment of rent for 3 years, bank gives notice and then public notice in two newspapers. Locker broken in presence of two witnesses and bank officers, and the contents are to be recorded, stored in sealed covers, and not opened by bank unless legally allowed. If the locker is inactive for 7 years, even if the rent is paid, if the hirer is untraceable, contents may be transferred to nominee or legal heirs or disposed after following due process. Locker operations rules effective 1st January 2002. So the alert must be given. So customer gets SMS and email each time locker is operated. Must include time, date, and redressal contact for misuse. If the content are lost due to theft, fire, fraud, or building collapse, bank must pay 100 times the annual locker rent. For example, if the locker rent is 2000, the compensation is 2 lakh rupees. Locker safety standards are to be followed. So, new lockers must have BIS safety standards. Electronic lockers must follow RBI cybersecurity guidelines. Locker keys must carry bank branch code, and banks may allow extra padlocks by customer if possible. Also, banks will not be liable for act of God for natural disasters, but they must take preventive steps. Liability of bank. So bank must have a board approved policy on responsibility for loss of content, safety and functioning of locker, protection from unauthorized access, and prevention of theft, fire, etc. And banks are not liable for natural disasters, but they must take reasonable safety precautions. Custodial services. So a custodian bank is like a caretaker of your financial assets. People or companies often invest in shares, bonds, and other securities. These investments need to be stored safely so they are not lost, damaged, or stolen. That's where the custodian banks come in. It safely keeps these assets either in physical form like paper certificates or in electronic forms like demat accounts. Now, the key services provided by the custodian banks are settlement, safekeeping, and reporting. Settlement, making sure that when you buy or sell a security, the exchange of money and securities is done properly. Safekeeping, safely holding the securities, and reporting, mean to say giving regular updates and statements about your holding. So, these services are offered to wide range of clients like mutual funds, insurance companies, corporates, investment managers, trust, endowments, or high net worth individuals. Portfolio management services. So, portfolio means a basket of investment, usually a mix of debt like bond and equity. Debt gives fixed interest income, while equity gives dividend and a chance for value to grow over time. Portfolio management means managing this basket in a way that gives the best return while keeping risk low and ensuring liquidity, that is, easy access to cash. So there are some key principles, basic principles, that is, We focus on portfolio and not individual security. So one share going up or down is less important than how the entire portfolio performs. High return comes with high risk. To earn more, you need to take higher the risk. This depends on timing. So when you plan to withdraw your investment, it matters. Diversification reduces the risk. It helps. Investing in different type of assets reduces the risk. Customized approach should be there. So each person portfolio should suit their goal, income and tax situation. It is a very competitive market. So many experts try to beat the benchmark. So the prices adjust quickly to new information. Again, RBI has also given guidelines on PMS. So investments are at customers' own risk. No return is guaranteed. Minimum investment period should be 1 year. Fund must be invested at market rates. No favors. Funds should be not be given to other banks to manage. Bank charges a clear fees. It does not depend on the returns. Funds to be invested only in capital market instrument and not in loans or money market. All transactions should be transparent and recorded properly. And if there is any fund lying idle, then CRR or SLR requirement must be followed. Merchant banking. Merchant banking mainly means helping companies raise money from the market. These bank manages new share issues, arrange loans, and give advice to companies about finance and fundraising. So a company, for example, company wants to raise 100 crore through IPO. So merchant bank helps in valuing the company, filing documents, finding investors, and managing the entire issue process. So merchant banks must registered with SEBI as category 1 merchant bankers to do with this merchant banking. And they can also do loan syndication, arranging a group of lenders, payment of interest, dividend warrants, or to bridge loans to temporary finance before full funding. Government business. In India, many financial transactions of the government, like tax collection or pension payments, are handled by selected banks. And these banks are called agents of the RBI. So, approval is required from CGA, from State Finance Department, from RBI itself. So, public sector banks and private banks are allowed to do government business. Example of government business like collecting income tax, customs, GST, opening and maintaining PPF accounts, handling treasury accounts and railway revenues, managing pension payments to retired government employees, issuing and accepting application for relief bonds or saving bonds, levying of service charge. So banks can fix service charge on their own, but again they must follow certain guidelines. So while charging, a bank must ensure that the charges are reasonable and reflects actual cost. People with low activity in their account are not to be penalized, and all charges must be approved by the bank's board. Now, there are RBI norms for reasonable charges. So, our basic banking services must be low cost, especially for rural people, for pensioners, and for senior citizens. Even if the service is part of the bundle project, like our premium savings account, basic services should be made available separately at reasonable cost. Charges must be lower for individuals than for companies. They should be more relaxed for vulnerable categories. Justified and communicated clearly in advance. Banks must disclose charges through notices, through websites, through newspapers, through customer welcome kits, and any change, a notice of 30 days prior should be provided to the customer before there's any increase in the charges. So RBI has prescribed ceiling for the charges that can be levied by the banks for RTGS and NEFT transactions. So for transaction of 2 lakhs to 5 lakh, RTGS maximum charge can be 24.50 paisa plus applicable GST, and above 5 lakhs, it should not go beyond 49.50 paisa plus applicable GST. For NEFT up to 10,000 it is 2.5 rupees plus GST. For 10,000 to 1 lakh it is 5 rupees. For 1 lakh to 2 lakh it is 15, and above 2 lakh it is 25 rupees plus applicable GST charges. It is for outward transactions and no charges must be levied on inward RTGS or NEFT transactions. So let's start financial inclusion. So what is financial inclusion? Financial inclusion means providing basic and affordable financial services like savings account, loan, insurance, to people who are poor or live in remote area. Now, these are the people who usually do not have access to bank or cannot afford banking services. And why this financial inclusion is important? Because it helps poor people become financially secure. It allows them to save, invest, to take loan, to bring these people into the formal economy, and it reduces their dependence on money lenders. And in a way, it also helps the economy to grow uh, because now more people participate in it. NGOs, SHOs, microfinance, they play a pivotal role with respect to financial inclusions because they help to connect rural people with banks. They empower women by encouraging them to save and borrow in groups, and they spread awareness about financial products. So these are the reasons why financial inclusion is important. Microfinance. So earlier microfinance means only giving small loans to poor people, but now it also includes micro insurance, meaning to say small insurance policy, micro pension for old age, micro remittances, basically sending a small amount of money, and digital payments like UPI. Now, how banks extend their services using business facilitator, business correspondent models. So, bank alone cannot open branch in every village. So, RBI allow them to use two models, basically business facilitator model and business correspondent model. In business facilitator model, banks uses helpers or intermediaries who do not handle cash, but they help people to connect with bank. And who can become a business facilitator? So NGOs, self-help groups, farmers club, post offices, panchayats, agri clinics, village industries, KVX units. So these all can become business facilitators. And what do? They identify people who need loan. They help fill out loan applications, spread awareness about savings and banking, promote self-help groups or joint liability groups, and they help in monitoring the borrowers and follow up for recovery. Now, it is important to understand that they do not handle money, and banks do not need RBI's permission to appoint them. Number two is business correspondent model. Now, this model is more powerful. Business correspondents can handle cash, open accounts, and deliver most banking services in villages. Now, who can become business correspondents? So, retired teachers, ex-servicemen, retired bank government staff, kirana shop owners, medical shop owners, PC operators, insurance agents, self-help members, linked with banks, NGOs, microfinance institutions, post office, and company with large rural presence can become business correspondents. Now, what can business correspondents do? So they can open bank account in remote areas. They can collect deposits and repay loans. They can disburse small loans. They can sell insurance, pension, mutual fund products. They can help in sending and receiving small remittances, and they help in distributing cash, coin, or subsidies. Now, before moving forward for the condition for engagement, we also need to understand one thing, that NBFCs can in general cannot be used as business correspondent, but can in any circumstance an NBFC can become a business correspondent? So answer is yes. uh, NBFCs which are non-deposit taking can become business correspondents, but some conditions are to be fulfilled, like bank money and NBFC money should not be mixed. There should be a proper agreement between the bank and the business correspondent, and NBFCs cannot force customers to buy their own services along with the banking services. So, if these conditions are met, then NBFCs can non-deposit taking NBFCs particularly can also be used under business correspondent model. Now, what are the terms and conditions for appointing business correspondents and business facilitators? So, bank can pay business correspondent and business facilitators a reasonable commission for their services, but they cannot charge any fee directly from customer. So if a business correspondent helps someone open a savings account, the bank pays, not the customer. They cannot ask the customer to pay. Technology use. So working with the business correspondents involves risk like fraud or mismanagement. So banks should use technology like handheld devices, mobile apps that is connected to the bank's central system. Risk management and safeguards. So business correspondents should have clear rules like a limit on how much cash they can hold, provide receipts for all cash collected, and customer must know the bank is responsible and not the business correspondent. Bank should provide protect customer data and information. Regular village level meetings with customers, business correspondents, branch officials, and sometimes district level officers should be held. If business correspondents contract ends, they should there should be a backup for uninterpreted services. If one business correspondent work for two banks, each bank's customer data must be kept separately. Ultra small branches. So these are small and simple bank branches set up in villages from where business correspondents can operate. Usually set up 3 to 4 kilometers from business correspondent locations, and they are managed by full-time bank staff. They should have a computer, printer for passbook, and a safe for storing cash. Grievance redressal for business correspondent services. So bank must set up a system to handle customer complaints about business correspondents, business facilitator service. Name and contact of the grievance officer should be made public. Timeline for handling complaints should be available on the bank's website. And if the issue is not resolved within 60 days, the customer can approach the business ombudsman. ICT in financial inclusion. So technology can solve the problems of banking in remote areas. Even illiterate customers can use banking services through biometrics like fingerprint verification. For example, a farmer in remote village can check his account balance using his fingerprint on a device which is operated by a business correspondent. Customer education. So bank must educate people, especially in rural areas, in their local language about the benefits of using banks. Uh, for example, teaching people why it is better to keep money in a bank than at home, how to use ATM or how to save using recurring deposits. So these measures can be taken by the bank. Payments bank. Payment banks are banks that focus on small savings and payments and remittances services. So they basically help migrant workers, small businesses, local income households, and they offer plethora of services like savings account up to 2 lakh per person, debit card, internet banking. Please keep in mind that payments bank do not issue credit cards. So they allow a person to pay utility bill for or to pay for insurance, to pay for mutual funds, and they must have 25% of outlets in rural areas through ATMs or business correspondents. So it is okay, but 25% of their presence should be in rural areas. Self-help groups linkage programs. So self-help groups are small groups of rural poor people who save together and lend to each other. A bank must provide loans to self-help group members to support their livelihood. Co-lending by banks and NBFCs. In 2020, RBI allowed banks and NBFCs to co-lend to important sectors like agriculture, micro, small and medium enterprises, etc. Now here banks have lower cost of funds and NBFCs have wider reach. So in co-lending model, both of these features are combined to serve the people better. Use of mobiles, tablets in financial inclusion drive. So first thing we need to understand is what is mobile banking. Mobile banking means using your phone to do banking, like you check balance, you send money, you pay bill. Now, cheaper smartphones and data plans have been made easier, especially after COVID. So, it is a blessing in disguise. Mobile phones are used to open small accounts and offer services in areas with no banks. So, business correspondent agents can use phones with point of sale machines to collect the money. But again, it has its challenges. So security issues are there. Different mobile phone types, and first time users, it is harder for them. Banks and telecom companies must make the apps that work on all devices. So again, that is a challenge. Benefits is also there, that instant money transfer, there's no need to visit the bank branches, and all non-cash services can be done through the bank. USSD based banking, it is launched in 2012. So it lets user dial star 99 hash to access banking. There's no internet needed. It works on basic phones too. And in 2016, UPI with USSD 2.0 was launched to allow even more features. Digital onboarding, this means helping customers join digital banking easily. There are two focus areas. Number one, making platform more accessible, and number two, managing the risk. Aadhaar and video KYCs are used for onboarding. Digital lending, loans are now given via mobile apps and online platforms. RBI has made rules to stop unauthorized lenders and to protect the customers. For example, if you take a loan from a digital lender, RBI rules ensure it is a registered and safe platform and not scam. Financial literacy. Financial literacy means knowing how to manage your money properly. It helps people understand how to use financial products like savings account, loans, insurance, and digital payments. So, in simpler words, it is a skill of making smart decisions about spending, saving, borrowing, and investing your money. For example, if someone understands how interest on a loan works or how to save money in a bank safely, the person is financially literate. And financial literacy and financial inclusion are two pillars. Financial literacy works on the demand side. It makes people aware of what they can ask for, like loans, insurance, or saving schemes. And financial inclusion works on the supply side. It makes sure that bank and financial institution provides these services to the people. Why financial literacy is important? Because financial literacy uh, for is important for country's financial growth and stability. In India, it is even more needed because many people are still not using formal banking systems. It helps people prepare for life events like marriage, education, retirement, or medical emergencies, and also it helps people from falling into debt traps or frauds. Who need financial literacy? It is everyone who needed financial literacy, but not just the poor or rural people. So users of financial services are the poor people without access to bank, middle class families who save and invest, and again rich people who makes complex financial decisions. They require financial literacy. Secondly, providers of financial services require financial literacy. Banks and financial institutions must also understand financial risk and customer needs. And last but not the least, policymakers and regulators, so RBI, SEBI, PFRDA, they must know what people need and how to design proper rules and strategies. Now, how is it taught? So, how is financial literacy being shared? RBI has asked banks to open financial literacy centers. These centers teach schools and college students, women, rural people, pensioners, and others about how banking works, and the goal is to help people make better financial choices. Let's understand about RBI's initiatives. So, number one is National Center for Financial Education. It was set up in 2013 with support from RBI, SEBI, IRDAI, and PFRDA. These Center for Financial Education implements the National Strategy for Financial Education. It conducts NCFE, NFLAT exam. It is basically a test to encourage school students, class 8 to 10 students to learn basic finance, and it offers online learning programs to youth, adults, and teachers through a special e-learning system. Center for Financial Literacy. It was launched in 2017 by RBI as a pilot project. These centers are set up at block level across India, and they are run with the help of banks and NGOs using community based approach. These centers aim to promote financial literacy, protect customers, and promote financial inclusion. Rural Self-Employment Training Institutes. So they are the project by Ministry of Rural Development. These institute gives skill training to rural youth to help them become self-employed. They are managed by banks with help from central and state government, and this model is based on the 1962 concept of Rural Development Training Institute. What are the objectives of RSETIs? So training should be demand driven. That is based on what the job market needs. Training field decided after checking trainees' interest and skill. Then we link trainees to bank loans so that they can start their own small businesses. Follow up for 2 years after training to ensure the business is running successfully. A short-term residential training is provided, usually 1 to 6 weeks, with free food and free stay. So these are the objectives which we have just covered. Let's start. Customer service. It means helping and supporting customers before, during, and after they use a service. So in simple words, it's about being polite, giving correct information, solving problems quickly. So if a customer visits a bank to open a savings account, the staff should guide him politely, help fill the form, and answer any doubts. So this is a good customer service. Banks have huge network in India, so they must maintain high standards of customer care. The RBI also wants to improve banking services and has issued many rules for better customer services. In May 2022, RBI formed a six-member committee headed by former Deputy Governor BP Kunangu to review the service quality in banks and NBFCs. Now, the committee checks how well banks are following RBI guidelines regarding customer service rules, and it also suggests changes, especially for online and digital banking. Now, let's understand customer services in bank. Banking is a very strict and regulated sector. Since bank handle the public's money, RBI gives many rules to ensure that customer service is not ignored. Uh, we understand by organizational framework for customer service. Now here, to make sure customer service is given importance, RBI wants banks to create committees and assign departments to handle customer service properly. We understand four committees. Number one, Customer Service Committee of the Board, CSSB. So this committee is made at the top level of the bank, the board level. It includes bank directors and customer representatives. It discusses service quality, policies for depositors, and how to improve service. It also looks at complaints handled by the banking ombudsman. Standing Committee on Customer Service. It acts like a daily working team to ensure a customer service is functioning properly. It includes senior officials like CMD, ED, and even non-bank people to give fair feedback. It checks if RBI rules are followed in spirit and not just on paper. Branch level customer service committee. It is made at every branch, and at least one senior citizen should be included. They meet once a month to discuss customer complaints, delay in services, suggestions to improve, and it reports to the higher standing committee. Nodal officer department. So each bank must have a dedicated department or officer at head office and zonal and controlling offices. Now this person or department is the first point of contact for grievances. Even RBI and ombudsman contact this official first. Board approved policies on customer services. Bank must have certain written policies for customer care. These should be approved by the board, shown on the websites and branches, notice board on the branches, and shared with customers when they join. Will understand with comprehensive deposit policy. Now, this policy explains the right of depositors, especially small account holders. It must cover account rules, charges, and maintain privacy of customers' information. Banks should not force depositors to take unwanted services for placing a deposit. Check collection policy. Now, this policy covers when the customer will get the money for local and outstation checks, time taken to clear the checks, and interest to be paid if there is any delay. Customer compensation policy. This explains when and how the bank will pay customer if there is a mistake or delay. Now it covers fraud or wrong debits, delay in check collection, delay in duplicate draft, and any loss due to bank's mistake. Customer grievance redressal policy. This is a detailed document that shows how customers' complaint will be handled. It includes the time frame and the process. Policy for general management of the branches. Banks must have a board approved policy to manage branches better. This ensures smooth services, good customer experience, and efficient functioning. Now, it includes better infrastructure at branches. So, every branch should have proper space, furniture, drinking water, cleanliness, and special facilities for senior citizens, pensioners, and differently able people. Uh, Bigger branches should have both reception and separate inquiry counters to guide customers. All counters must have indicator boards in multiple languages, especially local languages. And banks should assign staff to roam around and help customers. So there are roving officials, especially those facing difficulties. Banks should provide booklets explaining services and facilities in local languages, and bank staff should try to talk customers in the regional language of that area. If it is Hindi, then bank staff should talk to the customers in Hindi. If it is Marathi, in Maharashtra, speaking Marathi builds trust with the customers. So, if a customer understand English, you explain the rules to him in English. So, security arrangement must be reviewed and upgraded regularly. Staff should be trained on how to behave and serve customers better. Officers from head office should visit branches to inspect the real situation and suggest improvements. And banks should conduct audits and ask for customers' feedback to identify areas of improvement. Also, banks should hold meetings to talk with customers from all sections and understand their needs. And before launching any new product or service that may affect common people, bank must take approval from the board. Bank should also appoint officers to ensure all policies are actually being followed in the branches. ATM operations. Due to wide usage of ATMs, it is important that bank ensures smooth and secure ATM services. Now, a customer gets 5 free transactions per month at their own bank's ATM, 3 free at other banks' ATM in metro, and 5 free at other banks' ATM in non-metro cities. For each ATM transaction, including balance inquiry, the system must ask for the PIN in order to avoid fraud. And uh, at every ATM, banks must display helpline number for complaints and RBI standard complaint form. Bank must show no cash message clearly on the ATM screen before transaction, display ATM ID inside the booth, keep complaint form with officers contact, provide toll-free numbers to block cards or report problems, and register mobile numbers or emails to send the alerts. If an sorry, if an ATM remains without cash for more than 10 hours in a month, the bank has to pay a penalty of 10,000 per ATM. And any dispute in failed ATM transaction must be settled through ATM system provider and not by the private deals between the bank. If a customer complains about money being wrongly debited, the bank must resolve it within 5 working days, T plus 5. And if delayed, the bank must pay 100 rupees per day as compensation directly to the customer's account. Now let's understand security issues and risk mitigation measures. Now with the rise of digital banking like using debit card, credit cards, internet banking, UPI, cyber frauds are increasing. Many customers are not very tech savvy which makes them easy targets. That's why RBI has introduced strong security rules for banks and customers. Now to reduce misuse of cards, a bank should issue cards with advanced features like EMV chips, contactless tech. If a customer reports a card loss, the bank should immediately block it and do the paperwork later. Banks must tell customer clearly how to report card loss or fraud through helpline, SMS, email, websites, mobile app, and this should be available 24 into 7. After blocking, send confirmation to the customer. Alert should be given to the customer. Also, customers should get SMS or email alerts for every transaction done using their cards. CNP transaction, card not present transaction. CNP means card is not physically used, like shopping, online shopping or phone orders. For such transactions, bank must add an extra layer of security like OTP or password. If the fraud happens without this extra security and the customer complains, the bank must refund the money. secure electronic payments. There are two type of electronic payments: remote payments and face-to-face payments. Remote payments are online UPI and net banking. Face-to-face is like swiping card at the store. Bank must keep the system safe, and some risk reducing steps include uh, let customers set limits for their daily transactions, limit number of beneficiaries that can be added in a day, add security alerts for suspicious activity, use dynamic OTPs, track IP address to catch fraud. SMS email alerts must be mandatory. Customers should be able to reply to alert SMS or email to report fraud instantly. If a customer has not shared a mobile number, they should not get access to the online banking. Limiting customer liability in online fraud. So customer has zero liability if fraud was due to bank's mistake, and if fraud happened due to someone else a mistake in the system, it is not because of the mistake of the customer or mistake of the bank, and the customer reports it within 3 working days, then the customer has zero liability. And the customer is liable if customer has carelessly shared his account details, his card details, but again only until the time they report that the customer is liable, and after reporting the bank bears the loss. If the delays in reporting is 4 to 7 days, the customer pays up to a certain limit. For BSBD accounts, the maximum liability is 5,000. For savings bank account, prepaid cards, MSME, OD accounts and credit cards up to 5 lakh, the maximum liability is 10,000. And all other accounts and credit card above 5 lakh, the maximum liability is 25,000. And if it is reported after 7 days, then the bank will decide based on its policy. Bank can also choose to waive the liability completely for goodwill. So these are the limits which I just discussed. Services at counter. So bank must ensure good services at their branches and follow proper working hours. Uh, let's start with business and working hours. So staff must report 15 minutes early, minimum 4 hours. Daily counter service for public should be provided. Bank can fix their own business hours, and rural branches can set timings based on the local needs. But the bank have to follow the local laws, and no counter should remain unattended during the working hours. If a customer is inside the bank at closing time, they must be served, and certain tasks can be done after business hours, like no voucher uh, generated, so no money handling. Activities like issuing passbook, statement of accounts, delivering term deposit receipts, accepting share application forms. So these activities can be done after business hours, or voucher based transaction where there's limited money involved, like collecting locker rent, issuing traveler or gift check, opening term deposit. So these activities are allowed. Evening counters. So when we say evening counters, bank in urban and metro areas can have evening counters for public convenience beyond regular hours. And every medium or large branch should have "May I help you?" a counter or inquiry desk. Staff should help customers choose the right deposit schemes as per their needs, and branches must keep a complaint and suggestion box at a visible place. There should also be online complaint systems. Information to customers. So bank must give clear and easy information to their customers so that they can make good decisions, understand their rights, and know the services which are available to them. Notice boards in bank branches. So board must display 4 types of information, and that notice board should be minimum of 2 by 2 feet. So the board should display customer service information, service charge, grievance redressal, and other important information. And this information should be updated regularly. It should be easy to read. It should be in English plus in our local language. It should highlight any recent changes and mention topics for which booklets are available. So bank must also give printed booklets or pamphlets that include customer service details, all service charges, grievance redressal mechanism, and do's and don'ts for the customers. Information on website. So all important information must be available on the bank's website. It should be easy to find from the homepage. And bank can also use touch screen, information kiosk, scrolling bars, and tag boards to display the information. Bank must show the range and average of interest charged on recent loans, total fees and charges for different types of loans. APRs should be displayed so customers know the true cost of the loans. Other information should also be displayed on the website. It must include details like policy document, complaint mechanism, loan application form, deposit interest form, charges for services, etc. And bank must clearly display how many days it will take to approve or reject the loan. Now, the service charges, free services like balance inquiry, minimum balance required, and penalty for not maintaining, it must be available at the branch and must be in local languages. And charges for outstation check, demand draft, checkbook should be made available to the customers. Also, bank must educate customers about services offered, required document and rules and legal formalities and the limitations. Special arrangement at the branches. So bank must provide ramps for wheelchairs. Even if people can't come and can't sign, they are sick or elderly account holders. So bank must help them. Uh, Bank must provide facilities for usually impaired people. Bank must allow ATM usage, net banking, checkbooks, credit cards, and locker facility, and staff must help if needed. ATM must speak instructions. ATM must have braille keyboard keypads, and branches must also keep magnifying glasses for people with low vision. Bank should open and manage account based on legal guardian documents issued by the competent authority. Other provisions. So all forms must include third gender option. So there must be an gender inclusion. When customer submitted form 15G or 15H, these form for no TDS. So bank must give a receipt or acknowledgement. Timely TDS certificate should be provided. Form 16A, it must be issued within a deadline as per tax rules. Banks cannot refuse to accept cash at counter, and any such restriction is considered as unfair trade practice, unfair banking practice. Sorry, not trade practice. It is unfair practice. And if fraud is committed by bank staff, then the bank must pay. If bank is at fault, then customer must be compensated. And if it is the fault in the system, customer must still be compensated up to a certain limit. Bank must assist income tax officials, and if any staff helps in tax fraud, serious action will be taken against them. Bank can also let managers approve small loans without security for the trusted customers, and all calculations must be round off to the nearest rupee. Let's begin the video. Banks have a special relationship with their customers. This relationship is based on trust and contract. One of the key duties of a bank is to keep the customer's account details secret and confidential. But this duty is not absolute. That means bank can disclose customers' information only in specific situations. Now, bank can disclose information in four cases: when the law demands it, when it is in the public interest, when it helps the bank itself, and when the customer agrees. So now let's understand one by one. Disclosure under compulsion of law. So in some situations, bank must disclose information as required by law. Bankers Book Evidence Act. If there's a case in court involving a bank customer, the bank can submit certified copies of account entries, not the original books, but only when the court or authority has the power to ask for it. In court summons, if a civil or criminal court asks for a document or evidence, the bank has to submit only what is asked. Income tax officers may ask for bank details under Section 133 if needed in a tax matter. The bank must give the information and inform the customer. Again, there are other statutes where banks have to follow the obligation to disclose the data, like Companies Act 2013, RBI Act 1934, FEMA, gift tax. Disclosure in public interest. Bank may disclose if the customer is involved in serious crimes like terrorism, drug smuggling, international activities, but the bank must be very careful because the term public interest is a vague and sensitive term in law. Disclosure in bank's own interest. Sometimes it is important for the bank safety to share information. giving details of a borrower to the guarantor to recover the money, sharing information with other banks to avoid giving loans to defaulters. As per law, every bank must uh, be a part of credit information company and share the customer loans and credit details to CICs. With customer's consent, if a customer asks the bank or gives consent, the bank can share the information. For example, customer tells the bank to share account details with an embassy for visa purposes. So here the customer himself or herself is allowing the bank to disclose the data. Duty of reasonable care. Bank must act with reasonable care while handling customer's account. For example, if a bank loses the customer's check or make a wrong transfer due to carelessness, the bank must compensate the customer for the loss. Garnish your attachment order. So we have discussed it in Unit 7. We have discussed it in detail. So if a person owes money and has power, if the person owes money and has money in the bank, the court can order the bank to freeze the account. In this case, the bank cannot let customers withdraw or use the money. If only part of the balance is attached, the amount is moved to a suspense account. The remaining balance can be used by the customer or a new account may be opened. If the order is in one name, it does not apply to joint accounts, but if the order is in joint names, it can apply to individual accounts too. Bank rights, so bank lien, right of set off, right of appropriation, we have discussed in detail in Unit 7 and we are not discussing it here. Right to charge interest or commission, so bank have the right to charge interest on loans and commission on services. Bank is not doing charity, so when bank provides loan, bank charges interest, bank has a right to do so. And when bank provides service, bank charges are commission for it. If there is an agreement with the customer, charges are applied accordingly. And if no agreement is there, bank uses standard market practice in that case. Termination of bank customer relationship. So this relationship can end in two ways: voluntarily and by termination by law. Involuntarily, customer can close the account anytime. When customer shift to another city, customer can close the account. Also, a bank can close the account if the customer is misusing the account is or for valid reasons. Bank can close the account, but again, bank has to provide a reasonable notice to the customer. Termination by law. Bank stop all debit transactions and only after legal documents balance is given and account disclosed in case of a death of a customer. When there is a bankruptcy or company liquidation, if the customer is declared insolvent, the balance goes to the official receiver and the account is closed. In garnish or attachment order, which we have already uh, ex- understood in Unit 7 and we have discussed in brief a while ago, accounts may be frozen or closed. In insanity, if the customer becomes a person of unsound mind, bank closes the account after confirming it through medical documents. Customer awareness. Most customers don't know their rights and duties in bank relationship. That's why bank must take efforts to educate customers about terms and conditions, banking procedures, legal consequences. So this basically helps the customer to manage their accounts better and avoid the confusion. Banking Code and Standard Board of India. Back in 2003, the RBI noticed that many common people were not getting proper banking services. So, a special committee was set up under Sri S.S. Tarapure, a former deputy governor of the RBI. The goal of the committee is to find out why customer service in bank was poor and to suggest ways to improve banking services for common people. As a result, RBI decided to form a new organization, the Banking Code and Standards Board of India, just like the one in the UK. So BCSBI was officially registered on 18 February 2006 under the Societies Registration Act. Now, the main purpose of this uh, organization is to make sure banks keep their promises to customer and treat them fairly. Key objectives include create and publish rules called codes for good customer services, monitor whether bank follow these rules properly and work independently, not under the direct control of any bank or RBI. Now, this organization BCSBI issued two important codes in partnership with IBA, Indian Banks Association. Number one, Code of Banks Commitment to Customer, and number two, Code of Bank Commitment to Micro and Small Enterprises (MSEs). So these codes are like promise books where the bank lists how they will treat customer and small businesses. Now in 2019, RBI decided that BCSBI was no longer needed as its functions were being handled internally. So BCSBI stopped working from 1st April 2019. But the codes created by BCSBI are still followed by banks, and RBI uses them to check the quality of customer service in bank. So let's understand these two codes now. What is the nature of code? So these codes provide minimum standards that all member banks should follow. It's fair treatment, transparency in charges and services, clear communication, better relationship between the bank and customer. So code of bank's commitment to customer. This code includes promise to individual customers about opening savings or current accounts, issuing debit credit cards, providing lockers, resolving complaints, loan, foreign exchange, remittance, internet banking, etc. And code of commitment to micro and small enterprises. So this code include all the points from the first code plus extra help for small businesses like letter of credit, bill and factoring, interest rate transparency, support during financial difficulty, and protection of data. Key commitments made by bank. So member banks have some important promises like act fairly and reasonably, to help customers understanding banking products, to provide support, to use services, to quickly fix problems, to keep customers' data private, to inform customer about the code, and not to discriminate the customers based on the age, gender, or caste. Information transparency. Bank must show interest rate, charges, terms clearly. Bank must notify customers about any change in charges. Bank must explain products properly, and bank must register customers for do not call services to stop spam calls. Grievance redressal mechanism. So here the bank must set up a help desk at every branch. A code compliance officer at high levels. Bank must display contact numbers at branches, and details of banking ombudsman should be given. Steps for complaint resolution involves that the customer will go to the branch help desk first, then the customer will contact the code compliance officer, and if it is still unresolved, the complaint will escalate to the banking ombudsman. Obligation of on the customers. So even though the code are voluntarily for banks, customer also have basic duties such as do not share your password, OTP, pins, do not click on suspicious links in SMS or email, don't store sensitive data on mobile, use only trusted website for online banking, to inform the bank if the card or credentials are stolen, to submit correct KYC documents, to sign form properly, to register mobile number and email with the bank, to use non-home branches only when needed, and to safely use checks and cards. So these are some of the obligations on the customers. So every business, including bank, receives complaints from customers, and a complaint is when a customer feels something went wrong, like poor service, unfair charges, delays, or issue in transaction. And if the bank ignores the complaint, it may lead to a bigger problem. It may damage the bank's reputation and goodwill in the market. That's why every bank has a system to handle complaints called grievance redressal policy. Also, RBI made it mandatory for banks to have a proper complaint handling system. In 1995, RBI introduced Banking Ombudsman Scheme. So this gave customers an alternate way to complain in the bank if the bank didn't help. In 2019, RBI started an online complaint management system that works 24 into 7. And in 2021, a new and stronger framework was introduced to further improve the process. And in 2021 as well, the integrated ombudsman scheme was introduced. So we'll discuss about it later in this video. Model policy on grievance redressal. So the bank's complaint policy is based on simple principles. Number one is fairness. All customers should be treated equally and respectfully. There should be a timely response. That is, the complaints should be resolved quickly. Transparency should be maintained. Customers should know how to complain, whom to contact, what to do if they are not satisfied. And every complaint should be handled in a professional manner, in an efficient manner. Staff must act honestly and in the customer's best interest. So, good faith, good intention must be there. Also, banks have a complaint system working at every level, be it branch level, regional, office, zonal, and head office. And all bank staff should be trained to handle complaints properly. Internal complaint handling system. So, customers may sometimes feel unhappy with the bank service. And if handled properly, these complaints can actually build trust and loyalty. So, good complaint handling is equivalent to happy customers, which in turn makes bank reputation better. But if the handling mechanism is poor, the customer will left frustrated, and there might be some legal troubles as well for the bank. So banks must have a strong internal system to resolve issues professionally and politely. So number one is customer awareness and facilitation. So bank must help customers by giving full information like where to complain, how to complain, what are the forms, website, in person, and when will they get a reply, and what to do if they are not satisfied. So this information must be clearly displayed at bank branches. It should be printed in welcome kits, and uh, banks have to make sure that this information is also available on the website. For this, bank provides certain facilities like complaint or suggestion box for written feedbacks, suggestions at each branch. Then there are complaint register books, a register where customers can write complaints. One copy goes to the branch and another goes to the higher office. Then we have online complaint system for fast tracking and record keeping. Website complaint forms are available. Every bank website should have a form to file complaints. There should be contact information available of the nodal officer, senior staff in charge, and every bank website should mention that the right of a customer to go to RBI Ombudsman is there if a complaint remains unresolved within 1 month. Complaint redressal mechanism. So, the first step, the first point of contact is frontline staff. The first person the customer meets, like the cashier or the clerk, should try to resolve the complaint directly. If staff cannot resolve it, the bank branch manager gets involved, and they must investigate the issue, contact the customer is needed, and send a written reply to the customer. The details of the complaints are then sent to the regional or zonal office. If the issue remains unresolved, it goes to the regional or zonal office. They try to settle it within 7 days, and if it is still not resolved, the complaint reaches head office. Now, the head office reviews all details, take a final decision, inform the customer, and instruct branches if any improvement is required. And if the customer still feels unhappy, they can complain to the banking ombudsman within 1 year of receiving the bank's reply. The letter sent to the customer must include the ombudsman contact details and the statement about the customer's right to escalate. So, if a complaint is not resolved within 1 month, the branch must send a copy to the nodal officer who handles ombudsman matter. This helps if RBI seeks update later. Online dispute resolution system. The Reserve Bank of India wants a tech-based, fair, transparent system to solve customer complaints, especially related to failed digital payments. And that's why in August 2020, RBI told all authorized payment companies like banks and wallet providers to set up an online dispute resolution system. Purpose is to help the customers quickly raise and resolve disputes related to failed transactions like UPI failures or unsuccessful card payments. And this system can be accessed by customers and payment system participants. Later, the ODR system will be used for all types of dispute and not just for the failed transactions. And if the complaint is not solved in 1 month, the customer can approach the RBI Ombudsman under the Ombudsman Scheme. Uh, a customer can raise complaint in multiple ways. Now they can raise a complaint via website, mobile app, phone calls, IVR, call centers, via SMS, by visiting the branches or offices, and even apps like phone pay, google pay must allow filing dispute directly in apps. Now there are some extra features of ODR. It should auto fetch transactions uh, from the source shared by the customer. Now that is the data should be fetched and data privacy should be maintained. Customer should be able to track complaint status, like we can track courier parcels. So in a similar way, the customer should be able to track their complaint status. Handling unauthorized electronic transactions. So sometimes fraud happens through digital banking, like money deducted without your permission. In this case, what should bank do? So when sending SMS or email alert for any transaction, bank should allow the customers to reply directly to report fraud. Bank must give a direct link on their homepage to report such issue, and once reported, the customer should get an instant acknowledgement and reference number. The bank's system should record time and date of the complaint, which is important for deciding the customer's liability. And this complaint must be resolved within 90 days. And if it is not resolved, the customer must be compensated as per RBI rules. So, for example, for savings and current account, so there should be no loss of interest. And for loans and credit cards, there should be no extra interest charged to the customers. Credit related complaints. So bank must have proper internal redressal system to solve loan related complaints. Dispute should be reviewed by a senior level authority, at least one level higher. Uh, and the banks must regularly review how well they follow the fair practice code and uh, how well their complaint system actually works. Strengthening of grievance redressal mechanism in banks. So RBI launched a full framework to make the complaint handling system in banks more effective and customer friendly. Bank must report detailed complaints data to their board. They must analyze uh, all the common complaint areas. What are the frequent sources of issue? What is there any systematic problem? And complaints should be published in the annual report and on the bank's website, except those which are resolved within one working day. Apart from them, all the complaints should be posted, published in the annual reports. Now, some of the examples of uh, areas where bank must report complaints on, banks must gets complaint. So it is ATM debit cards, credit cards, internet mobile banking, account opening, operation, loan issue, excess charges, staff behavior, then check issues, senior citizen facilities, and RBI will recover the cost of redress from banks that get more complaint than the average in their peer group. And peer group average is calculated using complaints per branch, complaints per 1000 accounts, and digital complaints per 1000 digital transaction. Then there is an intensive RBI review. Uh, RBI will regularly monitor banks' complaints handling performance. Banks with recurring issues will undergo detailed inspections, and the goal is to find and fix system level problems to improve customer experience. Principal Nodal Officer. All banks must appoint a Principal Nodal Officer under RBI Ombudsman Scheme. This officer should be at least of the rank of a Journal Manager. So, that if a customer faces a serious issue, they know that their complaint is being heard at a high level. The name and address of this officer must be shared with RBI, and the contact details must also be clearly displayed on the bank's website or the app. Review mechanism in public sector banks. So RBI told public sector banks to regularly review their complaint handling system. Some of the important points are to continuously check if the system is working effectively. If some branches have too many complaints, then they should create special teams to handle them, to consider transferring the branch manager or staff to another department. In large branches or branches with many complaints, bank should appoint a public relation officer or license officer to talk to the customer. Customer service and communication skills should be included in staff training. If a complaint is not upheld, the bank must give a complete explanation to the customer. Chief Customer Service Officer. So, to further improve customer service, RBI asked certain banks in 2015 actually to appoint an internal ombudsman known as Chief Customer Service Officer. Now, this officer must not be an employee of the same bank. Their role is to check those complaints which the bank has rejected or not fully resolved, and before telling the customer the complaint is closed, the bank must show the matter to the CCSO, the Chief Customer Service Officer. And from 2018, all scheduled commercial banks with more than 10 branches except RRBs must appoint an internal ombudsman. So it is mandatory for them. Now let's talk about the RBI Integrated Ombudsman Scheme 2021. So earlier RBI has three different schemes: Banking Ombudsman Scheme, NBFC Ombudsman Scheme, and Digital Transaction Ombudsman Scheme. So RBI, in order to simplify things, merged all these schemes into one scheme. So this process was done in November 2021, and Integrated Ombudsman Scheme came out of it. So the key features is of this scheme is that it covers all RBI regulated entities like banks, NBFCs, payment companies, and it is absolutely free of cost for customers. If a complaint is not resolved in 30 days or a customer is not satisfied, then a complaint can be filed under this scheme. Even non-scheduled cooperative banks with deposit of 50 crore are included, and it follows the idea of one nation, one ombudsman. So these ombudsmen are RBI appointed senior officers, and at present there are 22 ombudsmen present. Complaints go first into a special center called CRPC, Central Receipt and Processing Center. It is at Chandigarh, and CRPC then send valid complaints to the right ombudsman based on the region. Now, how complaints are filed? The customer can file a complaint online at cms.rbi.org.in or through an email, or offline modes can be used like post or courier. But again, a lawyer cannot be hired to file a complaint. Only individual or authorized representative can file a complaint, and services of an advocate cannot be engaged for filing a complaint. Now, what is the complaint processing flow? Before that, we need to understand what can ombudsman do. So the ombudsman can ask the bank or the NBFC to provide any document or information. If the NBFC or the bank they didn't respond, it will be assumed that they have nothing to submit. And the ombudsman must maintain confidentiality unless the law requires disclosure, the provider agrees, or if needed to fairness between both the parties. Now let's talk about the complaint processing. So it is divided into several steps. The first step is the scrutiny by CRPC. So CRPC check complaints and puts them into three buckets: invalid complaints, not maintainable complaints, and valid complaints. So for invalid complaints like asking for advice or explanation, these are closed. For non-maintainable complaints, complaints which are outside the scheme scope, these are also closed, and valid complaints are sent to the ombudsman and shared with the bank for a written reply. Then the resolution process by the ombudsman is the second step. The ombudsman tries to resolve the complaint in the order of facilitation, mediation, and then award. So facilitation, letting both sides talk and settle. In mediation, it actually helps both the parties to come to a solution. And in award, if no solution is uh, reached, then the ombudsman passes a final decision, which is known as an award. So a complaint is resolved, is considered closed if it is resolved by the bank, if the customer accepts the solution, or the customer withdraws the complaint. Now let's talk about the proceedings, how hearing happens. So the process is quick and simple. There are no complex legal rules involved. Both sides may be asked for their statements and bank must reply within 15 days, or else the ombudsman may decide the case without hearing the bank and the bank will lose their right to appeal. Award by ombudsman. So the ombudsman decide a case after looking at all the documents from both the side and giving both parties a fair chance to speak. The decision is based on banking laws and practice, rules and instructions issued by RBI, and other relevant factors are considered. So the ombudsman can direct the bank or the financial institution. Uh, so these banks and financial institutions, we will refer them as the regulated entities. So the ombudsman can direct these regulated entities to do something specific, like to reverse the wrong charges or to pay money to the customer for any loss suffered. Again, there are limits on how much can be paid. So, for actual amount involved in the complaint, there is no limit. For actual loss, there is no limit. And if the customer suffered extra loss, any consequential loss, then the limit is 20 lakh rupees. And for mental stress, harassment, time and effort, the maximum amount that can be awarded is 1 lakh rupees. What happens after the award? So the decision is sent to both the bank and the customer. The customer must give a written acceptance within 30 days to the bank unless the customer is filing an appeal. And if there is no response provided in the 30 days and no appeal is filed, then the award becomes invalid. Yeah. And once the customer accepts, the bank must follow the order and inform the ombudsman within 30 days unless the bank files an appeal. Now let's understand appeal process before the appellate authority. So if either side is unhappy with an award or rejection, they can appeal to the appellate authority, who is an executive director of RBI. So executive director of RBI is the appellate authority. A bank can appeal only if it is approved by the top officials, the chairman, the MD, the CEO, and a customer can file an appeal if the complaint was wrongly dismissed, if it was not dealt with seriously, if it needed more evidence than the ombudsman could handle, and there are no actual financial loss according to the ombudsman. Now, the appellate authority may allow an extra 30 days time for filing an appeal if there's a valid reason. Now, let's understand what an appellate authority can do. So, after listening both the parties, the appellate authority may dismiss the appeal, may cancel the award, can send the case back to the ombudsman for fresh review, can change the order or pass any other order as required. So, appellate authority decision is final and it is binding, just like an ombudsman award. Non-maintainable complaints. So when a complaint is not accepted, some complaints are not allowed under the scheme, such as business decision of bank, the dispute between a bank and a vendor, grievance not addressed directly to the ombudsman, journal complaints against bank staff, if the complaint is about service which is not regulated by RBI, if any dispute between uh, bank's employee or between the banks. So these complaints are not maintainable. Conditions for filing a valid complaint. So first, a person should complain to the bank. If they reject or don't reply in 30 days, then a person can approach the ombudsman. And the ombudsman must be approached within 1 year of getting the reply or within 1 year and 30 days if there is no reply was received. So this is actually the limitation period. If if the question asks what is the limitation period for filing complaint to the ombudsman, so it is 1 year after getting the reply or 1 year and 30 days if no reply is received. And customers must not, uh, the customer makes sure that complaints must not be already settled or pending before the another authority. If it is there, then they cannot file a complaint. The complaint must not be abusive or without reason, and it must be not filed beyond the time limit provided. So customer must give all the necessary information and file the complaint by himself or herself or through an authorized representative and not the advocate. Unless the advocate is a complainant, then advocate can also file a complaint, but a person cannot uh, engage an advocate, cannot use the services of an advocate to file the complaint. When can a complaint be rejected? So the ombudsman or deputy ombudsman can reject a complaint if it is fall within non-maintainable categories we just discussed. If it is just a suggestion or a question and not an actual complaint, if there is no clear mistake by the bank, if the claim amount is more than the ombudsman power, if the complainant is not serious, and if it needs detailed investigation which is not suitable for this platform, this ombudsman platform, and if there is no financial loss or inconvenience caused, then a complaint can also be rejected. Powers and functions of ombudsman. So ombudsman can settle or close all types of complaints, and deputy ombudsman can handle only non-maintainable complaints or those resolved through mutual agreement. Ombudsman can pass an award if no agreement is reached, and every year ombudsman send a report to RBI as of March 31st, giving overview of cases handled and any other information RBI may ask for, and RBI publishes this report. Responsibilities of regulated entities. To support the smooth working of the scheme, every bank must appoint a principal nodal officer, at least general manager level, and display key information about the ombudsman scheme in bank branches and offices, on the ATMs and websites, and provide booklets of the scheme in the branches. So earlier when people faced problems with product or services, they found it very difficult to get help because civil courts were slow, expensive, and had complicated processes. So there was no special laws for the consumers. Business and sellers had more power, and consumers, especially poor or less educated ones, suffered. And to fix this problem, the Consumer Protection Act 1986 was introduced. Now, this act was good, but it was made before digital technology and online shopping. So after 1991, India opened its market, e-commerce, international trade, online payments became normal, and the 1986 law could not handle these new issues. So in 2019, a new and improved law was passed, Consumer Protection Act 2019. Now, the purpose of this law is to protect the interest of the consumer. It gives consumer an easy and fast way to resolve their complaints. With respect to its applicability, it is applicable to whole of India, including Jammu and Kashmir. And this act does not cover certain goods and services. So, goods bought for resale or for commercial use, services which are taken for free, or services under a personal contract like hiring a personal tutor or driver. So, these services are not covered under Consumer Protection Act. So, for example, if you hire a gym trainer and gym trainer promise you that you will lose 5 kg of weight, but you lose only 2.5 kg of weight, so you cannot sue the gym trainer. Uh, or let's take another instance. So, you hire a private tutor. So, you are preparing for certain exam, and if you do not clear this exam, you cannot sue that tutor. So Consumer Protection Act 2019 does not replace other laws. So this act does not override any other law. It works alongside other laws. So if another law says you cannot claim a refund in a special case, then Consumer Protection Act cannot overrule that law. Salient new aspects of Consumer Protection Act. So it clearly defines consumer rights. It covers false advertisements, misleading advertisements, and misleading endorsements. It includes online sales, e-commerce. It allow consumers to sue manufacturers or sellers for defective products. That is product liability, and it covers direct selling, multi-level marketing, tele-shopping, etc. So these new concepts were introduced. Now, who's a consumer? Under the Consumer Protection Act, a consumer is a person who buys goods or has services, but these services should not be for free. These services should not be for under a personal contract. And the goods which you have bought should not be for the purpose of resale or for commercial purpose. And if someone pays or agrees to pay for them, so even if a person promises to pay for the goods or the services in the future, that person is also covers under the ambit of a consumer. And it also includes people who buys online from Amazon, Flipkart, or through teleshopping or direct selling. There's one thing you need to understand, that if a person buys something for self-employment, like a sewing machine for tailoring work, then he or she are still treated as a consumer, not for commercial use, but for self-employment. You will be considered as a consumer. Consumer rights. So under Consumer Protection Act 2019, there are 6 rights given to every customer or consumer. Now, what are they? Right to safety. Now, every consumer has a protection from dangerous goods or services. Right to information about products price, quality, ingredients. Then right to choose. Consumers should have a variety of options at fair price. Right to be heard. Consumers can complain and expect response. Right to redressal. A consumer can consumer has a right for compensation or refund for defective product or bad service. And last but not the least, right to consumer education. So consumer has a right of awareness, how to file complaint, what are its remedies, so on and so forth. Now let's look into some key definitions. A person is not just a human being. It includes a single individual like you and me, a business partnership, even if it's not officially registered, HUF, cooperative society, any group of person, a company, corporation, or even any legal creation like trust or board. Advertisement. So any message or publicity done through TV, radio, internet, newspaper, SMS, poster, label, it is called an advertisement. Endorsement. When a person or an organization supports a product in an ad, it's called an endorsement. So this can be a spoken or written statement, a celebrity photo or signature, or an organization name or seal. For example, if a particular sports person says that the shoes help me to run faster, it is an endorsement. Goods means every kind of movable property, and it includes food items. For example, a fridge, wheat, a car, these all are goods. Services means facilities provided to users like in banking, insurance, transport, electricity. But if someone helps you for free or under a personal contract, it's not considered a service under the law. Keep that in mind. Express warranty. When a company promises something about a product or service in writing or advertising, now this is express warranty. So any claim promise which assures that the product or service meet a certain standard. So this is what an express warranty. For example, a paint lasts 5 years, so it is in written. Uh, then it is an express warranty. If a phone has a 2-year warranty, then it's an express warranty. Product manufacturer. A product manufacturer is someone who makes the product or its parts, assembles the product using part made by others, put their own brand name on a product made by someone else, and also involved in designing, packaging, repairing, selling, or distributing. Product seller. A product seller is someone who is in the course of business, imports, sells, repairs, packages, or label goods, and is involved in any step of selling it to the consumer. Now, the product seller does not include is someone just leases property without control of the property, or gives professional advice like doctor, or is acting only as a financer. So in that case, that person is not a product seller. Electronic service provider. So a person or company that helps in selling or promoting goods or services online in an is an electronic service provider. Website like Amazon, Flipkart, OLX. So these are electronic service provider. Complaint. A complaint is a written allegation made by a customer asking for a relief. When goods have defect, services are poor or deficient, price charged are more than that of printed or agreed. So unfair pricing is there. Product or services are hazardous to life. product or services does not match the quality what was promised, or there is an unfair contract or practice. So we'll understand in a bit what is an unfair contract, what is an unfair trade practice. But before that, let's understand what is a defect and what is a deficiency. So defect means any fault or imperfection in goods. So defect is related to goods such as quality, quantity, durability, standard. So defect, you whenever you heard this term related with goods. Deficiency, a deficiency is a fault or poor performance in service. So defect is in respect of goods, deficiency is in respect of service. If a courier company delays your urgent document delivery, then there is a deficiency in service. Unfair contract, product liability, and product liability action. Um, when we are understanding advertisement, we should also understand misleading advertisement. So, an advertisement is misleading when it makes false claims, it shows second-hand items as new, it falsely says a product is approved by the government or expert, or it hides the price or gives wrong price comparisons, or it sells harmful product knowingly or misrepresents warranty or features. So, it is a misleading advertisement. Now let's understand unfair contract. A contract is unfair if it favors the business heavily, if it imposes huge penalties only on the customer, it puts customer at a disadvantage, it removes your legal rights, or it forces you into terms that are unreasonable. So then it is an unfair contract. A product liability. So if a product causes harm, the manufacturer, seller, or service provider can held be responsible. So this is called product liability. And a product liability action means the legal action a consumer can take against the responsible party for harm caused by a faulty product. Uh, we also understand spurious goods. So spurious goods are fake goods or duplicate items passed off as real goods. So they are spurious goods. So selling a fake Nike shoe with a similar logo is selling spurious goods. Unfair trade practice. So doing business using tricks or cheating methods is called unfair trade practice. It includes false advertisements, not giving an invoice, not giving a bill, selling expired goods, falsely showing price or offer, hoarding to raise the price, not taking back defective goods. So these are all examples of unfair trade practices. Now various foras. So the Consumer Protection Act has built upon a certain framework, and it broadly comprises of these four bodies: consumer protection councils. So these are at three levels: center, state, and district, and they render advice on promotion and protection of the consumer rights. Central Consumer Protection Authority, so it regulates matter relating to violation of the right of the consumer. Now dispute redressal commission is the place that handles consumer complaints which are filed under Consumer Protection Act. And then we have mediation cells. So these are attached to each of the redressal commission and the regional regional benches, sorry. And these cells try to get the dispute settled through the mediation. Consumer protection councils are to protect consumer rights in India. Different councils and commissions have been created at central, state, and district level. Uh, so, consumer protection councils, they guide and they spread awareness. So these councils do not handle complaints. Instead, they focus on advising the government, educating uh, people about consumer rights, promoting awareness, and these are at three levels: central, state, and district. So central consumer protection councils are formed by the central government. They advise on promotion and protection of consumer rights. They have up to 36 members, including ministers from central and state government, MPs and officials from consumer affairs, regulators, CCPA, etc. Minister of Consumer Affairs is the chairperson. State Consumer Protection Councils, they are set up by state government, includes both officials and non-official members, maximum 10 members, chaired by State Minister of Consumer Affairs, and they should meet at least twice a year. District Consumer Protection Councils, they are formed by the state government for each district. It includes members from various fields, and district collector is the chairperson. All similar to State Consumer Protection Council, they should also meet twice a year. Central Consumer Protection Authority. So the Central Consumer Protection Authority is like the consumer police at national level. So it is a regulatory authority uh, such as TRAI, FSI. So it protects consumer rights across India. So it was created to take strict action against violation of consumer rights, unfair trade practice, and false or misleading advertisements. When we talk about its structure, it comprises of chief commissioners and other commissioners. It is headquartered at New Delhi, and it can have regional offices across India. It's it is divided. Its functions are divided into two parts: main function and ancillary function. Main function is to protect consumer rights, stop unfair trade practice, stop false or misleading advertisements, and ensure honest business practices. And its ancillary, its other functions include investigation, can inquiries. So it can start investigation on its own or through complaints. It can appear in consumer court cases. It can study what's stopping people from getting their rights. It can promote best practices followed in other countries, can run awareness campaigns. It can warn consumers about dangerous goods or services, and it can issue guidelines for businesses. Now, its power includes inquiry, to investigate violation of rights of false advertisement, uh, to ask the companies to recall harmful products or services, to stop false advertisements and punish endorsers or advertisers, and to search and seize documents or products if needed. Appeal can be filed. So, if someone is unhappy with CCP's order, they can appeal to the National Commission within 30 days. Not following CCPA's direction can lead to an imprisonment up to 6 months or fine up to 20 lakh rupees. And if a business puts out false advertisements, punishment can include imprisonment up to 2 years and fine up to 10 years. And for repeated offenders, imprisonment can last up to 5 years and fine up to 50 lakh rupees. Consumer Dispute Redressal Commission. If a consumer has a complaint about a product or service, they can approach Dispute Redressal Commission. Now, there are three levels: district, state, and national. District Commission is set up by the state government in every district, and it works from district headquarters or any other notified place. It comprises of a president and at least two members, one of which must be a woman, and it handles cases where value is not more than 50 lakh rupees. State Commission. State Commission is set up by state government. It works from state capital. It comprises of one president and at least four members. One must be a woman. Uh, com- with respect to its jurisdiction, the complaint value should not be greater than 2 crore rupees and should not be less than 50 lakh rupees. And with respect to unfair contract, it handles complaints which are less than of 10 crore rupees. National Commission, it is set up by central government. It works from Delhi NCR, and its composition includes president and at least four members, one of must be women. With respect to appointment and tenure, the term lasts for 4 years or till the age of 65, whichever is earlier. A member can be reappointed and appoint the selection committee includes High Court judges, Consumer Affairs Secretary, and Chief Secretary nominee. Jurisdiction of consumer commissions. So the term jurisdiction, it means which commission will handle a case, a particular case, and this is usually based on two things: the value of the goods or services involved in the complaint, and the location of the person filing the complaint or the company against whom the complaint is filed. So let's understand with district commission. The district commission will handle complaints where the cost of goods or services up to 50 lakh rupees. Also, the complaint can be filed in district commission if the person or the company against whom the complaint is filed lives, works, or runs a business in that district. If there are many opposite parties and at least one of them lives, works, or runs a business in that district, and the district commissions allows it, the incident or the problem happened that the cause of action arises in that particular district, and the complainant lives or works in that district. So, in that in these four cases, a complaint can be filed. The state commission handles bigger and more complex cases. It deals with complaints where the value of goods or services is more than 50 lakh rupees but should not be more than 2 crores. And the complaint is about an unfair contract and the value of goods or service involved is up to 10 crore rupees. Also, it looks into the appeals against order passed by district commission in that particular state. It can revise cases if it feels that the district commission took a case it should not have taken, did not take a case it should have taken, or did something wrong while handling the case. And the complainant can file in the state commission if the person or the company against whom complaint is filed lives, works, or does business in that state. The cause of action arose in that state, the complainant lives or works in that state, or if there are many parties or at least one of them is based in that particular state, and the district commission gives its permission. National Commission handles cases where the value of goods or service is more than 2 CR. If the complaint is relating to unfair trade, unfair contracts, then the value should exceed 10 crore rupees. The National Commission will handle appeals against the order of state commissions and cases transferred from state commission for specific reasons. Now, who can file a complaint? So, under Consumer Protection Act, a person who is a consumer can file a complaint in a district commission where there is a problem related to goods or service. So, who can file a complaint? A consumer, someone who buys goods or service for personal use. A group of consumers, a consumer association, legal heirs. So, if the consumer has passed away, so legal heir can file a complaint. Parents or guardians, if the consumer is minor, or the government authorities can file a complaint. So, you cannot file a complaint if you bought goods for resale or for commercial purposes. And again, if you have received services for free or under a personal contract. Fees for filing complaints. So there is no fees if the product or service cost up to 5 lakh rupees. Above 5 lakh rupees, a fees is charged. The amount is notified by the government and the payment can be made by demand draft, postal order, or electronic transfers can be uh, permitted. So when will complaint not be accepted? So if the case is already being heard by a civil court, then the Consumer Commission will not entertain that complaint. Keep that in mind. Now, how are the complaints handled? So, after filing the complaint goes through some stages. The first being the admissibility. So, the commission checks if the complaint is valid and decision should be made within 21 days. If no decision is made within 21 days, then the complaint is automatically admitted. Reference to mediation. If there is a chance of settlement, the parties may be sent for mediation. Both parties must be given consent within 5 days, and if mediation fails, the case continues in the commission. Complaint types. So, complaint involving goods. So, a copy of goods is sent to the seller or opposite parties. They must reply within 30 days, and a 15 days extension is permissible. It is possible. If technical testing is required, a lab test is arranged. The lab report is shared by both the parties, and both parties are allowed to present their views before the final order. And if the complaint is about services or do not need testing, then in particular case, the opposite parties give their reply. The commission makes a decision based on the evidence. If the opposite parties does not reply, the commission may decide ex parte, that is only on the only on the evidence which is presented. And if the consumer does not appear, the commission may dismiss or decide on merit. Power of district commission. The district commission has the same power as civil court, such as summoning the witness, receiving evidence, issuing orders. It is treated as a judicial authority and has power like a criminal court for certain legal matters. Orders that can be issued if the complaint is found to be valid. Excuse me. The commission may order the seller or service provider to repair the defect, to replace the product, to refund the amount with interest, to pay the commission for loss or injury, to remove the defect in goods or service, to stop unfair trade practice, to stop selling hazardous goods, to withdraw dangerous product, to issue a corrective advertisement, and to pay cost of complaint proceedings. And if a large number of people were affected, the commission may order the seller to pay at least 25% of the value of those goods to the affected consumers. Complaint to state commission and national commission. So the state and national commission follow similar procedures, but the value is higher. So they also have some additional powers like declaring unfair contract terms as void and cancelling ex parte orders passed by district commission if the affected parties complaint, file an application, sorry, if it is appealed. Appeals against orders of district or state commissions. Uh, we start with appeal against district commission order. So if a person is unhappy with the decision of the district commission, they can appeal to the state commission, and this must be done within 45 days from the date of the order. But no appeal is allowed if the case was settled through mediation. Appeal against state commission order. A person can appeal against state commission order to national commission and within 30 days. Appeal can be made if the order involves a serious legal question or the order was passed ex parte. Now, the appeal should be resolved within 90 days of being accepted. If there is a delay, reasons must be recorded in writing. Normally, no extension are given, so there are no adjournments. If granted, then the reason must be written and the cost may be charged. And if a person is unhappy with the National Commission's order, they can appeal to the Supreme Court within 30 days. If no appeal is made, the order of district, state, or national commission becomes final. Other important aspects, limitation period. So, a complaint must be filed within 2 years from the date the issue has occurred. If delayed, the commission may allow it if there are valid reasons for the delay. Enforcement of order. Orders passed by the commission are treated like court decree, and these can be enforced like any other court order as per civil procedure code. Penalty for non-compliance. Uh, so if a person does not follow the order, imprisonment for 1 month to 3 years can be imposed, or a fine of a minimum of 25,000 to 1 lakh rupees can be imposed, or both imprisonment or fine. And the commission has the power of a judicial magistrate of first class. Also, such cases are summary trials. Appeal against penalty. So if a person is punished under section 72, they can appeal within 30 days from district to state, state to national, from national to Supreme Court. And delay can be accepted again if there are valid reasons. Transfer of cases. To ensure justice, a case can be shifted by state commission from one district to another, and by national commission from one state to another, or between state commissions. Frivolous complaints. If a commission finds the complaint is baseless or is done to harass the other party, it can dismiss the case, or it may order the complainant to pay up to 10,000 rupees to the opposite party. Digitalization. So the Act supports e-filing of complaints, online fee payment, and video conferencing for hearing to save time and reduce difficulties. Review power. The district and state commission can review their own orders if a request is made within 30 days to correct any error. Good faith protection. If any officer or employee of the commission has taken any action in good faith under the Act, then no legal case can be filed against them. Now, this protect honest efforts by the officers. Mediation process. So, when a consumer dispute is sent for mediation, it goes through a forum process to try and resolve the issues peacefully without going through the courts. Now, mediation cells, who sets them up? State government sets up mediation cells at each district commission and state commission. Central government set up mediation cells at the national commission and regional benches. The cells will have members as per government rules. And what records are kept? So, list of mediators, list of case handles, notes of all proceedings, other requirements. So, all of these are kept. And every 3 months, a report must be submitted to the commission. It is attached. How mediators are selected? A panel is created by each commission, and this is based on selection commission, which includes president and one member of the commission, who can be a mediator. Persons like retired Supreme Court or High Court judges, district judges, or member of consumer commissions, advocates with at least 10 years of experience, experts with 15 years of experience, retired senior government officers, people already working as mediators in the court, and people with at least 5 years of experience in mediation can be appointed as mediators. And if the person is declared insolvent, has criminal charges, or is facing any disciplinary action, then that person cannot be appointed as a mediator. Mediators are appointed for 5 years and they can be reappointed again. So they are appointed for 5 years and they can be reappointed again. Uh, Now let's understand the proceedings. So both parties should attend the mediation proceeding. If one party does not attend, the commission can ask them to participate, and everyone must give the required documents or information. The mediator ensures fairness and natural justice. There is no need to follow strict court rules like CPC or Evidence Act, and a report is written and signed after every session. What happen if agreement is reached? So in that case, a written agreement is prepared, it is signed by both the parties, and it is given to the commission in a sealed envelope. And what if no agreement is reached? So after 3 months, if no settlement happens, the mediator informs the commission, but does not share the private details of what happened in the mediation, and time can be extended if it is required. Mediator helps both the parties to talk and understand each other. Mediators suggest solutions but do not force any decisions and only reports to the commission in writing. So there are no private communications. Also, whatever happens in mediation stays confidential. No one uses things said in mediation later in the court, and no recordings of video or audio are allowed. Uh, so there are three types of settlements: full settlement, partial settlement, no settlement. So if everything is settled, commission passes an order within 7 days and close the case. If there are partial settlements, then commission passes orders for the settled part and continues hearing the rest. And if there is no settlement, commission continues full hearing like a normal case. Product liability: if a defective product harms a consumer, he can file a product liability case. Now, who can be held responsible? The manufacturer, the service provider, and the seller are covers this liability. They can be held responsible. Unfair contracts. So, when you shop online or use digital services, you often agrees to terms and conditions. So, these are click wrap contracts without reading or understanding them. So, these are usually one-sided and protects only the companies. Now, Consumer Protection Act 2019 allows consumer to challenge these unfair terms, these unfair contracts. And for value up to 10 crores, you approach the state commission. And if the value goes above 10 CR, then you approach national commissions. And if a company leaks or shares your personal information, which you have given in confidence, then it is considered as unfair trade practice unless it is required by law. banking services under Consumer Protection Act. So, Consumer Protection Act 2019 also applies to banks. If banks give poor service, then consumer can file a complaint. Some of the common deficiency areas are delay in returning your deposit, so bank must compensate for loss of interest or other damages. Bouncing off a valid check, if the bank wrongfully returns your check, then they may have to pay damages. Refusing to pay a valid bank draft, not crediting a deposited check. If banking correspondents collect money but does not deposit it, in that case also the bank will be responsible. If no receipt is provided or there are no updations in the account, then it will amount to deficiency of services. And if money is not credited in time for public issue like shares, the bank may have to pay for the loss due to the missed opportunities. Let's begin our video. So the Right to Information Act, it was enacted so that citizens can ask for information from the government and the public authority. It helps bring transparency and accountability in government work. So the main goal of this act is to fight corruption, to make sure government departments are answerable to the people, and to allow people to know how public money is used. Prior to this act, we have Freedom of Information Act, and with the enactment of Right to Information Act, Freedom of Information Act was repealed. So with respect to applicability, it applies to whole of India. All public sector banks and government controlled institutions follow RTI rules. However, some information is exempted, like trade secrets, sensitive business information of bank, personal information of individuals like medical record, unless it's in public interest. So you cannot ask bank for someone's loan account detail unless it affects public interest. Now let's understand some key definitions. Appropriate government. So this means the government in charge of the public authority. So if fund flows from the central government, then the central government is the appropriate government, and if the fund flows from the state government, then state government is the appropriate government, and it also applies to the control. So if central government controls the organization, central government is the appropriate authority, and if state government controls the organization, state government is the appropriate authority. Competent authority. So decision makers for various institutions like Speaker of the Parliament, Chief Justice for Supreme Court, Chief Justice of the High Courts, President, Government. So different people depending on the authority are the competent authority. Information, any type of data in any format, be it document, email, report, sample, CD, digital file. So it is any data, any material in any form. So it is information. Public authority, so it is any body or institution, basically any organization which has been created by the virtue of constitution, by virtue of law, be it parliament or state legislature law, or it is controlled or funded by the government. So it falls under the ambit of public authority. Record is, it includes paper files, handwritten notes, microfilms, computer data, printouts or digital copy. So it is a record. Right to information. So basically, right to information is available to citizens, citizen of India. So this particular right is available to citizen and that too of India. So you are a citizen of India. So you have the right to see and inspect government work or document, to take notes or copies, get certified samples like material for from a road construction site. You have the right to get digital files or printed document. So you have this right to information. Third party, any person or organization other than the person filing the RTI is third party, and even public authority can be treated as a third party. Who can file an RTI? So all Indian citizens, if a citizen of India wants to get the information, then he has the right. Other than that, no other foreign citizen can demand this right. So all Indian citizens can file RTI, and this has been stated under Section 3 of the RTI Act 2005. So you do not need to give reason to ask for information. Keep that in mind. Duties of public authority. So every public authority must keep proper records. All the files should be organized and, when possible, stored in computers for easy access. And every public authority must publish basic information every year. They must share details like structure, what the employees do, what are the duties of employees, how decisions are taken, what rules are followed in the public authority, what type of documents do they keep, details of committee and boards, employees list and salary, budget details. Then we have subsidies or welfare schemes, who got government permission or benefit, what information is available in electronic form. So all these informations have to be published every year. Then they must give clear reasons when they make big decisions or policies. So they have to publish reasons. They have to publish reasons for major policies. And if an individual is affected, they should be told why. So they have to share reasons for individual decisions. Suo motu disclosure should be there. Suo motu means on its own. Now, authorities should not wait for RTIs. They should regularly publish important information by themselves. Wide dissemination should be there. Information should be shared using newspapers, websites, notice boards, etc. And information should be shared in the local language. It should be available in printed or digital form. Also, it should be available at low cost or free of cost. Basically, it should be at reasonable cost. Public information officers, PIOs for short. So, every government department uh, called the public authority, they must appoint PIOs in all their offices. These officers are responsible for giving information when someone asks for it under RTI. Then we have assistant public officers. Every public authority must also appoint assistant PIOs at subdivision or block level to receive to receive the application and then forward them to the concerned PIO. Other officers, so a PIO can ask help from other officers to gather the required information. If those officers fails to help or violates RTI, they will also be held responsible like the PIOs. How to apply for information? So any citizen can apply for information in writing or by mail, either in English, Hindi or any local language. A small fees of rupees 10 has to be paid, and it can be paid in cash, demand draft, check or postal order, and there is no need to give reasons or personal details. Now, time limits for response. The normal time limit the PIO follows is 30 days. So, a PIO must reply within 30 days. And if it is about someone's life or safety, then the reply must be within 48 hours. If there is no reply in time, it is considered denied. Excess and fees. Um, if additional fees is required, then the PIO will inform the applicant to pay the fees. For extra fees, 2 rupees per page for A4 and A3 will be charged. For disabled applicants, will provide them special help. For persons below the poverty line, no extra fees will be charged from them. For paper bigger than A3 size, actual cost of the paper will be charged. Then we provide free inspection of records for first hour, and after that we'll charge rupees 5 for every 15 minutes. Rejection and appeal. If the PIO denies the request, he must give the reason why he has denied the request. Mention that the appeal period which the applicant has and give details of the officer who will hear the appeal. Information should be given in the format requested unless it is difficult or harm the record, and if only partial access is provided, then PI will give the part and explain why the rest of the part is not provided or why it has been removed, and the applicant must be told about his right to appeal. Transfer of application. So if the information is held by another department, the application will be transferred within 5 days and the applicant will be informed. Third party information. So if the information is related to another person or organization and is confidential, then the PIO will consult that party. If the public interest is greater, then the information may still be shared. Now, certain information cannot be shared. It is known as exempted information. So, if any information which affects the sovereignty or security of India, or it is forbidden by the law, or if provided would result in the contempt of court, if it is a confidential information like trade secret, IPR, or the information has been received in confidence from the foreign government, if it endangers someone's life or safety, or could disturb an ongoing investigation, as well as if the information pertains to cabinet meeting records, then the information cannot be shared. So it is exempted information. Appeal. So if a person is not satisfied with the information provided, or if he has been denied, uh, sorry, if he has been denied of the information, then in that case, the person can file an appeal. So the first appeal must be made within 30 days to the officer senior to the PIO, and delay can be excused, but valid reasons have to be provided. Then there is a second appeal. If not satisfied with the first appeal, a second appeal can be filed within 90 days to the Central or State Information Commission. Their decision shall be binding and will be final. Orders and appeal. So, the Information Commission can order the department to provide information or take corrective action. They can appoint a PIO if there is not a PIO appointed. They can impose penalty on the officer. So a fine can be imposed with the minimum limit of 250 per day and up to 25,000. They can order to compensate the applicant for the loss, or they can reject the appeal if it is not justified. Central Information Commission. So let's understand about CIC and SIC. So the Central Information Commission is a body that helps people to get information from the government departments under RTI. Now, CIC has one Chief Information Commission and up to 10 Central Information Commissioners. And they are appointed by the President of India based on the recommendation from a committee that includes the Prime Minister, who is the chairperson of the committee, the leader of opposition in Lok Sabha, and a Union Cabinet Minister, which is nominated, chosen by the Prime Minister. And who can become an information commissioner? So only those person with a good reputation and experience in the field of law, science and tech, social work, journalism, management, mass media, administration, they can be appointed as information commissioner, and they must not be a MP or member of state assembly. They must not hold any government office or office of profit, or be associated with a political party, or be running a business or practicing a profession. Now, with respect to tenure, they work for 3 years or till the age of 65 years, whichever comes first. There is no reappointment, and Central Information Commission may later become the Chief Information Commission. With respect to office location, the CIC headquarters is in Delhi, but it can set up offices in other part of India as well. SIC. So every state has its own State Information Commission to handle RTA issues related to state government departments. With respect to members, we have one state Chief Information Commissioner and up to 10 state information commissioners, and they are appointed by the governor based on recommendation of the committee, which composes of Chief Minister, Leader of Opposition in the State Assembly, and a Cabinet Minister. With respect to qualification and restriction, it is same as this CIC, and with respect to tenure, again 3 years or until the age of 65, whichever is earlier, there shall be no reappointment, and a state information commissioner can later be made state chief information commissioner. Penalties and violation. So if a government officer does not give information properly, the central or state information commission can impose a penalty. As stated earlier, it is 250 per day of delay in giving information, or maximum of 25,000 rupees. Again, other disciplinary actions can be taken. To the commission may also recommend disciplinary action sorry, If the officer deliberately avoids accepting RTA applications, does not give information in time, rejects the request without reason, or gives false or incomplete information, destroys the information, or create obstacles in giving information. Now, this RTA Act overrides other laws, so the RTA Act is stronger than any other older law, like Official Secrets Act 1923. This means if there is a conflict between RTI and any other law, the RTA will prevail. And the court again cannot hear any case against decisions made under RTI. Only appeals under the RTI is allowed. Now let's talk about certain exceptions. Last topic under this unit. So when RTI does not apply, we have to understand this. Uh, so those organizations which are listed under second schedule are exempted from the application of RTI. Say these are Central Intelligence Security Agencies like RAW and IB. Again, there is an exception. So if there are corruption or human rights violation cases, information must be given after CIC approval. State level security agencies are also exempted. So the state government can also declare certain bodies as exempted. Again, the same exception which applies to the Central Intelligence Security Agencies shall apply to state level security agencies. Thank you for watching this session. I hope module A is clear to you. But again, if you have any doubts, you can reach out to us on our Telegram group channel, JAIIB CIB Prep. We'll meet again and we'll start module B from next class. Till then, please take care and do revise your modules.